Hello, this is BinkyGTTT. Just want to say hello. I have prepped a few stock market, macro market radar segments. There are 5 major segments, non-trivial length. Don't feel like you have to listen through in one session. This is perspective going into earnings and OPEX. All audio has been sped up for friends and family. Market profile, ending October 20th, 2024, earnings on deck. Welcome to the main event. It's prime earnings season, and the Titans are stepping into the ring. Seasonality meets the market cycle. Expect fireworks. Tesla, ticker symbol TSLA, reports on Wednesday. Wild volatility, possibly some baffling commentary from Elon. Reeling from the robots, but on a SpaceX landing high. Love it or hate it, this one's a must-watch. Bank of America, ticker symbol BAC, lands on Tuesday. How have they been handling rate changes, and how does their guidance stack up against the big guns last week? Their balance sheet will reveal all. Procter & Gamble, ticker symbol PG, checks in on Friday. Not flashy, but reliable. People still need soap, toothpaste, and all the essentials they dominate. Earnings here will act as a bellwether for investor sentiment across tech, finance, and consumer goods. Buckle up. Recent CPI results. Last week's CPI report showed inflation at 3.7% year over year. Core inflation remained sticky, but the market isn't panicking yet. The Federal Reserve is stuck between a rock and a hard place. Inflation is slowing, but not enough for Powell and company to celebrate. Upcoming economic data is critical. Implications for this week. Higher CPI could pressure the Fed to keep rates elevated longer. Watch how the market digests this. It's likely to drive more caution, especially in growth stocks. Economic data to watch. Inflation news is simmering in traders' minds, and we've got more numbers to crunch. Retail sales on Tuesday will show if consumers are still spending despite rising rates. It's either a good sign or they haven't felt the pinch yet. The Philly Fed Manufacturing Index on Thursday indicates economic health. If weak, expect risk-off moves as slowdown fears take hold. Fed watch on early radar. Jawbones engaged. No Fed rate decision this week, but the central bank's influence remains. After the sticky CPI, listen for hints from Fed speeches. Inflation above target means traders will parse words for rate hike clues. Geopolitical and natural disaster notes. The Israel-Iran conflict is intensifying, making oil markets jittery. Crude prices are spiking as traders factor in potential supply disruptions. Higher oil prices could fuel inflation concerns, troubling central bankers. Watch energy stocks and commodities. Last week's Gulf hurricane spared major oil rigs but hit agriculture. This could ripple across commodity prices, especially in energy and food. Futures and international markets. As of today, October 14th, overnight futures are cautious. Modest declines as the market grapples with last week's CPI and awaits this week's earnings. European markets digest geopolitical risks, waiting for U.S. inflation data. Asia's markets are mixed. China's modest recovery provides optimism, but global economic headwinds might drag growth down. That's my quick tracking map for the week, ending October 20th, 2024. What is your take, and what are you watching? Stay nimble, stay frosty. I should be back Wednesday if fortune favors the foolish. I've curated some long-form clips for you. Not urgent, just interesting to the community based on recent discussions. Hello, this is BinkyGTTT. Just want to give you a couple of comments on a few stock market, macro market radar video segments you're going to listen to and watch. There are 4 segments, non-trivial length. All of the audio has been sped up for the benefit of the friends and family that listen to them. Usually the visuals are not that interesting, and you will hear in the course of each of the 4 videos that there are probably screenshots that you'll want to catch up to at a point when you can review the visuals after listening to the audio. I don't have any strong opinions about any of the content other than to say they seem directionally correct to me, and that some of the very bearish projections that you'll hear in the last segment are pretty severe. I do think it's a good thing to be aware of them. But the source for that segment is a contributor to Zero Hedge, and his track record is kind of a perma-bear in my opinion. In the interest of full disclosure, I just wanted to paint that context for you. Hopefully you find each of the clips interesting. Let me know with comments in the videos and/or ping me up directly with a direct message if you have follow-up questions or thoughts. Price always rules. I do welcome your observations and thoughts for everyone who's listening on what your take is on these topics and segments. I think that we potentially may begin topping on SPX over the next 6 weeks if we do not get a lift out of earnings. I do believe that we've got another rally probably as high as 6,300 based on SPX volumes that I see and option strikes out in December and January. But we may be hard-pressed to push above that without fresh liquidity injections, which could come in the guise of more dramatic rate cuts faster than I am expecting. But the guidance from earnings into the week past the election may be enough to twist sentiment. I confirmed on Friday. There are even higher upside targets farther out now in further dated expiries, but I think that the election results are going to probably cloud that time horizon, so I'm not actively building out in any of those strikes that are farthest out other than long leap positions that have been established far out in time for several different tickers, futures, and equities. Sorry for the long-winded monologue. I hope this is helpful and just wanted to give you a little context. Have a good trading week, be nimble, some of the horses are skittish, especially around Iran, BRICS, and election volatility. Any of these could trigger a pullback, possibly even a checkback of 10 to 15% if our participation with Israel defense gets more kinetic over the next few weeks. As always, none of this is financial or investment advice. This is provided for your education and entertainment. Copyrights and trademarks belong to their owners. I leave them in mostly for attribution and disclosure. They are not endorsements. Cheers! Thank you to everyone who contributed comments. Your insights are invaluable and help make this community stronger and more informed. If you'd like your analysis or predictions featured in future videos, drop a comment or send us a message. Stay engaged, stay informed, and we'll see you next time. Cheers.
May not, and I'll let you answer this, may or may not increase volatility. What's top of mind for you right now in terms of risk factors that could derail the 6,000 S&P target that a lot of people haven't given me on my show?
Yeah, look, I mean, I think it starts, so phenomenal question. I think anytime you think about, trying to understand what the full balance and distribution risks are when you're approaching asset markets, I think it's important to understand what has caused the current positioning to build. In our view, the current positioning is associated with a function of 3 themes. One, our resilient U.S. economy theme, which we authored back in September of 2022. We've seen a general and persistent upside surprise in U.S. growth, which we've been calling for the past couple of years. We expect that to continue. And that, in our opinion, has contributed to some of the mildly crowded positioning that we've seen on the long side of risk assets. The number 2 theme that we're highlighting is the here comes the liquidity theme. We have the view that both U.S. and global liquidity are set up to accelerate markedly over the medium term. And that's partially a function of the number 3 theme, which we've maintained since November of last year, which is our J1 the soft landing theme. This is a Federal Reserve that has an asymmetrically dovish reaction function. And anytime you hear the phrase asymmetrically dovish reaction function, it generally pays to be bullish as an investor.
Well, let's just highlight some of your high conviction calls. So this came in from a recent research summary that your team sent me. High conviction, again, like you just mentioned, the liquidity issue, a weak USD should accelerate global dollar recycling and provide Chinese authorities scope to accelerate support of the economy. Does this narrative or this thesis depend on who is president by January, Darius? Because we do know that Donald Trump is very much bullish on the dollar. He wants a strong dollar. He's adverse to the dollar losing its reserve status. Vice President Harris has not made similar comments, so I'm curious to see how her monetary policy or even fiscal policies will translate to the dollar. But what is your take on whether or not the election may impact the dollar?
Yeah, the election may certainly impact the dollar. If you think about the 2 choices that we have as candidates, we have Kamala Harris and Donald Trump. With respect to, I think the markets are assuming that there's going to be a significant change in tariff policy and how the U.S. is, sort of responding to Chinese trade policy. And the reality is there's not much of a difference. But the big difference that we see is that we're probably going to see an incremental application of tariffs towards China. But it's very unlikely, just based on the folks that Trump has surrounded himself with respect to his economics team, if he were to win the election, it's very unlikely that we see anything in line with what he's been sort of talking about on the campaign trail. It's very typical of what you see in elections, which is politicians promise a lot and deliver a little, and that's sort of our expectation. But it could be something that could cause our conviction in that theme to wane in the coming months.
Okay, so let's highlight some of the negatives from both campaigns, at least the worries from investors. On the Trump side, tariffs. So people are concerned about tariffs. Trump has promised to slap on 100% tariffs on some Chinese EVs, for example, where actually, no, not 100%. He recently said 200%. He raised that to 200%. He promised to increase tariffs to 100% on those countries that want to ditch the dollar, trading with the dollar. Let's comment on that first before we move on to the Harris side. Donald Trump's tariff policies, are they bad for the markets? In the past presidency, we saw that markets did not like new tariffs on China. Would things be any different now?
We have a different take on that. I mean, we don't think this stuff matters all that much to markets at all. I mean, if you think about what really genuinely matters to asset markets over medium to long-term time horizons, it's usually one of these 4 things. It's growth, it's inflation, it's policy, and it's liquidity. every now and again, the profit cycle will kind of rear its beautiful or ugly head, depending on where you are in the business cycle, to have a significant influence over asset markets. But in our view, the things that you need to pay most attention to as investors are growth, inflation, policy, and liquidity. And with respect to growth, inflation, policy, and liquidity, 3 of those 4 cycles, as we talked about at the beginning of the show, are moving in a direction that is supportive of asset markets. The inflation cycle is unlikely to continue moving in a direction that's supportive, but tariffs would obviously be a secondary headwind with respect to that cycle. But if you go back to 2019, and I'm pulling this off the top of my head, so don't quote me on this, but I want to say markets rallied about, the S&P 500 rallied about 35% in 2019 at the height of the previous Sino-US trade war that was obviously engineered by executive policy in the Trump administration. So we're not of the view that that's going to be the only thing that matters to asset markets. In our opinion, those bigger cycles are what's really driving the boat here, and we have a moderately sanguine view on most of it.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below, or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. And by the way, JD Vance made this point during the VP debate. He said that tariffs have not been inflationary during Trump's presidency the last time. Take a look at the CPI chart. Let's just fact check this, if you will. Have tariffs been inflationary? The CPI overall, and we can segregate this by specific items, but overall, during Trump's presidency, the CPI didn't spike to abnormal levels until we had the pandemic, and then the Fed introduced unlimited QE. But can you make the argument? Now, let me just make the argument that tariffs have not been inflationary overall in the last administration. Just looking at the data, am I wrong, Darius?
No, you're correct. Tariffs are a regressive tax on consumer spending, so it's very likely to be durably inflationary. You could have a one-off change in the price level that creates a one-off shock in inflation, and I do believe we saw that in 2018 relative to the trend of inflation that we observed in the post-crisis era, post-GFC era. We did have a significant increase in inflation to right around 3% on a core basis in 2018. That was a big change from what we had experienced for the prior 5 to 7 years. So that was a meaningful shift. However, it wasn't necessarily inflationary in the way that you, I, or consumers across America are currently sort of characterizing that today. So again, we don't believe that tariff policy in and of itself is inflationary. What we see the biggest upside risk to inflation stemming out of either the Trump or Kamala Harris administrations, because we have a relatively sort of similar view on the outlook for fiscal policy in either administration. Where we see the inflation, the next round of inflation to come from is populism, and we continue to see populism brew up on both sides of the aisle, mostly as a function of the broken down social contract that we have here in America. I'll show a chart from our most recent macro scouting report. Every month we publish this report for our clients here at 42 Macro, where we try to help them kind of hone in on all the kind of big growth, inflation, policy, and liquidity drivers of asset markets, and so provide them with a very sanguine, clear view of how those things are likely to unfold. And when you look at this chart here, we show employee compensation divided by nominal gross domestic income. That's declined to about 56%. We see corporate profits as a share of gross domestic income that has accelerated to 13%. If you go back and you look at the long-term means of these time series, the respective means of these time series, they were 63% and 9% respectively. So we've had essentially a 400 basis point shift away from employee compensation into the corporate profits. Now, that doesn't sound like a lot, but it's a significant deal as it relates to what drove that shift. We've seen a hollowing out of the U.S. manufacturing sector over the past 20 to 25 years. And as a function of that, we've seen a greater and greater share of corporate profits go to, or a greater and greater share of national income go to corporate profits. And part of this, in our opinion, was globalization. Obviously, we had the NAFTA agreement in the late 90s. We had China join the WTO in 2001. And as a function of those policies and other policies, not the least of which is QE, incessant QE, sort of siphoning, creating a stimulus for the incomes of the folks in the upper income of the distribution. We've had a series of policies in this economy that have really kind of put the middle to lower, quote unquote, class on its back, middle to low income household consumers on their back. And as a function of that, they're pissed off, for lack of a better word, David. They're upset, they're frustrated, and they're looking for solutions. This is why Donald Trump is a politician. This is why we've gotten a sequence of populist monetary and fiscal policy since 2008. And we are likely to continue to see a sequence of that populist fiscal policy going forward.
Sorry, what is a populist monetary policy?
Populist monetary policy is socialist monetary policy. The policy that won't allow big banks to fail. The policy that won't allow, hedge fund managers, my clients, to actually have bad years. That's the kind of policy that we see. It's really just all a function of what we see as kind of the main driver of this, which is, we have this socialist economy that's sort of masquerading as capitalism. But the reality is, when you have socialism, Democrats, they practice socialism for the poor. If you look at the government social benefits divided by household income, that's been up and to the right for the last couple of generations. If you look at the effective corporate tax rate in this country, there's been down and to the right over the past couple of generations. So both parties are combining to support the incomes of their quote unquote constituents. But the reality is Donald Trump, with based on some of the work that my former colleague and mentor, whom you recently had in your show, David Howe, based on some of the work that he's been exposed to vis-a-vis Steve Bannon, he understands this chart here, slide 99, which shows the breakdown in the social contract here in America. And as a function of that, he's caused not only just the Republican Party, but he's also pulled the Democrat Party even more left and even more populist.
By the way, on taxes, okay, so Kamala Harris wants to raise corporate tax sorry, the capital gains tax, not corporate tax. She wants to raise corporate tax as well, but capital gains tax 28%. That would effectively bring a combined total capital gains tax for the top earners to 33%, which would be the highest since 1978. Would that cause a market sell-off?
It probably would, yeah, but it's unlikely to occur, right? I mean, you have to essentially have a supermajority in the Senate in order to get that done. So it's very likely that no matter who wins the White House, we're probably going to have some form of a divided government. The highest probability outcome, we don't get the top of the ticket is a toss-up, but we know that the Senate is more than likely to flip to Republican leadership, and we know that the House is a reasonably high probability of flipping mildly into Democrat leadership. So right there alone tells you you're probably not going to get some of the more left, more aggressive policies from either candidate. And so what's more than likely to occur, which is why we continue to believe that populism is the only outcome from the starting point, is what's more than likely to occur is both parties are going to have to come together to figure out the deals, what they want out of the negotiation of the expiring core tenets of the Tax Cuts and Jobs Act. Recall that at the end of next year, we're going to see significant changes with individual tax policy going back, essentially reverting back to where they were in 2017 prior to the Trump tax cuts. And so we know that no matter who's in office, neither party wants that outcome to occur. You don't want to implement a significant tax hike on a consumer, particularly in an economy where we're already observing evidence of slack being created in the labor market, inverted yield curve, et cetera, with the Fed, kind of responding to all those things. You don't want to hike a bunch of taxes because you're essentially going to cause a recession. So what's more than likely to happen, David, is Republicans get what they want on their wish list. They'll probably get 80% of their wish list, and Democrats will get 80% of their wish list, no matter who takes the top of the ticket. And in our opinion, we want investors to be focused on that as the underlying message from U.S. fiscal policy is that the entire curve is shifting left or shifting populist, both parties included.
By the way, the increase in the capital gains tax that I just read to you applies to only those people making more than $1 million annually. So, top 1% of the population. The argument here from the conservatives is that, well, those people are the people driving growth in the economy and consumption on the most part. What is your philosophy here? Does wealth trickle down? In other words, if you derail the wealth effect for the wealthiest, will that derail the entire economy?
Yeah, it more than likely would. I mean, I'm not a big fan of the K-shaped U.S. economy as someone who grew up on the very bottom part of the K. Spent half of my life on the very bottom of the K, and now I guess I'm a part of the top part of the K now. Lord willing. But in our opinion, yes. So the answer to your question, David, is yes. So if you look at the share of income, consumer spending by income cohort here in America, what we see is that the upper third of households by income account for 51% of consumer spending, which compares to only 15% for the lower third. So one of the things that we've been sort of pounding the table on for the past couple of years that has become consensus, but it wasn't consensus when we authored the theme back in September of 2022, was our resilient U.S. economy theme, and part of one of the core tenets of that theme was what you and I are discussing right now, which is the environment for rich people in this country is actually quite favorable. We have policy that is getting incrementally favorable, and as long as that's the case, and as long as asset markets back then we were kind of at the lows of markets, but if they start to recover, which we anticipated that they would, if they start to recover, then you're going to see a continued expansion of the U.S. business cycle, and that's exactly what we observe, and that's exactly what we're likely to see, assuming that no policies are going to be no significant policies are going to be enacted that kind of disrupts that apple cart. And again, it's very unlikely we see the apple cart materially disrupted in the context of the composition of the White House, and Congress that we're going to observe some point in Q4. I mean, again, we don't have the view that the election is going to be decided on November 7th, but we do have a view that we're probably going to wind up with divided government. And divided government means both parties get what they want as opposed to neither party gets what they want. It's game theory.
Okay. That's very interesting. So what you're saying is either way, can we see the wealth gap close or not widen as much if the country is leaning more socialist from both parties?
Well, that's one of the key core tenets of the fourth turning, right? I mean, you think about one of the big dynamics that occurs in a fourth turning is you typically have a significant decline in income inequality. That's something we've observed. So we did a big deep dive statistical study, piggybacking on my Newhouse work on the fourth turning. His work is more focused on the geopolitical drivers and outcomes in the economy. We're focused more on what's going to happen with the economy, what's going to happen with policy, and how those things are going to impact asset markets. Because again, what we're trying to do here at 42 Macro is help our clients make money in financial markets. And so one of the things that we typically observe in a fourth turning in the context of this big deep dive empirical study that we did, where we analyzed time series going all the way back to 1800s, so we can get a sense of how do these time series statistically evolved in this fourth turning process. And one of the things we found, with data as far back as we can get it, is that if you go back and you look at income inequality as a function of the top 10 share of national income, what you typically observe in this previous fourth turning was that it declined sharply throughout the duration of the fourth turning. And so as if, we're kind of, we're starting from a very high level again, and it's our expectation that income inequality declines sharply throughout the duration of this fourth turning. So we're going to see policy, in our opinion, that is incrementally populist, that essentially is, Robin Hood policy, if you will. We're going to take from the rich and give to the poor. Now, it may not happen next year in the context of a divided government. It may be in response to a bigger crisis that investors are, that both households and investors need to navigate. But ultimately, I think as someone as an investor, or just even someone as a voter, you need to be aware that things are probably going to get better after they get worse in the context of this overall fourth turning view.
I interviewed Neil Howe in the fourth turning, and one of the tenets of the fourth turning, by the way, for the viewers who don't know or are familiar with the concept, every 80 years, there is some sort of generational crisis that needs to happen. And you probably know more about this than I do, so you can explain more detail. In this fourth turning, a lot of things could happen. Rise of populism, like you talked about, rise of conflicts internally and perhaps even externally. So we're talking about civil conflict, civil war, perhaps in the extreme case, and obviously global wars as well rising. We're talking about perhaps a different change in attitude from one generation to another. But generally speaking, from what I gather from Neil Howe, we're looking at perhaps more volatility as more fear ratchets up. But yet, you told me offline, and this is your core thesis for investing is that you're still medium-term bullish. So how do you reconcile the differences between the coming of the fourth turning and your bullish outlook?
Yeah, 100%. It's how it's how policymakers have historically responded to these geopolitical and economic, socioeconomic developments. Historically, they've responded with two things. One, a lot of fiscal support of the economy, which obviously creates a higher nominal GDP environment, which is generally supported for asset markets, or for risk asset markets, less so for defensive assets like treasury bonds. And then what we typically see from the Federal Reserve is monetary debasement and financial repression. And so it's our belief that as a function of those three things, excessive fiscal policy, support of the economy, monetary debasement to capitalize that fiscal support, and currency devaluation to capitalize that fiscal support as well. If you put those three things together, you should be, just like we've been for a long time here, 42 Macro, structurally bullish on risk assets like stocks, credit, crypto, and commodities, and structurally bearish on defensive assets like treasury bonds and US dollar. Doesn't necessarily mean the treasury bonds or the US dollar are going to decline in price. The dollar will likely decline in price as a function of those policies. But doesn't necessarily mean the treasury bonds are going to decline in price because we're getting financial pressure. So, I'll show you a couple of charts from our fourth turning analysis that sort of support that takeaway. So one of the things that we observed in this study that money supply growth tends to accelerate sharply during fourth turning. So that's something that we're anticipating as investors. If we have a significant uptick in money supply growth, you're talking about a significant uptick in liquidity, and historically, a significant upticks in liquidity have done, that we have perpetuated, raging bull markets and risk assets. The other thing I would highlight is with respect to the financial pressure that we're likely to see. The 12-month real T-bill yield has tended to decline substantially in fourth turnings, which means the Fed has a negative policy rate on an inflation-adjusted basis. You've also seen the same similar dynamics with the 10-year real treasury yield. So there is an evidence of financial repression occurring in this fourth turning, and we have a belief that we're probably going to see even more financial repression in this particular fourth turning than we have historically. If you look at this chart here, where we show the private sector, we break down the marketable treasury securities market into its various large investor cohorts. So you have the Federal Reserve, which shares declining; it's plus 16% or 16% of the total now. You have commercial banks, U.S. commercial banks; their shares have been declining since 2021 as well. They're now 15% of the total. And then if you have foreign central banks, which is the black line, that peaked back in 2008, their share continues to decline at 14% of the total. So if these three major cohorts of investors are all sort of divesting at the margins, relative, or at a minimum not keeping up pace with the growth of public debts here in this economy, that means the private sector has to pick up the slack. So the private sector was 36% of the marketable treasury market back in late 2021 when we called for bond yields to materially accelerate to the upside as a function of the return of the treasury's net financing policy in 2022. So that's obviously something that we were accurate and prescient on. But you go look at that 36% ratio, it's now up at 54%. So the private sector investors now, real money investors now own 54% of the marketable treasury market, up from 36% just a couple of years ago. And just the reason that's important, David, is because investors will demand higher yields to capitalize on Sam. We, the private sector, want return for the units of risk that we're taking in our portfolios. We're not just going to, buy a treasury bond at any price like a foreign central bank would, or a commercial bank would, based on changes in regulation, Basel, Dodd-Frank, et cetera, or the Federal Reserve would if they're implementing a large-scale asset purchase program. And so that's, in our view, the Fed has to do something to offset that. And so we're going to see more currency debasement. We're going to see more financial oppression by banks into the treasury market. Currently, banks are 18% of their total assets are in treasury and agency securities. When you do some ratio math, because we don't have that time series going back as far, you do some ratio math, it was about 47% of commercial banks' treasury and agency securities back in the prior fourth turning. So we know that number is going up. We know the Fed's balance sheet is going to go up, and we also know that foreign central banks, depending on how this geopolitical developments progress throughout this fourth turning, are probably not going to increase their share. So as a function of all that, then the Fed and regulation that financially represses investors into the treasury market will have to accelerate markedly, and all those things are incredibly bullish for risk assets.
Okay, and your base case. Yeah, and your base case assumption here, flipping back to my screen on your notes here, your base case assumption is that the U.S. economy will remain resilient, medium conviction. The U.S. economy remains resilient due to historically strong sector balance sheets. You just talked about that. To what extent would a war in the Middle East derail this thesis here?
Yeah, I mean, look, I'll say this, and I don't mince, words about this. Obviously, we have a tragic situation, what's going on, across the middle, all over the world. Obviously, Russia, Ukraine, we all seem to forget about that one as well. What I've noticed throughout my career, and my career began on global Wall Street at the depths of the financial crisis in 2009, we've seen nothing but geopolitical consternation, whether it be outright wars, deaths in wars, conflicts, the total amount of conflicts, the headlines associated with conflicts. Those statistics have done nothing but go up and to the right throughout my entire career. You know what else has gone up and to the right throughout my entire career? The stock market, Bitcoin, gold. So in my opinion, a lot of you got to focus on, in my opinion, this is our humble opinion, and it's using my humble opinions to help thousands of investors around the world make tons of money. You got to focus on the things that actually matter most to markets. And so, David, to your point, the way we would characterize the impact of an acceleration in the conflicts that we're seeing with Israel and Iran, which, by the way, that conflict began a little bit over a year ago. Stock market's up 35%, Bitcoin's up like 150%, gold's up like 30%. Again, it's not the conflict that matters. It's how policymakers respond to the conflict and or not even pay attention to the conflict at all. So in our opinion, how that will ultimately derail asset markets is through the lens of liquidity. So one of the things that we do in the context of our longer term views, we obviously have to keep an eye on the cycles. We have to risk manage the cycles. So if you think about this just from a, thinking about this from a secular standpoint, we think the line is up and to the right with respect to risk assets. However, that does not mean we don't need to risk manage cycles along the way. There are plenty of cycles to risk manage along the way. And if you're, too long at the top of the cycle or not long enough at the bottom of these cycles, then the total amount of return, the total return you're going to face in these cycles, and both on a Sharpe ratio basis and also on a nominal basis, is going to be much lower than investors who are respecting those fluctuations. And so And we have to do a lot of research around where we are in the growth cycle, the inflation cycle, the liquidity cycle, the policy cycles to understand, okay, where are we? Are we here? Are we here in the context of this longer term structural bullish bias? And so one of the things that we do to help investors understand that is we do a lot of work on liquidity, what's happening with respect to the liquidity cycle. And so when we talk about liquidity, it's important for investors to know that if you don't have an informed view on liquidity, it's probably a big detriment to your investing activity. And how we define liquidity here at 42 Macro is the aggregated sum of the world's major central bank balance sheets, the broad money supply from those economies, their FX reserves minus gold from those central banks, and then we run a bond market volatility overlay to account for fluctuations in the repo market, which also have an impact on the overall risk taking that we see in financial markets. And since the global financial crisis, since 2007, risk assets have only corrected or crashed for two reasons: either a declining liquidity or refinancing air pocket, which means that there wasn't enough liquidity for the previous issued debt around the world to get refinanced at appropriate rates, and so you had to draw down in total non-financial sector debt. So if you look at the black dotted lines so in this chart, we show our global liquidity proxy. That's the blue line. S&P 500 is the red line. The total non-financial sector debt is the shaded area, and the black dotted lines coincide with the big corrections and crashes that we've experienced as investors since the start of 2007. And every single one of them, with the exception of Armageddon, coincided with a refinancing air pocket or a decline in global liquidity, or both. And so it's our view that if you're going to have the Middle East sort of the consternation that we're currently seeing in the Middle East, if that deteriorates to an all-out war between Israel and Iran, that won't be the issue. What will be the issue is that we're going to have a refinancing air pocket and a decline in liquidity. And so currently, if you look at our forecasting tools, we understand what the key leading indicators of liquidity are with respect to a 3 and 6 month lead. It's stocks, it's crypto, it's the US dollar, it's FX volatility, it's interest rates, it's bond market volatility, it's growth, inflation, unemployment. And so we, at all times here for 42 Macro, for our clients, we're maintaining this model and refreshing this model to help them understand where is liquidity likely headed over the medium term. And we do this by taking the sum of the correlation adjusted z-scores of those variables and subtracting the current z-score of where our liquidity proxy is. And if there's a positive residual or significantly positive residual, then we'll have a view that liquidity is likely to increase significantly over the medium term, or vice versa. And right now, we're in the view that liquidity is going to continue to trend higher over the medium term. Right now, if you look at all the major economies in the world, the global liquidity is trending higher, Australian liquidity is trending higher, Canadian liquidity is trending higher, Canada or Chinese liquidity is trending higher, and it's going to accelerate meaningfully in the coming months. Eurozone liquidity is trending higher, India's liquidity is trending higher, Japan's liquidity is trending higher, Swiss liquidity and UK liquidity is trending higher. The only countries where liquidity is not currently trending higher is the US and Brazil. And so if you put this snapshot together with what's already currently happening, then you can kind of wind up in a place where the only way this could derail things is if we actually have significant pullback on some of those drivers of liquidity, like the dollar gets stronger, fixed income volatility accelerates, and so you have to have a more informed view on what could potentially cause that.
How are you measuring liquidity? Is it bank lending, money movements, capital flows?
Yeah, so it's a little bit of all those three things. So we'll take a step back. We think liquidity comes from different sectors of the economy. It's not just all coming from central banks. It's not all coming from the private sector, commercial banks. It's not all coming from the repo market. It comes from all three actors. So how we measure liquidity in the context of our 42 Macro net, the global liquidity proxy, which again is the blue line in this chart here, that is the aggregated sum of all those central bank balance sheets that we just walked through. It's the aggregated share of their, or aggregated sum of their broad money supply, which we walked through, and it's the aggregated FX reserves minus gold, because obviously a lot of those FX reserves get recycled into liquidity instruments, and they reduce the burden of net financing for private sector investors, which allows them that frees up capital for them to go invest elsewhere. And so, one of the things that I think could potentially cause an issue in the context of our sanguine medium-term outlook for asset markets through the lens of the Israel-Iran conflict or any other many conflicts that are currently going on that none of us are talking about right now, because quite frankly, they don't really matter to asset markets. And again, this is a program to help investors figure out where asset markets are headed. So those things, if you think about what could potentially cause that, is how will this impact the US dollar? How will this impact US rates? Because those are the shortest, those are the most reactive things that would cause an inflection, a significant inflection on liquidity, starting with the dollar here. If you get the dollar right, you're probably going to get the general direction and trend of liquidity right. I.e., if you're right on the medium-term outlook for the US dollar, you're probably going to get the medium-term outlook for US liquidity right, or for global liquidity right. That's not always the case, but it's generally the case. And the reason for that is the dollar is a significant influence over global financing activity. Dollar is 60% of FX reserves, it's 60% of cross-border bank lending, it's 70% of international debt securities market, it's 79% of trade invoices, it's an 88% of foreign exchange transactions, and 99% of stablecoin backing. And so, how a weak dollar would, so how, let's assume your sort of your question is kind of leading us to the same place, which is let's assume that we did have a significant pullback in asset markets as a function of the Israel-Iran conflict. How would that actually? What would be the mechanism for that to occur? It would obviously result in investors thinking that there's more inflation in the system, therefore pricing out the global rate cuts that are currently priced in US dollar money markets. That would strengthen the dollar and cause the supply and demand for global cross-border financing to decline. But the supply goes down because the borrowers, their creditworthiness declines because their currencies are declining against the dollar. The demand goes down because the currencies are declining, and it's a little harder to service the debt. So that takes out one pocket of liquidity from the private sector. Then obviously you have foreign central banks probably unable to price in as many rate cuts into their forward rate curves, with forward guidance into their forward rate curves. That obviously causes that to unwind as well. And then you probably have declining global trade as a function of businesses and consumers getting incrementally concerned about the outlook for the global economy. And so you sort of have a inverse of what we're calling for. We're calling for all those things to be moving in the positive direction as they have been for the past year plus. But we ultimately see that there is a risk, to your point, David, that those things stop. But we're not forecasting them to stop. We're not going to, kind of base our investment decision making on what we feel is likely to happen with the Israel-Iran war.
Okay, on the issue of the U.S. liquidity situation declining, that's interesting. I'm going to like to drill in a little bit deeper on that. Let me just show you this chart first. Unrealized, this is from the FDIC website. Unrealized gains and losses on investment securities. This is share of longer-term loans to securities, 49.6% of first quarter of 2024, down from 51%. Anyway, you can see here, held to maturity securities and available for sale securities all underwater, and they have been ever since 2022. In fact, this is, in nominal terms, the most amount of unrealized gains or losses rather ever. Far worse in 2008. I don't know if this is significant at all, but just by looking at this, I'm assuming or I'm guessing that banks are more unwilling to lend if a larger amount of the securities held for maturity are not doing well.
Yeah, no, to me, this is the most bullish chart of macro.
Really?
Yeah, absolutely. Because what it means is that the policymakers, it stopped the policymakers dead in their tracks back in 2023. I mean, that's what it did. I mean, you go back to the UK gilt crisis in the fall of 2022, where essentially we had a significant VAR shock in the UK gilt market that caused the Bank of England to completely reverse course in their policy. The VAR shock that we had across commercial banks and the regional banking crisis last year essentially caused the Fed to reverse course on its policy with its forward guidance. Obviously, they got one more rate hike done from there, but the markets had already inflected if you look at the slope of U.S. money market curves from that point. And so this is, in our opinion, it's how the policymakers deal with these problems that creates the outcomes in asset markets. And obviously, with respect to the Fed, we got the BTFP, we got the dovish forward guidance, we got Jay now pivoting from I want to see pain to I want to see a soft landing. This was all in part and parcel in response to this issue. Because at the end of the day, what we're observing around the world is very clear and cogent evidence of central bankers prioritizing financial stability over economic outcomes, particularly over their price stability mandates. And as long as that's the case, you cannot sit there and be in defensive assets that are going to get eroded away by inflation. There's likely to be a sustained fund flow dynamic in support of risk assets and gold, Bitcoin, gold, stocks, all those types of assets that are not nominal and not tethered down to the U.S. Treasury market or global bond markets. And in our opinion, this is bullish because the policymakers are responding with dovish policy.
Okay. So let's turn over now to the China stimulus story. Just today, actually, on Tuesday, it was announced that the government officials met, I think, the night before, and they disappointed Chinese investors with I think, the lack of additional stimulus. Yeah.
Before we go to China, there's one more thing I want to point out.
Sure, yeah, please.
In the context of this conversation we were just having. If you look at U.S. liquidity, so we talked about global liquidity prior. Global liquidity is currently trending higher, and we're expected to continue trending higher. Obviously, if we get some news that could cause an inflection in that, then we'll have to respond in a Bayesian manner, which is why I do my job six days a week. But anyway, getting into U.S. liquidity. So how we track U.S. liquidity, which is basically how the world tracks it now. We actually invented the whole concept of net liquidity, which is the Fed balance sheet minus the Treasury general account balance minus the reverse repo facility balance. That had been in persistent decline all the way through the end of 2022 and really into the early part of 2023. It's been flat since then, despite the fact that the Fed has continued its quote-unquote quantitative tightening program. And the reason it's been flat since then, for two reasons. One, primarily because we've had a significant decline in the RRP. But why have we had a significant decline in the RRP? It's because you go back to the early part of 2023, which is what we talked about in terms of the Fed's reaction to the regional banking crisis. From that point forward, the forward rate curves for the U.S. money markets were negatively sloped, i.e. investors were pricing in rate cuts and rate cuts and rate cuts on a go-forward basis. And so in our opinion, those rate cuts that were being priced in the forward curve obviously were supportive of the returns that we've seen since then in the bond market and the inversion in the yield curve. And so the dovish policy, or at least investors expecting dovish policy, and ultimately the Fed ratifying that with its actual words and actual policy, have been one of the key reasons why U.S. liquidity has stabilized despite the Fed's quantitative tightening program. And ultimately, when you get into the first quarter of next year, as a function of the debt ceiling negotiation process, the debt ceiling moratorium lapses on January 1st, as a function of what's likely to be a relatively lengthy debt ceiling negotiation process, if we're right on our call for divided government, then you're probably going to have a significant drawdown in the Treasury general account balance as well, which is also supportive of the liquidity, supportive of U.S. liquidity, the same way that the significant decline in the RRP balance was as well. So again, this is sort of the environment, the economic environment. It does not necessarily mean to scream bullish. It's the policymakers' response to the economic environment that we need to be most abreast of as investors, and why we continue to be relatively sanguine on the medium-term outlook for asset markets.
Okay, so then let's have you sum up your outlook on U.S. markets. So you're bullish on what exactly? Stocks, bonds, all of the above?
Yeah, no, definitely not bonds. I mean, we made the call going back to September 17th to get out of the loan bond as a function of our medium-term views on the economy and how policymakers are going to perpetuate that with incrementally dovish policy. Right now, the Fed is cutting interest rates into a late cycle expansion that does not need policy support. And so what it's likely to do is cause both growth to continue surprising to the upside, which are currently already baked into our forecast, and it's likely to cause inflation to start to grind higher over the medium term. So in our opinion, that's very negative. That's a higher than expected nominal GDP environment, which is what we're calling for on a next 12-month forecast horizon basis. That, in our opinion, is very unlikely to be supportive for bonds. However, it is likely to be supportive for stocks and other risk assets, particularly in the backdrop of U.S. and global liquidity accelerating markedly in the first quarter of next year.
We do know that the Fed funds rate is going to come down either way. What is the relationship between the short end of the curve and the long end?
Yeah, well, I mean, in our opinion, there's not a tremendous linkage from our perspective. What we've seen throughout the business cycles, we've seen massive fluctuations in what was priced into from a forward rate curve perspective, both to the upside and to the downside. But what's really driving the boat, in our opinion, is what we see here on slide 37. Ever since we got our U.S. resilient economy thing back in the fall of 2022, real economic growth has generally and persistently surprised consensus expectations to the upside. When you look at our forecast, we're expecting that dynamic to continue. And so ultimately, we don't think what matters. We think the Fed should continue to front load policy rate easy because it will increase the probability that Jay gets the soft landing that he wants. And ultimately, we think that is what he wants his legacy to be as an investor. But as an investor, that doesn't necessarily mean you need to be long bonds. What we're essentially saying is the economy's fine. The labor market's fine. You don't need to run out and buy a bunch of bonds. In fact, investors probably bought way too many bonds going back to when we told them to sell them a month ago.
Okay. Do you have a target for the S&P 500 for us?
No, we're institutional investors. We don't have price targets.
Okay.
Whatever return we get throughout the duration of the market move is the return we get. We're not going to tell the market what it has to do for us.
I only have one question on China. And where I was going with China is that the stimulus package that was announced, it was immediately bullish for commodities, particularly base metals. Now, if base metals continue to rally on the back of more stimulus, by the way, they fell today because the stimulus measures announced last night failed to meet investor expectations. So the CSI in China and the Hang Seng fell. The Hang Seng had its worst day since 2008 today. Very, very fickle market over in China. But anyway, my point is, if the base metals do continue to rally, that could, in theory, feed into inflation, as that is an input cost for a lot of things, including construction. Does that transmission mechanism make sense to you? China stimulus bullish for inflation across the board, not just for China?
Yes, but we've had a view on inflation that inflation is unlikely to return durably to trend absent a recession since January of 2022. So what China's doing is only supportive of that view. Back to that fundamental research summary that you put up at the beginning. So that's our oldest research theme that we've been operating here as investors of 42 Macro. And the core tenet of the theme is that when you go back and you study business cycles here in the U.S. economy, what we find is that two things. One, inflation is the most lagging indicator of business cycle. It typically doesn't break down durably below trend until the recession. And number two, there is no historical evidence of it breaking down durably below trend prior to recession. So on a median basis, it doesn't do that. And then if you go back, you look at every observation in the sample and every post-war business cycle that we've had in the U.S. economy, we've never seen inflation. We've never seen the Fed win on inflation without a recession. And so it's our view that the Fed has a choice to make. And we would argue that the Fed has already made the choice. The Fed has made the choice that it wants financial stability. It wants a smooth functioning in the treasury market, which obviously the regional banking crisis was the shot across the bow to tell them that they need to do something different. They want smooth function in the treasury market. And that is more important, unfortunately, for the folks like myself, who, like I used to be on the bottom part of the K, the folks on the bottom part of the K. Unfortunately, that means we're going to have to deal with higher inflation. And this is something that Neil talked about in your conversation, David, with you about how historically, how have we financed, how have we capitalized, how's governments capitalized the big changes in fiscal policy that typically occur in the fourth turning? They do it one of three ways: currency debasement, borrowing, and taxes. Well, currency debasement and the borrowing, the Fed has kind of 1.5 kind of units in that. The fiscal policy is obviously the fiscal authority, and we continue to see populist fiscal policy that will be accelerated in the coming decade. But the Fed's responsibility in that is to make sure that we are comfortable buying a treasury bond with a real interest rate that is negative, potentially deeply negative, as we progress throughout this fourth turn.
Good segue. Final part of our conversation: currency debasement. You told me offline that your theoretical ideal asset allocation model would be 60% stocks, 30% fixed income, 5% cash, and 5% Bitcoin. Right. Let's drill down on the 5% Bitcoin because we talked about the other assets. How does that 5% Bitcoin allocation fit into your currency debasement thesis?
Yeah, that's a great question. So it's actually 60-30-10. That's our kind of flag. That is our flagship investment strategy that we use to help retail investors remain on the right side of market risk. We use a separate systematic strategy for our institutional investor clients. But with respect to our KISS portfolio construction process, so that is a 60-30-10 trend following strategy that is designed to essentially materially outperform 60-40 over the long term. And if you think about the average annual return of our KISS process, it's right around 15% with a max drawdown of 12% for CalMAR ratio, average annual return divided by max drawdown of 1.3. If you look at 60-40, the average annual return of 60-40 is all the way down to 10% with the max drawdown of minus 22%. So the CalMAR ratio there is only 0.4. So I think KISS is doing its job in terms of keeping clients in the market, participating in this monetary debasement regime that began back in 2008. We continue to see evidence of that monetary debasement regime not only accelerating domestically in the context of our J1 soft landing theme. The Fed, by the way, cut the policy rate 50 basis points with core inflation 70 basis points above target last month. So investors, I think we continue to get evidence of that theme. We're trying to do is keep investors invested in the market while also using our core risk management systems to kind of help them step aside heading into bear markets so that they can preserve capital and actually have money to invest when we get to the lows of those cycles again. And that's exactly what we're observing right now. So that 5% allocation in Bitcoin is just a function of the bottom up risk management overlay taking down the exposure to Bitcoin from 10% to 5% directly. And again, this is a trend following strategy, so it's we're proud of it.
Very, very good. Darius, this was a great talk. So overall constructive on the economy and on risk assets. Any sectors in particular, let's close off here, any sectors in particular within the S&P 500 that you are the most bullish on?
Yeah, that's a great question. So we are currently in a Goldilocks market regime. So this is our discretionary risk management overlay table. This is what we use. It's a tool that we use to help institutional investors pick factors long, short, and weight those bets. And so right now we're in a Goldilocks market regime. The key portfolio construction considerations in a Goldilocks market regime, specifically as it relates to equities, are you generally want to be long high beta equities over low beta equities. You want to be long cyclicals over defensives. You want to be long growth over value. You want to be long small and mid caps over large caps. That's generally how you want to be invested as an investor in Goldilocks. So with respect to some of these sectors that we like the most that have broken out most recently that probably have more upside from here are things like energy, things like industrials on the sector side. It's things like mid caps, small caps, high beta on the factor side, and it's in global equities, not global equities broadly, emerging market equities, China, EEM, India, those types of equities have historically performed quite well in this context of a Goldilocks market regime. I mean, it doesn't feel like Goldilocks from an economic standpoint, David, but if you think about what's happening in the economy, we have a slowdown in growth that is surprising to the upside. I mean, that kind of sounds like, the Three Little Bears story. It's not too hot, it's not too cold. And as a function of that, and the Fed is obviously aiding and abetting that with monetary policy, cutting interest rates, providing dovish forward guidance. They're probably going to slow the pace of fake QT in the coming months as well if they're unable to push through more rate cuts in the first part of next year as a function of the economy proving resilient and inflation starting to firm up again.
Okay, good. Darius, thank you very much for your analysis. Where can we learn more from you? Where can we follow 42 Macro?
Well, I appreciate you, David, man. Thanks again for having me on your show, and all the best to you and your viewers. So you can come check us out at 42 Macro. As you can see, we're a very data-driven shop. I cut my teeth on the global institutional flying around the world, meeting with institutional investors. Kind of learning a lot of these procedures and processes, and we're really proud of democratizing this for Main Street. This is something that, as I said, I grew up on the bottom part of the K in this economy, and I want to be able to take the blessing of the gift of math that I've been blessed with, and actually create tools and solutions for Main Street, in addition to the folks on Wall Street. So we're really grateful for that. That's at 42macro.com.
Okay, put the link down below, so make sure to follow Darius there. I'm just curious because you said you basically told us you grew up poor, now you're not.
Being understated, David.
well, we congratulate you. You're a success story on your own, if that's the case. So
give the glory to God, my friend.
The education system in the U.S., do you think we're lacking, or even in Canada as well, do you think we're lacking financial education in public schools?
Oh, we can go on a rabbit hole on this topic, but absolutely. I kind of have the tinfoil hat view that they don't want us to know this stuff. At some point, I'll probably fly too close to the sun and wind up missing.
I'm guessing you didn't learn advanced economics in high school, right? When did you start becoming acquainted with this subject?
I went to Yale, so I did start learning.
Okay, so at some point, okay. After high school, all right, yeah.
But no, I agree with you, David. I do think there's an education crisis in this country, and that's why, in my opinion, I think it's so important for folks like us with platforms to generate the interest and generate the support for fixing that problem. And it may be one of the problems that we fix in the before turning, but unfortunately, as our friend Neil would like to say, we probably have to go through the path of perdition before we get to the good part.
Do you feel like, just final question, we'll close off, follow 42 Macro in the link down below. Do you feel like we are entering the fourth turning right now, just from your own personal perspective, anecdotes that you've observed in your own life?
Yeah, no, there's a personal perspective. No, I'm sitting here looking at the forest, miles and miles of forest. So it's beautiful. My life is great. But no, from a purely economic standpoint, from a statistical standpoint, if you go back and, like we said, with that deep dive empirical study that we've done, there's probably 35 different time series that we've analyzed statistically to help investors understand what's likely to happen with the economy, what's likely to happen with monetary policy, fiscal policy, geopolitics, socioeconomic developments in and for turning. And if you look at how things have progressed since 2008 in this country and really around the world as well, we are sort of tracking right along trend. And so we have a very high conviction that we are A, in a fourth turning, and B, the fourth turning crisis will deepen in the coming years. And as a function of that, we want to make sure investors are participating in asset markets or exposed to asset markets with the appropriate solutions in their portfolio so that they can take care of their families in this what's likely to be an increasingly trying time.
Thanks so much again, Darius. And thank you for watching. Don't forget to like and subscribe and follow Darius in the link down below.
Note when David is on, he has those special 3 letters, the CMT designation, which just means that he's really done some study on the technical analysis side. And of course, your background, Fidelity Chart Room, that's one of the legends, right?
It's a really cool space dedicated to market history and investor psychology. And when I think about Bill O'Neill and his legacy, it's as a market historian. I mentioned before, I have the Bill O'Neill mouse pads somewhere in my office here that I've used for years and years. Okay. And I love just these like classic charts with notes and using the charts as a conversation you're having about these stocks and these markets. So O'Neill did an incredible job of really documenting historical successful charts and what makes a good company and a good investment. And the chart room, we were really trying to do that for our mutual funds and trying to help learn the lessons of market history, which I think even again today so many people could stand to learn a little bit about market history. Hopefully we'll do a little bit of that today.
Yeah, absolutely. And of course, one of the reasons why sometimes people shy away from that whole idea of the history is they kind of well things are different now. We're special. We don't make the mistakes that people made back then, or things are much faster. Our technology is better. We're smarter. All of those things. Do you find that to be the case necessarily?
Not at all. I totally get the argument, Justin, and you're right. I think the reality is human nature is pretty consistent. And I think if you look around you, people, even with all the tools we have, the devices we have, the connectivity we have, people still get super excited, super desperate, super nervous, super euphoric when conditions around them cause them to do so. And so I still see investors buying too early, buying too late, selling too early, selling too late, sort of those 4 cardinal sins. It still happens even with all the tools we have available. So I would argue, even though we have access to essentially unlimited information and incredible capabilities with AI and all the promise, we're still humans making human errors. And so I think, surrounding yourselves with resources and tools to help you minimize the impact of those negative decisions and just better understand the market environment, I think are more valuable in 2024 than ever before.
Yeah. And I think that's why a lot of us really like to lean on the technical analysis part of things, because especially, I'm just gonna say it. There's a lot of turmoil out there, right? The headlines, if you just read the paper, I feel like I would just want to be in a bunker and go in there with my canned goods. And the thought of sticking your neck out with investments would be a little distasteful. Certainly right now we've got hurricanes. We just celebrated a 1 year from the Hamas-Israeli conflict. We've got the election coming up, and let's not forget that even before the election, we've got another earnings season coming upon us very shortly. That's always fraught with peril as you kind of decide, wow, is it going to be one of those things where stocks react favorably, or is it the CFO coughs wrong and the stock tanks 10%? So again, how do you kind of manage your emotions when, again, you're seeing all these headlines that kind of can shift things?
And talk about a sign of the times, Justin. We didn't even, you mentioned all of those very real, very market moving macro themes. We didn't even talk about the Fed rate cut cycle, inflation. Like that's just down the list of this, this growing list of concerns. And to your point, I think if you focus too much on each of those items and what they could do, you'll go crazy thinking about all of these different possibilities. That's what I love about using charts and technical analysis consistently, is the whole point of it is the markets arguably are the best way to aggregate what everyone is thinking and worried about and concerned about and confident about. Price is a great reflection of that, because more buyers buyers than sellers, more sellers than buyers, all makes the price move. And so when investors get jittery or investors get really excited, the price tells you that very, very quickly. So I would encourage people to, the way that you look less subjectively and more objectively at the market dynamics is focus on trends, clearly define what you're seeing, and have an exit strategy, and then stop worrying about it, right? Think about, right, this is the trend I see. If I see X, Y, Z happen, that tells me it's something different. And until I see that, I'm going to just sort of follow what this is going. And trends continue to persist here in October of 2024. I think they'll keep persisting for quite some time.
Yeah. Well, let's you mentioned charts and how useful they are. So let's get to some. I'm going to go ahead and start with the NASDAQ composite, which is a lot of times where we've tended to start, but this has actually been kind of lagging. This is our relative strength line versus the S&P 500. And it did perk up a little bit here in September. But really since July, this has been in a downtrend. The NASDAQ just hasn't been holding up nearly as well as the S&P 500. The S&P 500 kind of met a lot of milestones before the NASDAQ did. It got to new high territory first. It crossed levels of resistance first. So do you think it's kind of the NASDAQ's time to shine? It's had its time in the corner thinking about what it's done, and it's time for it to get out of its time out?
Ready to come out of the penalty box and join the class? I mean, perhaps, right? And I think when you look back at 2024, there have been a couple clear leadership regimes that we've observed, right? Sort of Q1 was the Magnificent Seven dominating, right? The mega cap growth trade sort of dwarfing everything else. Then later into the spring, we got into more value sectors, right? Like industrials, materials, all of a sudden starting to look very good. Then in the third quarter, you had sort of a market pullback. That's where the NASDAQ's coming off, and all of a sudden defensive sectors, which have been sleeping for most of the year, all of a sudden all wake up, and REITs and consumer staples, Colgate, Palmolive kind of stocks are all of a sudden looking pretty good. Now I think it's a very open question in terms of what that next leadership theme is going to be. And I think a lot of that, to be honest with you, I think what will end up working is going to be a lot driven by elections, a lot driven by interest rates, a lot driven by some themes that I think we'll get more clarity on in the next month or so. But I am super encouraged by the improvement I'm seeing, particularly in technology. And it's leading names like a Palantir, right? Just kind of in these nice sort of steady uptrends. But it's kind of the other things, right? It's semiconductors, it's AMD and Nvidia that had been in a very consolidating kind of sideways pattern. And now we're all starting to feel like they're resolving to the upside. So I'm certainly seeing a lot to be impressed with technology, and not just, a name or two. I think more broadly speaking, you're starting to see that. So the performance gap, I would argue, between the S&P and the NASDAQ maybe starts to narrow a little bit here, certainly as we go on in the coming weeks.
Yeah. To your point, heading back over to the NASDAQ, I think an important kind of shift, as you were saying with that third quarter, was on July 11th. Of course, this was a CPI day, and as bad as the NASDAQ looked on that day, to your point, like the Russell 2000 on that day was skyrocketing, right? And it was short-lived, granted. The Russell 2000 gave you all of 2.5 weeks to participate in that move before it just tanked. But it's again, those very quick rotations. And it's worth mentioning, tomorrow we have a CPI report. I feel like people aren't as on edge, like, oh, I can't do anything because the CPI report is up or the PCE report is up, or pick your inflation gauge of choice. But with that 50 basis point cut now kind of starting the ball rolling, saying inflation is not as big a concern as the recession, labor market, and all those things. Do you think the CPI report holds the same level of import?
Yeah, worrying about inflation is so May, June of 2024, isn't it? It's old news. I mean, to be honest with you, I think, the Fed has certainly communicated, Powell and others have communicated that, sort of inflation is sort of doing what you'd want it to, according to how they're, the approach it and the levers that they pulled have sort of, slowed things down to a degree that it's sort of doing what you'd expect. And now they're focusing more on job creation and making sure that the jobs remain robust. I would argue that that's all fine and good, but a big change outside of the expectations of inflation, I think still has the opportunity to shock the markets in the short term, for sure. Only because I think at this point, again, with all the things going on around us in the world, the Fed's rate cut cycle, I still think is a hugely important theme going into the beginning of next year. And once we get through election season and once we get through hurricane season, hopefully, and get through that, this will still be a very real market moving scenario. And I think different types of stocks. I mean, the reason why defensive stocks are so attractive is because rates come down so quickly. And if that starts to change, all of a sudden utilities aren't as good of a bet as they were before. And so I think a lot of the leadership themes have been tied to interest rates and all of that. So I still think it's super important to watch the inflation data. What they've said certainly is jobs are more important as well. At the end of the day, I think the markets are what's most important to follow. So let's see how we trade going into it, but especially react to the numbers that are released. I think that's key.
Yeah, and before we get to the S&P 500, and I do promise we're getting there, I just want to kind of show the 10-year Treasury yield, because certainly, it was already kind of starting to move up. We did see, especially with the Fed funds futures, a big change in the expectations of, okay, we're looking at maybe another 50 basis point cut in November, and then the jobs report came out last Friday, and it was like, whoop, no, we're going the other way. It's 25 is still really on the table, but 50 is based. It was a 0% chance of no cut to now a 0% chance of a 50 basis cut, and a likelihood that there might be no cut. So the 10-year Treasury yield back above 4%. Normally, that's something that you would think that kind of move would really have an effect on markets. But I guess, what is it? The lack of recession fears subsiding. What's your take?
I mean, I think you're right. And I would say, with things like the 10-year yield, I think a lot of people probably spend too much time trying to pinpoint inflection points, and arguably, more broadly speaking, with stocks, with things like the S&P or with a key name, we spend so much time and energy trying to think about, was that the peak, was that the bottom, trying to pinpoint a particular move. And people that claim to have done so are super proud of, I called the top or I called the bottom. I would argue the game for most people is less about predicting a top or bottom to the day. It's recognizing when the trends have changed. And I think that's where a lot of investors are on the wrong side of things and then stay on the wrong side of things, right? Recognizing that rates have gone down with the 10-year yield from 5% down to 3.75%, huge change, right? And so ignoring the fact that rates were in an uptrend and now are very much not in an uptrend, I think that's the problem. That's what you want to avoid. You want to avoid missing the change in trajectory. And so I think the risk right now is that rates continue to go higher. I think a lot of groups like home builders, for example, all of a sudden seem like really decent bets because rates are coming down and things are becoming a lot less expensive. I think that's a really good bet. If rates continue to go much higher than this, though, I mean, is that really still the thesis anymore? And too often we sort of develop our thesis. It's called a narrative bias. You develop a narrative and then kind of that's your trade. And even if everything changes around you, you kind of still stick with that trade, regardless of the fact that the evidence is no longer supporting it. So recognizing inflection points in some of these areas and just recognizing when the trends have shifted, I think is super, super valuable. And I'm certainly watching the 10-year with that in mind.
Or, even worse, sometimes you do see the evidence that maybe your thesis is wrong and you just ignore it because
right?
I'll just keep on looking at the evidence that says that I'm right because that just makes me feel better as a human being. But let's go ahead and go over to the S&P 500. And as you mentioned, there were certainly a lot of areas where when the Magnificent Seven kind of took a break, when tech was kind of taking a break, you had the utilities, the industrials, the financials, you had all these other areas that were, they might not have been making the same types of moves that you would expect out of tech, but they were going up. And so the S&P 500 has been, looking really strong here. And all-time highs today, looking like it just kind of came out of this little thing. I mean, it got support right here, exactly where you'd want it, at the top of this previous base, or these previous areas of resistance. Didn't even come down. This is the green line is our 21-day exponential moving average line. Didn't even come down to that, and right back to all-time highs. It just doesn't want to go down.
It certainly seems the case, right? And from a technical perspective, I call that a pivot point, which is a level of resistance that then becomes support, and that is a well-trodden, path within technical analysis. Happens so often, and with individual stocks, you see that all the time, right? Like a big basing pattern, you break out, you test the breakout level, and then continue up. That's around 5650 on the S&P 500. For me, that's a really good kind of line in the sand. We mentioned earlier, how do you sort of stay sane with what's happening in the market at any given time? I do what's called a line in the sand approach. At least that's what I call it, which is define the trend. The trend in the S&P is up, right? We're making higher highs and higher lows. We're above upward sloping moving averages. That's all pretty constructive. We're above a trend line, using the major lows in August and September. That's all pretty constructive. So what would you need to see to start to question the fact that this trend is clearly going up? And for me, 5650 is a pretty decent starting point. It's pretty early, right? I mean, it wouldn't take long. That's a big down day for us to get below there, to be honest with you. But the other side of that is, as long as we remain above 5650, how concerned do I want to be about market downside? The answer is not a whole lot. I think you want to think of it like you're programming in Excel and think of it like an if-then statement. If we break 5650, then we have the possibility to do these other things. But I think a lot of times people all of a sudden are thinking too much about downside targets that are nowhere near really probable at this point. I'm happy assuming that the trend is innocent until proven guilty. 5650 is kind of that breakout level where I think you start to question it, and at the very least start to think about money management and make sure you have stops that are updated and make sure you're limiting your losses. That's how you survive to invest for the next cycle.
Any kind of final thoughts on the market in general before we kind of get into our next segment?
I mean, I think that, to be honest with you, the only other space we haven't really talked about sort of precious metals and commodities. I mean, obviously there's a lot of noise in crude oil related to events in the Middle East, understandably so. But I think, when you look, we talk about the NASDAQ, we talk about the S&P, hold the phone, because gold has outperformed both of those year to date, right? And by a decent amount. So I think, gold feels very overextended when you look at the trend over time. And you're seeing a bit of a pullback in gold and silver prices this week. But again, similar to what you saw with the S&P, as long as we keep making a pattern of higher highs and higher lows, as long as we remain above trendline support, as long as we remain above key moving averages, I think the charts are pretty strong. And for now, I would argue gold is still sort of in a primary uptrend, but I'm acutely aware of what levels I would need to reconsider something like the GLD or the GDX here.
Well, since you opened the can of worms, now I have to ask a follow up, because
do it.
You brought up so many commodities. It's worth bringing up the strength of the dollar. So this is UUP that tracks the dollar, and you're seeing kind of a surge here. Of course, that has a negative correlation. It often puts pressure on commodity prices. So what are your thoughts on the strength of the dollar and how that affects other things?
Yeah. And so as this trade in gold has continued to work, and I've shared a number of times over the year, I've shared a chart just looking at the performance, year-to-date performance of the GLD, the SPY, the QQQ. And pretty much anytime I've done it, gold's been at the top of that list. I mean, consistently through a lot of these different cycles. And it was more just did you know, like, are you recognizing the strength you're seeing? It's a reminder that regardless of what we think should be working, right? Gold's a safe haven, it shouldn't be doing well. It is. Now, when I've been asked, well, what's the risk to that? It's the dollar, right? Because the dollar has been in such a good, consistent downtrend for so long, that sort of provides this boost to gold prices, because the dollar's a big sort of, that's the opposite trend trend. So the spike in the dollar has been a part of that immediate pullback in gold. So I think the biggest risk to the precious metals charts looking as strong as they have year to date is a rally in the dollar. And then you've started to see the beginning of that. I think the dollar continues to go further, and certainly the dollar seemed to have bounced off of the key support level right around 100 for the dollar index, sort of bounced off from there. And if the dollar really continues to strengthen in a more meaningful way, that's when I think you need to think about, all right, what does that mean for multinational companies that have a lot of their revenues outside the US and have to at some point convert them back to US dollars? It's not sort of in the danger zone of that, but that's what I think you start to think when you have an equity portfolio and just thinking about where a strong dollar regime could change the thesis that's worked maybe in some cases for some of those charts.
Yeah, it definitely gets interesting during earnings season because you start hearing the complaints about, well, it's not fair because the strong dollar, is what caused all of these our numbers to not look so good. And
that's right.
Especially with those multinationals. So okay, let's go ahead and shift gears a little bit and talk, because you mentioned it earlier. A lot of times people want to be on the hill saying, look, I'm the one that kind of called it right at the top. And they're looking at all these different indicators to suggest, oh, things are getting tired. Or and I mean, there's a whole host of technical indicators, sentiment indicators. Are there any that you gravitate towards to kind of tell you, not necessarily that you're at the top, but hey, it's a caution flag. It's something to be aware of, that we're in an environment that you might want to start looking at locking in some gains, or at least being ready to go on defense.
Yeah, for sure. So I think of my role. I mean, I consider myself a trend follower primarily. So my goal is threefold any given day. One is identify trends. Second is to follow those trends and assume that they will persist and make sure that I'm following the continuation of that trend. And then the third one, which is what you're alluding to, is anticipating when that trend might be over. And this is the part of the technical toolkit that I would argue is more of a leading indicator, a set of leading indicators. A lot of the technical analysis toolkit is very much a trend following approach, right? I'm looking for moving averages that are sloping upwards. I'm looking for relative strength to start improving. And all of those tend to happen after the price has already started to make progress. But there's also parts of the technical toolkit looking at divergences, looking at weakness in some metric that would tell you that even though the price is looking good, underneath the hood of the market, right, or looking at the details behind there, you start to see a disagreement. And those disagreements often have a great predictive value because before the price tops, I mean, as the price is still going up, the conditions start to deteriorate. And it happens pretty common. And market breadth indicators are the best way I know to think about it, because especially at major market tops, in the later stages of that bull market phase, a lot of things actually are no longer going up. They're no longer driving higher, but the indexes keep going up because of the biggest, in a lot of ways, more defensive kind of blue chip names are strong enough to propel the index higher, even though a lot of names rotate lower. So a lot of measures of market breadth are really designed to help you recognize when that disagreement is starting to come out. And arguably, we're maybe starting to see that here in 2024.
Okay, well, let's maybe start a little bit more historically. You brought some charts. These are from stockcharts.com with some of these indicators that you have in terms of whether it's the looking at the percentage of stocks above their 50-day moving average lines and so on. But yeah, let's go ahead and start with our first chart. And this goes back to 2007. Of course, in 2007, as frothy as it was, no one was thinking, oh, we're probably looking at a great financial crisis next year where everything is going to grind to a halt. It's never, you never know how bad things can get. You just kind of know, oh, things are starting to turn possibly. So so kind of explain, we got the price on the top here in this chart, and then you've got a few different things that you're looking at below. So can you describe those for us?
Yeah, so I'm looking at the 2007 market top really as more of a case study in what a major peak kind of looks like. And to your point, right? I mean, at that peak, which I've shaded in a purple shading area there at the top. I mean, at the top, it's really hard to recognize that that's a top, right? In the rearview mirror, it seems really obvious that okay, a lot of frothiness was happening, and as things unwind, you recognize the forces that were at work there. But at the time, the market was going up, so we basically have the S&P 500 at the top, looking at that period going into and then coming out of that 2007 peak, and then we have three indicators top to bottom below there. The first one's called the McClellan oscillator, and this is a way of analyzing advanced decline data, right? On an average day, you have the advanced decliners, how many stocks are up, how many stocks are down. Tom McClellan's parents, Sherman and Marion McClellan, decades ago, came up with this oscillator, kind of turning it into a momentum indicator measuring the changes in breadth conditions. If it's above zero, it's bullish. If it's below zero, it's bearish. That is a very simple way of thinking of that measure of breadth. The next panel down is looking at, well, what am I looking at there? Oh, percent of stocks above their 50-day moving average. So this is, while the S&P is above its 50-day moving average, and I think that's an encouraging sign, you look at all 500 stocks in the S&P, how many of them can stay the same? And when that gets above 70%, we're in a kind of a euphoric level. When we come out of that 70% level, it can tell you that things are maybe starting to change. And then in the bottom, in the green and red histogram there, that's showing you every day the new 52-week highs and the new 52-week lows. So it's literally counting how many stocks are breaking out, how many stocks are breaking down on any given day. So if you look at the performance going into that purple shaded area, which again ended up being the 2000 market top, what were the breadth conditions going into there? We had the McClellan oscillator above zero, and it remained above zero for quite some time, right? 4 or 5 weeks, just showing you that the short-term breadth was very strong. The advanced decline data was improving. We had all of a sudden over 70% of the S&P 500 members above their 50-day moving average, which means kind of almost everything is in a primary uptrend at that point. And you have a bunch of new 52-week highs, meaning those leading names are kind of getting it done, and you have very few stocks making new 52-week lows. Look at how that changed as we get toward the end of that purple shaded area for the S&P 500. You can see everything I just said was no longer the case. So the McClellan oscillator breaks below zero, which tells you the short-term breadth is starting to change to more bearish advanced or decline data. Stocks are trading lower on on an average day. Instead of over 70% of stocks above their 50-day, we have less. We have 60, we have 50, we have even 40. So a lot of individual names are breaking well below their 50-day moving average, even though the S&P is still above it. Then finally, we have less and less stocks making new 52-week highs. So the green histogram is sloping downwards. So that suggests that those leading names that have been driving the S&P up, there are less and less that can say that, right? There are less and less that are going higher. So without looking at a bunch of, hundreds of individual charts of stocks, you can see from the breadth data that the breadth conditions were slowing down, that stocks were breaking their 50-day or their 10-week moving average, and that the new 52-week highs were becoming less and less. And you can see what happened in the months after that is everything just started to get worse and worse. You had a bunch of stocks making new 52-week lows. And so recognizing when the market is making a peak, I immediately glance down on a chart like this and just see, is the breadth data supporting it? And then when am I seeing the breadth data no longer supporting that uptrend and off? And that can be a major top. And that's how 2007 actually, the reasons for it came clear later, but I think the technical reasons using market breadth were pretty clear actually.
Yeah. Well, you know what? It's interesting that you mentioned that because I remember that time period. It was I'll be honest, 2007 was not a great year for me. It was a lot of slop until August, and September and October were phenomenal. Like all the money was made there. And, if it's okay, I'm going to change charts real quick. I did a change date to that time period. And it's interesting because a lot of those areas that you mentioned, where it started to break down, it was right in the middle of October, where you started getting the McClellan oscillator. And I remember this day right here on October 11th, 2007, a big downside reversal. It was like, oh, okay, this might be the warning sign. Yeah. And I'll be honest, what happened to me though is, we kind of went sideways for a little bit. And then I remember this vividly, Halloween, it was, oh, we're breaking out into new highs. We had gotten all this distribution. We broke out to new highs and it was like, oh, maybe this is okay. And it was kind of like, I got to get back in. And then, exactly as you mentioned, it was, things really started breaking down in a big way, very quickly. I mean, I remember this day, November. Yeah, I thought it was November 4th, but, yeah, maybe it was the 8th or something. I mean, I had VMware and, the IPO VMware. And, I think Crocs, was one of the big winners at that time. It had this, horrible earnings reaction on the 1st of November. And it was just November. There was just nothing good could happen. It was everything was breaking down. So really interesting that, again, those breadth indicators kind of got you in that environment. And the S&P 500 was not as ugly looking as the NASDAQ, but it certainly it certainly had some issues. And
it's worth noting that, by the way, that end of October on Halloween, the NASDAQ was making a new high, but the S&P actually was not. That was actually a really interesting non-confirmation, which with one of the benchmarks breaking out, the other one actually made a lower. The S&P made a lower peak at the end of October. Yeah.
Right. Yeah. So a really good example here. So let's go ahead and go back to your charts real quick. And you've got another example to kind of show us. So
the next one that comes to mind would be the 2020 peak. And before you go, telling your friends, Dave is claiming he predicted COVID with charts. That's not what I'm claiming here. But what I am claiming is that what ended up being the peak, the deterioration had already started to happen. And again, what the lesson here is the breadth divergence, right? The breadth indicators breaking down often happens as we're making a new high, which is why it's so counterintuitive. So if you're not paying attention to sort of the metrics underneath the market, you see the S&P and NASDAQ making a new all-time high. You think this is awesome. New highs are good. One of my mentors, Greg Morris, used to tell me all new highs are bullish except the last one. And so I think using tools like this to recognize, okay, new high, that's great. I immediately glance down and say, all right, are more and more stocks really participating? And what happened at the 2020 market peak? And again, a lot happened after the shaded area where COVID became a reality and we all sort of struggled with it. But the breadth conditions had really started to deteriorate, right? So again, the McClellan oscillator breaks below zero, telling you the short-term breadth is getting weaker. You can see all of those breadth indicators are trending lower while the S&P is making a new high into the February peak, and particularly the new 52-week high. So even though the S&P made a new high in February, less stocks were making new 52-week highs during that period. So again, there's a cohort of leading names doing quite well. The next new high, less stocks are participating, and that divergence, not to jump to the punchline of what we're seeing now, that's one of the things that concerns me now in October of 2024 is you're seeing that same trend where there are less and less new 52-week highs as we're starting to make new highs now, particularly in the last couple of weeks, kind of from mid-September now to early October. You're seeing the S&P break out. You're seeing the McClellan oscillator break below zero. We're seeing the percent of stocks above the 50-day. It's literally right at that level as we're doing the podcast here. Yesterday was below, today slightly above it. It's right at that 70% threshold. And the stocks making new 52-week highs have been trending lower. So again, on this week as we're breaking out, less stocks are participating. So the breadth divergence is what concerns me in a market like we're seeing now. And again, what this little history lesson tells you is that's what a lot of market peaks have kind of looked like, that divergence. The saving grace, I would argue, is something we saw back in like January, February of this year, where breadth conditions were a little negative, but the Magnificent Seven stocks were so strong that despite the weaker breadth, the benchmarks were able to remain quite strong. And that is a brutal environment for stock pickers. It's a brutal environment for active money managers who are trying to pick stocks outside of the Magnificent Seven. Because if those are what's working and other things are not participating, it's really hard to outperform unless you just layer into those mega cap names. And I think that's the risk for the market here is a lot of stocks maybe start to not work, but the benchmarks remain strong enough that it's a really tough environment to outperform. That's a risk here for sure.
Yeah. And I mean, that's where a lot of the closet indexers come from. I mean, they're almost being, why stick your neck out? No one's going to fire you for buying Microsoft or Apple or, one of those things where it's kind of the safe bet versus, going out on a limb, not having enough, especially compared to the indexes. Well, and to that point, you mentioned how a lot of times in the past, this breadth indicator was kind of reflective of the fact that maybe some of the defensive names, the big defensive names, were what were kind of propping things up. But now, I mean, are Microsoft, Google, and Apple the defensive names now? I mean, it certainly seemed like it for a while there, because especially as rates were going up so much, it was kind of like, well, these guys are sitting on all sorts of cash. Higher rates don't affect them because, they don't need to borrow. They're just in a position of strength. But is the Magnificent Seven defense now?
It's interesting because the Magnificent Seven names, not all of them. I mean, I'm ignoring Tesla when I say this group now. So this group of mega cap leadership names show a lot of
$1 club.
Yes, right. They show a lot of the characteristics of mature companies, but a lot of the characteristics of growth, right? And when AI is one of your big growth engines, I mean, you're certainly more of a growthy name at this point. But again, I mean, these are more established companies that are sort of immune to market dislocation. I'm still going to use my iPhone, and I'm probably going to still buy another one when it's time, regardless of what's kind of happening overall. Whereas some of the more speculative emerging growth names probably have a little tougher go with things. So I think they're a little bit of both. And if you ask, right, if you're concerned about the market going down here, where do you go? I traditionally would say defensive sectors, right? Utilities, which have been pretty decent recently, and tend to be good low volatility ways of making it through. But I mean, Meta, Apple, Invideo, I mean, these are pretty stable companies that certainly are tied into emerging themes. The other thing to think about is more of as a long-term, as a long-term investor, and really thinking about what themes are emerging that are probably going to be successful years later, right? What things do we see ourselves, what products and stuff do we see ourselves using down the road quite a bit? Electric vehicles and the growth in that area of the market. I think undeniably the reality that we'll be experiencing AI and related technologies, blockchain technologies. I mean, I think over time, those will be quite well. So those big, stable tech and communications names that will benefit from those themes working seem like a safe place to be.
Well, and interestingly enough, a lot of times we've been talking about, you mentioned the utilities, and this is, again, what you typically think of as the boring, okay, this is what you give the widows and the orphans, so they can get their dividend and everything like that. But it kind of almost turned into this AI adjacent. I mean, one of the stocks I ended up selling today, because Constellation Energy, came in quite hard, but this beat Nvidia. I mean, I think it was the top, between this and VST, Vistra, I think these were, the top, stocks in the S&P 500. They're utilities. What, like how do you have a utility topping I mean, usually if that happens, it's because the S&P 500 has gone down and the utility didn't go down as much. That's don't typically get a utility being top of the S&P 500 when it's going to new highs. So again, is there something different going on? And again, people always love to say it's different this time, but is there something different going on? I mean,
and you're right. I think the traditional idea is thinking of utilities as sort of that low volatility defensive play, because if the markets are going to go down, I mean, the reality of active managers, money managers, is you tend to do much better in bear markets because you can get in defensive things that will not go down as much. And that's where you really earn your keep. You cushion from a lot of downside. Utilities, in a lot of ways, if you covered up the ticker of CEG or something and asked someone to guess what it is, I guarantee they would not say a utility stock. They'd say technology or like a biotech or, some more growth area of the market. I read something, and I forget who, I can't credit where I saw this, but it was looking at the utility company earnings calls, sort of the multi-utilities in like Q1 to Q2 to Q3, kind of going through the month, and the number of times crypto and the energy requirements of crypto mining, and it was like mentioned 0 times the first quarter, and then almost all of them it was mentioned the second time. So that is certainly, I think, part of this is the energy requirements of crypto mining and other related technologies.
Well, and AI too.
And AI as well, right? I mean, they all require a staggering amount of computing power. That all requires a lot of energy. And so all of a sudden, utilities are a growth trade. What I love about it, and what I love about what's happened with utilities, the charts told you that these are good places to be, right? And I always tell people the reasons why something works are crystal clear in the rearview mirror. So you don't have to know why CEG is necessarily a great call. The chart tells you this is a good place to be, and it tells you it's outperforming. And so if you thought the markets were going to go up, so I definitely don't want to own gold and utilities in 2024, talk about the wrong call, right? Because those are some of the strongest places. So for me, the lesson learned is focus less on what you think should happen, although that's an important thought process to go through. But don't forget the benefits of recognizing that the trends will tell you something that you'll learn the reality of much later, right? It'll make sense down the road when they write a book about 2024, but don't miss an emerging trend just because it doesn't make sense to you at that particular time.
Yeah, that's so important. I mean, I feel like there have been so many cases where, I kind of joke. There was a show, Early Edition. I don't know if you remember that. Where the guy gets, he gets the paper,
before
and
it happens.
But a day ahead of time, and there's a cat involved, and we never know what the cat's issue is, why the cat's there. But yeah, he gets the paper, and he does good with it. He's trying to save people and everything like that. But I kind of think you would think that with that information it would be invaluable. But I sometimes say, well, gosh, man, if you had given me the headline, I would have done the exact wrong thing. I mean, COVID. When COVID was happening, to your point, everything looked like it was falling apart. But yet in April, we kind of had a follow through day. And yes, in the rearview mirror, it's like, oh, well, obviously the stimulus and, everything that the Fed was doing and, how much they increased their balance sheet. Yeah, obviously when you have that much money sloshing around. But at the time, if you just look at the headlines, no one was talking about, oh, look at what's going to happen a year from now in the market because of, what the Fed is doing. It was, oh my gosh, the sky is falling. So yeah, very good.
In my institutional days, we would call that, you got the market call right, but you didn't get paid for it. And it was like your gravestone as an analyst would be, got the call right. And it's like, what does that really get you, right? Because you're paid to outperform, you're paid to own things that are doing better than other things. And so getting the call right, getting the idea, recognizing a theme that's emerging, like that feels good, but you get paid by owning things that benefit from that. And a lot of times that can be very difficult to gauge at the beginning. But again, I think recognizing when the charts start to evolve, that tells you something's happening. And as we go on, we'll realize what that story is and we'll make sense of it. But don't miss an opportunity just because you can't get your head around exactly what's going to create the value. And again, I think what's great about price action is it usually tells you what's working, and it's always right. The market's not wrong because the price is reflective of where things are headed. So when in doubt, follow the trends.
So to kind of just wrap a little bow on this, because I want to make sure we are a little bit clear for our listeners, because when you're showing those breadth indicators, it's almost like, watch out. Especially, frankly, I mean, you showed 2007 and 2020, which were both some really.
And to be clear, I think the header on that last one should be 2024 market top question mark, right? The question mark maybe should be there. To be determined, right? Right.
To be determined, because again, in our first segment, we were talking about how great everything looks and the trend is up, and this kind of goes against that. So what is it that tells you that, oh, maybe this breadth thing was telling you something important that you need to watch, or is it like, this time it's more like January where breadth didn't matter, it was the indexes kept going up?
No, that's a really thoughtful question, Justin. I think that's the reality, right? With the 2007 top and the 2020 top, what happened after those breadth conditions changing is really the most important part, which is you then started to see the price trend finally move in line with what the expectations would be, right? And then, as I mentioned, a lot of these breadth divergences, when breadth starts to rotate lower, even as the indexes are going higher, that's a leading indicator. For me, I want to look for confirmation, or what I would consider follow through, right? So after the peak, you start to see the price break down through those lines in the sand. We mentioned, like with the S&P now, 5650 is a line in the maybe line in the sand, maybe the 50-day moving average or whatever it is. So as long as we hold that, producer, I'm like, well done, that was awesome. Delivering with the question mark. Thank you for that, just to save myself here. So I think that, still to be determined, but I think what this tells me is, okay, there's now an elevated risk of deterioration in price because these conditions look very similar to previous market tops. Now the proof is going to be in price reacting in a negative way. So starting to be unable to hold support, pulling back, and instead of making a higher low, you see further deterioration. The breadth conditions continue to deteriorate. We see less and less new 52-week highs, but you start to see more 52-week lows, which those other two peaks, all of a sudden you set a bunch of like leading names to the downside that had already deteriorated quite a bit. We're not seeing any of that yet here in October, but I think that's what you look for now, is you look for confirmation that, yep, the breadth conditions really were a good identifier of negative conditions. The price is now reflecting what I was concerned about.
Yeah, very good. Let's go ahead and shift gears to some stocks. Again, just to be clear, again, you're still looking at the trend. The trend is up, and there do still seem to be a lot of stocks that are setting up. Any particular areas of interest? And we're flying blind here because we didn't get a chance to talk about this ahead of time. So
there's no telling what I'll throw at you.
Exactly. What do you got?
I mean, I'll start very simple with PLTR. I think Palantir is a great representative of the emerging strength that we've seen in technology. While some areas of technology have not been particularly strong, what I like about this chart is if you covered up the ticker and if you didn't know what was happening in the world around you and all of these concerning macro themes, this is a chart that's working and it's continuing to outperform. It's setting resistance levels and then breaking out. I mean, it's a classic kind of Charles Dow uptrend of higher highs and higher lows. And the fact that charts like this exist remind me of reading IBD back in the day as a print daily thing that I'd buy at the newsstand. And no matter what was happening in the world, there were always charts that kind of looked like that ideal chart. Like they were just out there. You had to find them. And so I think charts like this deserve to be, again, considered innocent until proven guilty. I like the fact that the trend has been quite positive. Upward sloping moving averages, the improvement in relative strength is what I appreciate the most. So charts like this, I build a portfolio around charts like this and feel very happy with that general approach.
Yeah. Now I'll be honest. This is one that I've tried a few times, and it seemed like it was, it moves on earnings and then it doesn't do anything. It moves on earnings and then it doesn't do anything. This last time, it almost looked, I mean, it was just a really wild reaction. And then this is the time that it kind of almost reminds me sometimes of how you can't treat stocks like people just because, you get stood up on a date, sometimes you got to, try and try again.
And I always remind people that, I mean, literally, I mean, if you can't do this mentally, literally like get out of your chair and take a couple steps back from your monitor and don't get so caught up in the short-term movements, right? Stocks will be noisy and day-to-day price action is noisy. So what I like to do is literally take a step back, think about what the trend, my 8-year-old son, Henry, I always think, what would Henry say? If I asked him, is this chart going up or down? That's a Henry bull chart, right? Henry's going to say that's going up. And so that's, for me, that's what you want to remember. Don't get too drawn into the brief pullbacks, which will happen in any good market. Some of the biggest down days are going to happen during a nice uptrend, but they're just, corrective moves within a larger upward trend. And I think PLTR is still showing those signs.
Well, now one other thing that does make PLTR a little bit harder is the moves day to day. So it's easy enough to say, David, just step back and don't worry about the day to day. But some of these day to day are, 5%, 7% moves in a day.
Yes.
How do you handle that if you're doing a 7% stop loss and that's just a day that ends in Y for Palantir? How do you manage your risk?
No, I think that's a challenge, right? And I think that the reality is volatility certainly feels like it's increasing, not just with Palantir, but with a lot of things. Right? I mean, the VIX is above 20 again. You're certainly seeing, that sort of slow and steady bull phase doesn't necessarily seem to be what we're experiencing now. This is more of a high volatility environment again. So the idea that a chart like Palantir isn't going to have significant drawdowns, I think you're kidding yourself if that's a reality. There's always that balance, right, between having a good stop that makes sure you lock in, you minimize any sort of significant downdraft, but also keep plugged in enough and make sure that you remain engaged as the trend goes higher. For me, a percent stop is a good starting point. I like to move to things more based on like an average true range, a little more dynamic. And with something like PLTR, you probably want to give yourself a little more room for those sorts of things. And with a lower volatility name, you tighten it up a little bit. And then the other thing is, remember, risk management is not just, what's that?
I was just going to say, the good news is using an ATR, it kind of does that for you, right? If you're like, oh, I'm going to multiply the ATR by X, it kind of does that.
The noisier the chart, the wider your stop is going to be because it's adjusting for that volatility. And so I think that's a good way to think of it. And also just remember, I mean, there are different ways to manage risk. I think stops are one of those. Thinking of position sizing and just how aggressive you want to be with that. So maybe you keep your position size down so that you're not overexposed to the noise in a PLTR. I think those are levers investors can pull. They probably don't recognize how much power they have to ratchet the risk up or down if you're concerned about volatility. There's a lot of options.
Yeah. Okay. So next chart. What else you got for us?
Yeah, Comcast is another one I'd highlight. CMCSA. And again, I'm looking at these mainly from a technical perspective, but I think particularly, if you look at what's happened most recently, Comcast back above the 200-day moving average. We just made a higher low here potentially in the last week. Maybe emerging from this kind of rounded bottoming type of pattern. It's not my ideal chart. My ideal chart is a nice strong uptrend, but with a lot of those charts like a Palantir, in some ways maybe overextended because they've already had a really good run. Comcast strikes me as one that's a little earlier on in the uptrend, so maybe just emerging from a base. Again, given the uncertainty, given the choppiness in the world right now, I think keeping stops relatively tight, on average, isn't a bad idea. But I like that improvement that I'm seeing at least in the last quarter. Comcast was an absolute nightmare of a chart through the middle of the year, and then that double bottom when you had a low in April, a low in June, and then we start to improve from there. I think is pretty encouraging. So overall, I think for now, worth the benefit of the doubt until proven otherwise.
And it's worth noting that Comcast has a dividend. So I mean, that's 3% dividend yield there. Now, again, one of the things that are you kind of going for a rotation in this case? Because the relative strength, of course, has been dismal. Anything below its 200-day moving average line recently is probably taken a hit in that regard. So when you're kind of doing these bottoming bases, what kind of different strategies do you use as opposed to really breakout?
Yeah, and I would say from a high level, I think part of this is an exercise in diversification. We think of diversification traditionally as asset allocation and being diversified in different ideas and stuff. For me, I think of technical diversification as if you own a bunch of stocks and their charts all look identical, you're probably playing a similar theme that is connecting those names, right? And so the danger with that is your entire portfolio is working, and then most likely your entire portfolio starts to struggle right around the same time. That's not guaranteed, but there's a danger. So I would often look with a money manager and just think, okay, hold on, do we own too much? Are we doing an unintended bet that this theme is really starting to work? So I'm always thinking, all right, if I own a chart like Palantir, what other stocks are starting to improve, maybe a little earlier on in the rotation, maybe still having some to prove, but would probably be a very differentiated return profile from the first one. And so I think that's one way to think of more bottom fishing candidates, is just thinking of how that actually diversifies your exposure to particular themes. I think with something like Comcast in particular, with a more established trend, you're basically betting on what has been happening to kind of continue. And so you just want more of the same. You want the status quo. You want higher highs, higher lows. Even if they're noisy, you want them to sort of remain in a constructive way. With something like Comcast, it's sort of an emerging idea. So it's more about, can we clear resistance? Can we hold that resistance level? Like with the S&P, right? Hitting 5650 a couple times, breaking above it, and then does that now hold? And so seeing those early tests of a new uptrend and seeing if something like Comcast checks those boxes, and if not, then move on to other things. Justin Mamus, famous technical analyst and investor, famously said, if stock doesn't do what you expect it to, sell it. And what I think he was implying by that is you have an idea of why you're betting on this trend, on what the chart would probably look like. If it does something dramatically different than you'd expect in a negative way, like get out of the way and find another idea that is emerging again. I think that's one of the benefits you have as an equity investor. Just a lot of levers you could pull, a lot of ideas.
And just one thing I'm going to kind of mention in favor of Comcast is the telecom services. This is Comcast is in telecom services, cable, satellite. But if you look at the industry group ranks, I mean, for telecom services, there are a number that have been doing pretty well in their relative strength over 6 months. So you've got the foreign is in 57, cable satellite 71, integrated at 37, wireless at 28, and cable satellite equipment at number 11, consumer products at 21, fiber optics at 5, infrastructure number 1. So telecom has been kind of, not everything. You can see it's kind of widely dispersed, but there's a number of groups in that sector that have been improving quite dramatically lately.
For sure, and arguably the old telecoms or the communication source like AT&T comes to mind, right, as a great example of strong price action, great dividend. I mean, one of the better dividends that you see in a stable company. What's good about a chart like AT&T, if you're concerned about rates going back lower, if you're concerned about lower rates, meaning bonds are not a particularly good place to be anymore, something like this with a decent dividend is a good way to play it. Lower volatility, good price action with good income means it's probably a good defensive play if you do see any deterioration. So thinking about some of these areas of the market that have been strong, but also have kind of those qualities of defensive names can be a good way to sort of mitigate downside risk in the markets.
Yeah, and it's worth mentioning the yield on AT&T is 5%, over 5%, and I mean, this is a strong looking chart, and that's not even considering the yield in there. So if you
that's just the price,
that's just the price. So one more chart for you. We can get through quickly, or
VFC.
VFC.
Yeah, VFC probably looks like what I hope Comcast would look like. Right? Sort of, think about Comcast, right? It's sort of like that basing pattern, that bottoming pattern, but still with a lot to prove. I would argue like a VFC is one that has shown what can happen coming out of these bases, and I don't think it's necessarily too late to be participating in a chart like this. But I would say what this is a great example of is what bottom fishing, how that can benefit. Even if the market conditions are quite strong, looking for stocks that have been in a downtrend and then what I call is a change of character, right? If you look at the right kind of quarter of that chart versus the left 3/4, something's obviously very different. And I think, every technical reason why it was a horrible place to be in April and May, from a technical perspective, has now changed because we've, in a confirmed downtrend below downward sloping moving averages to a confirmed uptrend above upward sloping moving averages, right? We're making new swing highs. We're making progress on the way up. And the other thing I would say is the price momentum is improving, right? So overall, you're seeing stronger up days, and so for me, I think that's a great sort of example of what, when you're looking at a chart like Comcast, if it feels too early, this is what you want it to develop into. And I'm impressed by names like this that had been chronic underperformers, really starting to maybe emerge in a new leadership role.
Do fundamentals come into play at all? Because they're not great here.
They're horrible. So no, arguably no. So this one is not a fundamental play. This is purely a technical. The charts are telling me to think of it differently. Thinking holistically, I think that's the challenge for a name like this. Is you're buying into a name where the numbers are not particularly strong here. So what I was always taught is that the stocks eventually trade their fundamentals. So you really, if you're buying it, you're betting on that picture improving down the road over time. For now, it's telling you something is different and something's improving, and that's why I think it's interesting here.
Yeah. Well, David, it's always a pleasure to have you on, and it's always a great conversation. So on Twitter, folks can follow you there, or I should say X. That's at DKellerCMT, right? You had to get those 3 letters in there, right?
That's right.
Yeah. And then your website, again, Sierra Alpha is your new venture that you're doing. You've got the market misbehavior website, so that's just marketmisbehavior.com, right?
Yeah.
And anywhere else that people should be looking? Of course, YouTube. You've got a lot of content on YouTube.
Yeah, I've got an active YouTube channel, getting more and more active. So hopefully at some point, Justin, I can get you to call into my podcast, and we'll trade a favor if you're up for it. That'd be blast.
Yeah. As long as I don't have to go up to Seattle in the rain.
Well, I won't subject you to Seattle until next spring. Okay, this is the
perfect.
Where you don't.
I love Seattle. I love Seattle.
Seattle in the middle of the summer months are where you're going to enjoy Seattle a lot more than the rainy period we're embarking on. But no, yeah, marketmisbehavior.com is my website. My YouTube channel has the same name, and I'll look forward to engaging with anyone and everyone on those places.
Yeah, well, thanks a lot for showing up today, and I really appreciate your insights. Again, the technical action, no one better to kind of walk us through it. So thanks a lot, David.
Appreciate it, Justin, and thanks, Mike, for your help getting this going.
This is according to research from our next guest, Tavi Costa, portfolio manager of Capcut Capital, who believes that we may be heading into a renewed inflationary period, which may boost commodity prices. We'll be talking about the investment implications of his research findings. Welcome back to the show, Tavi.
David, thanks for having me. Looking forward to this.
I'll be starting off by asking you a very broad question. Did the Fed make a mistake with 50 basis points, which is what they did in September, a 50 basis point cut? We spoke before September. Did they make a mistake?
Yeah, it's not that I'm trying to avoid answering the question, but I'm not sure they had an option. And from my understanding of looking at the government itself and how much interest payments is going towards, especially relative to GDP, close to 5% now, compared to other economies. We used to say, well, the dollar is the cleanest of all dirty shirts. But then looking back now and saying, well, look at Germany and Japan spending 0.5% or less than 1% of their GDP on interest payments. And most of the other developed economies, needless to say that the emerging markets are also spending way less than the US. That gives the government, or I should say the Federal Reserve, a sense of urgency to reduce rates much more than other economies. And that has to have an impact on the dollar itself. So I'm not sure that the Fed really had an option. A lot of people are seeing this as, look, I think the Fed has reduced rates before really accomplishing, the end of an inflation problem. I don't disagree. I don't think there's an end of the inflation problem, but I also don't, I think that saying that is also missing the fact that, if you were in their position, you would have to do the same. You don't have an option here. Would you keep rates at 5.5% and create a major burden for the government when you know that basically majority of the growth that we've had, particularly from a valuation differential of companies in the US versus the rest of the world, is mostly attached to the fact that we're able to spend more money fiscally than other countries, then you start reconsidering all these things. And so if you work under the assumption that the Fed is trapped and the Fed has to lower rates regardless of what's happening, then you can kind of come up with a lot of potential investment ideas or investment thesis that are likely to unfold, given an environment where suppression of rates is inevitable, in my view.
Suppression of rates is inevitable. So interest rates are going to come down. We're going to talk about that in just a minute. That feeds into the next 2 charts that I want to show. This is from your recent investment newsletter here from Capcut Capital. Very, very good resource, by the way, for investors. Check out CapcutCapital.com. Link below. Global money supply has been going up according to this chart that you put together. Data from Bloomberg. It looks like global money supply versus US CPI correlation there. That makes sense. Let's put these 2 charts together. What is the story here that these tell?
Well, money supply, by the way, this is prior to any, I put this chart out prior to anything that came out of China from a stimulative standpoint and the bazooka that came out, which only adds to that. But that puts into perspective that the level of growth we're seeing, which is about 7% on a year-over-year basis, or $7 trillion, because the money supply is about 100+ billion. We're talking almost as much as we're kind of in the same trajectory that we saw coming out of the pandemic. And really, there's not much going on right now compared to what was happening at that time. And so when you think about this, it's not coming just the US, it's really globally. China, not as much part of this as you would think, and China may even add tremendously to this data. But the charted CPI with money supply, I think the answer to that is, those friends that we all have that say money printing doesn't create inflation, that's the person you want to share this chart with. And I'm not trying to be, hopefully rude or anything like that, but a lot of people like to get into the technicality of what money printing really means, the expansion of money supply. I mean, it doesn't really change the picture. The money is being diluted in a large way, and that has to have an impact on CPI, particularly when you have, this level of monetary stimulus along with fiscal, which has been something that combination of the two is incredibly inflationary. I'm extremely concerned because back in 2021 and 2020, when we came out of the pandemic and we've had all these stimulative packages coming out of most developed economies, even emerging markets did the same, and all the money creation that we've had, we didn't see the dollar actually depreciate relative to other fiat currencies. And so that to the US economy, just looking at the US economy alone, that was actually a positive factor that helped not to make the inflation issue even worse. This time, I am very, I remember in 2021, I came out very strongly saying, I think 10-year yields are going to go a lot higher. I'm still of that view. I still think 10-year yields could go a lot higher. I think the suppression of rates is happening on the short end. You just want to be clear of that. It's the Fed funds rate, 2-year yields, and so forth. The T-bills, they're all going to be suppressed in a big way, in my view. Now, the big trend that I'm paying attention is not necessarily on the interest rate side of it, but it's the impact of that on the dollar. I think the dollar is extremely mispriced. We've had a big appreciation of the dollar versus other fiat currencies recently, and that actually has moved the other way a little bit recently as well. And I think that that's not the real trend. The real trend is that the US dollar is likely to devalue much further versus fiat currencies. Now, I want to be clear as well. I've had that thesis about hard assets for a long time too. I'm not talking about hard assets at this stage. I mean, I'm extremely bullish hard assets for the near term and the long term. I am being very specific about the dollar versus other fiat currencies, particularly the ones that are emerging markets. I think that's going to have some major implications in the global economy. And we have, as investors, to think about that, especially for the next 0 to 3 years. And I'm not here to also say that this is the end of the dollar or anything like that. I'm not going that extreme either. I'm just saying the appreciation of the dollar is highly likely for the foreseeable future. And, I think that's going to be very important.
The dollar is going to depreciate relative to other currencies. Why? Because other central banks are going to be more dovish than the Fed, or other reasons?
The other way around. I think the Fed is going to have to be more dovish than other central banks. I think if other folks have not learned a lesson about currencies, is that it's a relative game, always. It's a relative game, especially from the economy standpoint, from policy making and all those things. And when I look at that interest payment relative to GDP, this is the main thing I'm concerned about, because I cannot see this being fixed outside of suppressing rates in a large way. And if that's going to be the case here, then even the ECB and even the BOJ is in a better position than the Fed in terms of the interest rate policy. Keep in mind, Japan as a country has a much larger leverage in the system than the U.S. I understand that that's a very, very contrarian view, and I'm saying are very unpopular. The fact that I think that the BOJ is in a better position than the U.S., and I'm fully aware of what happened with the dollar carry trade not too long ago. But I do think that the Fed is it's really boxed in, and it's going to have to lower rates regardless of what's happening. And so we're going to get into that path moving forward. And what's going to be interesting, David, is if inflation actually really starts reaccelerating, which is my base case right here. I think that base case was a lot harder 2-3 weeks ago to call. Now you're seeing break-evens much higher. The crude prices are much higher. You're seeing most agricultural commodities much higher. We've had one of the largest increases in food prices over the last, since the Russian invasion period in 2022. So, things are lining up to a point that I think inflation could reaccelerate as the Fed is lowering rates, and the Fed is going to be forced to ignore that. That cannot be possible. That cannot be positive for the dollar, in my view.
I want to come back to the inflation side of the story, and you've done excellent research on the interplay between the Fed and fiscal policy. So we'll talk about that. But I want to focus on China's stimulus first, arguably the most important piece of news in the last couple of weeks for base metals. Just today, on Tuesday, October 8th, the Hong Kong Hang Seng Index saw its biggest daily decline since 2008, because last night, the government of China announced that perhaps the stimulus measures weren't going to be as big as initially projected. Take a look at this article from Reuters. China stocks rally fizzles as stimulus offer disappoints. Okay, Hang Seng saw its biggest, it closed 9.4% lower, heaviest fall since 2008. Comments here. Ultimately, for the rally to be sustainable, we need to see more fiscal policy and more measures to support the economy and the property market, says analysts. So the Shanghai Composite also fell. Basically, economic planner chairman told reporters Shanghai was fully confident in achieving economic targets for 2024, but his failures to detail sufficiently big or new measures rekindled market doubts about Beijing's commitment to ensuring the world's second largest economy can climb out of its most serious slump since the global pandemic. Copper today fell by the order of, let's say here, 3.5%, 2%, 3% in one day. Pretty big drop. As you know, base metals like copper rallied significantly. This was the announcement by the Chinese central bank here. So what's next for base metals? Is the China stimulus story still important after today's announcement?
Well, first, I don't think metals really rely solely on this China thesis. I think the China thesis is very much a potential upside to the story in a big way. And the reason for that is because I just want to be clear on one thing, the amount of spending we're seeing from developed economies outside of China, whatever you want to call it, a developed or emerging market, the Chinese economy, but the amount of money on construction, on trying to fix the electrical grids and green revolution, all those things, that's not ending anytime soon. The onshoring, and clearly that is yet to drive even further demand for the base metals in particular. And you can see that as well. I mean, utilities are leading the way in S&P 500 year to date as a sector. What does that mean? Now, either a defensive sector is very negative for the economy to see a defensive sector leading, or it's just the fact that a lot of institutional capital clearly understands that all these technologies and macro trends that we're seeing from onshoring in particular are yet to feed a much larger investment towards the utility space. And if we see that, it has to also drive the demand for the metals. And so I want, that's number one. Number two, I think what's happening with China, not too long ago, China was reported actually purchases of gold, and gold was doing very well on the back of those reports. And then one month, it basically reported that, unchanged holdings of gold, and gold had a terrible day on that day. And everyone was extremely bearish and saying, look, China's not buying gold anymore. And all it did was it didn't buy it for a month. And all these assumptions are made. I don't agree. To me, this is very similar to that. I disagree with this type of noise. The Chinese market went up massively in the last few weeks. Everyone is extremely bearish and up-footed. Everyone had to change their views. And now after a massive move, it's absolutely normal to see a volatility or a volatile day on the downside. We're seeing that today. Now, is at the end of it? I wouldn't bet against it. I wouldn't bet against it at all. I used to be a China, hawkish person. I used to write all these papers about the potential for a Lehman Brothers moment in China years ago. I'm not in that camp at all. I think that the time to be short China was 2 to 3 years ago. This is not the time now. Things have been cutting half. Some other things are down 80+% already. And if you don't understand that as an investor, I think you're missing the point in a large way. So I fully have this China thesis as a potential for other things like gold and base metals and others. I do think that the Chinese economy or the Chinese government is serious about stimulating their economy once again. And while I don't see this being what is highly dependent on the base metals case, I think it could be a very important upside, even for other emerging markets. And so you're seeing this sell-off in crude, a sell-off in a lot of other things. And if you look at it, technically speaking, crude is actually right in a support. It would make sense to have a weakness right at that level that we're seeing right now. Now, those types of, I shouldn't say support, resistance. Those types of resistances are usually not, very strong. You tend to see a big break out of those. And I would be betting on the other side of this. I actually think that inflation will reaccelerate. I think commodities would do much better here 3 months from now. And that can change quite a lot, this dynamic that we're seeing on a day like today. I think those things are quite normal if you're an investor and you follow these things. And I want to say one more thing. Every thesis that you come up with will be challenged at some point. Everyone. I mean, I've had my own thesis that have been challenged in the past. How many people told me silver would never rise? How many people told me gold would never rise? And trust me, I've had situations with silver trading $18 and I had to defend my thesis. Well, those folks that came out recently and said China was a trade to be in and they got it right, now they're being challenged. And what do you do in that position? Do you just get spooked and out of the thesis, or do you have the basis and the support to really, rely on and add to your position on a day like today? Now, I'm not an investor of communism. I'm not an investor of those companies at all. I want to be clear there too, but I would not bet against it. And I do think there's ramifications to the global economy. And I think that's going to be very positive for emerging markets. So I'm a buyer of emerging markets. And I think that's really the big trend ahead of us.
Going back to your thesis here, liquidity is going up, stimulus from China and stimulus from other central banks. So immediately, what are we looking at in terms of investment implications? Do you like emerging markets, commodities? These are your highest conviction calls right now for bullish assets that will react to the stimulus?
Yeah, I have, I've been very consistent over the years in those ideas. My ideas have always been, we've been in a entrenched inflationary era where central banks worldwide are very in a very limited position to fight those trends, and therefore are going to have to allow them to continue infiltrating the system. And ultimately, it drives capital back into things that have been neglected for a long time, hard assets being one of them, and also emerging markets. Now, of course, I have near-term of views as well. And I think energy looks very attractive. I think a lot of people are not counting on the idea that energy can break out and change quite a lot the macro setting here. And I think that's a real possibility. There's geopolitics that can play into this as well as a premium to energy prices, but also natural gas, oil, all those look extremely attractive. Other implications that I think are important when you have the suppression of interest rates on the short end, but you also have inflation running somewhat freely. You can have a major steepener of the yield curve, and so the steepening of the yield curve is one of the most important trends in my view for the next, call it, year. I think that's highly likely. We were highly likely to see a steep steepener or a steep steepening of the yield curve, and so those are important trends that are also still likely to unfold here.
Let's talk about that steepening of the yield curve, the most important investment trend of the next year. Why is that going to happen?
For two reasons. One, as I said, I think the Fed is trapped that they're going to have to reduce rates more than other central banks, and they're going to have to act quickly despite what's happening. And that doesn't mean we're going to see 50 basis points tomorrow or anything like that. I'm also not saying this, but I think that the trend of rate cuts is here, and it's here to stay. And so, this is my view on the short end. So short end is likely to actually go lower. And then on the back of that, we're seeing inflation actually reaccelerating this, with the Fed acting that way, but also with more stimulus globally on the money supply front. We're seeing commodities starting to trend higher. If you are of that view that inflation is reaccelerating, you're probably probably of the view that the 10-year yield will be challenged. And the other thing that I think not enough people are covering, and they were covering a couple of years ago, and now this thing has been sort of on the sidelines, has been the issuances of treasuries. More recently, on the long end, they're starting to increase again. And I think that drives supply much higher, drives yields much higher as well. So I would not want to be long the 10-year treasuries or the 30-year treasuries. I do think those yields are going a lot higher. And so if that's the case, you have a short end that is limited and it's likely to go lower. The long end is got a lot of upside. So that means steepening is highly likely. Plus, historically, when you have a deeply inverted yield curve, what do you see on the back of that? Abrupt moments where the yield curve tends to uninvert and in a very significant way. And so I don't think this time is different. I think we're going to see that once again.
Historically, when the 10-year minus 2-year yield curve steepened in the past, which assets have historically done very well?
Oh, that's a good question. I actually did a full research on this, looking at, I created an indicator, and I actually did a presentation at the IMF about this, which is I was invited to because I created the percentage of yield curve inversions. So instead of looking at separate yield curve spreads, like the 2 versus 10s that you referred to and others that a lot of people tend to look at, I decided to actually create a little bit more comprehensive way of looking at this and looking at all possible spreads in the yield curve. There's about 45 possible spreads, and then calculating how many or how much percent of those yield spreads are actually negative. And when you go above the 70% handle, you tend to see a recession. And if it's not a recession, which actually happened, I think, one time, where equity markets, did well despite all this. But one trend that is very clear that it tends to happen more often than not, and not only that, but the performance is very robust, is that the gold to S&P 500 ratio tends to rise significantly after those, very large amounts of inversions begin to uninvert. And so we are at the process now. If you look at the gold to S&P 500 ratio, it's been going higher, but not massively, because the equity market has been holding up well. And, gold has been doing tremendously well. I mean, the surge we've seen in prices is really what's been driving this ratio recently, but there's a lot more to happen here, in my view. And so I would be surprised if we don't see the gold to S&P 500 ratio be substantially higher in call it 1, 2, 3 years, because of this correlation it tends to have with the uninversion of the yield curve. And so that's usually the big sign. Now, it depends, to your question, it's going to depend on a lot of things. So if you are in the deflationary era, Treasuries is a good bet. And so in the last 20 years or so, every time you were in the position where yield curve is extremely inverted and it starts to uninvert as a recession unfolds, you want to buy Treasuries. If you are in a more inflationary era, you do not want to buy Treasuries. You're going to get in trouble. You want to actually buy gold. And so it really depends on what type of regime you're in. And now I have my opinion on that. I certainly believe we're in an inflationary era. And I think you can measure that in many ways, particularly how, commodities have been trading. We can get into that. There's kind of a rotation dynamic that we tend to see when you're in a commodity cycle in a very inflationary era. And in my view, this gold to S&P 500 ratio may actually work even more than we've seen in the past. So I'm paying close attention to that because of this, development in the yield curve.
So we're going to be in a bear steepener versus a bull steepener, meaning the short term will fall faster than the long term, but that's going to be happening into more of an economic decline. Is that basically your thesis?
I am agnostic about bear bull steepener, and okay. I think that you don't really have to answer that question unless you want to answer that question. But I don't think you need that answer. I mean, we have that trade on in our portfolio. We don't have that, I don't have that answer. I really don't know the answer for that. And I don't have a strong view because I don't know which one is going to move more. Honestly, if the fiscal side becomes a problem and the 10-year yield moves a lot higher, I'm sympathetic with that view. What if we see labor markets, I know we've seen some data recently, unemployment rates and others that don't support further cuts, but let's see we do in a month from now. And, a big change in the narrative on the labor markets front. And now justifies the Fed to cut much further, then the short end moves more than the long end. So, I don't really need to answer that question because I actually think the trajectory of both sides, or not both sides, but the spread itself is moving higher regardless. So what we do is we keep always, we have a duration adjustment of the position of that idea in a portfolio, and every week or so we try to kind of match that duration because the position would change because of the movements we tend to see. So as long as we're hedging both sides and that spread continues to be balanced in the portfolio, then that's I think that you can be agnostic to that question.
Actually, it makes a lot of sense. I'm going to flip back to my screen here. You have in your report, you said that your primary concern, however, is that the rising share of interest payments and entitlement spending pose a serious challenge to sustainability of this dynamic. I think you were referring to the World Monetary Policy here. Such non-growth oriented expenditures have surged significantly. So by non-growth, you mean spending on things that aren't infrastructure, things that are productive. You're just spending things on interest payments on debt, for example. And that spending from the government has been rising sharply per your research. What does this mean for capital markets, this chart?
Yeah, look, my letters are kind of long and I kind of build on them over time. And the prior letter was about a research I did about, the average fiscal spending we've had since the global financial crisis across the globe. And clearly the US is the one to spend the most. It makes sense. We're the reserve currency. We can be less disciplinary than other economies. It's what comes with territory, right? And so that's what we did. We meaning I'm Brazilian, not American, but that's what Americans did. They spend more money on the government side. That created growth on the back of that. That created a divergence of valuations of equity markets in the US versus other places. Imagine spending more every year than other economies on a relative basis. Kind of explains why you have such frothy valuations in the US versus other places. So that's number one. Now, when you dive into that 8% annual spending that we see relative to GDP every year, right, in average, one important aspect of that is that the known growth. Now, how much of that is known growth? How much of that is entitlement? A lot of people say that entitlements is eating the lunch of spending. It's not. I mean, it is, but it's not as bad. I mean, it's actually been very stable over the years. Believe it or not. I ask everybody to look at that data. Look how much entitlements is being spent relative to GDP over the years, and you will see that line has been going sideways recently. Now, what's not been going sideways is interest payments relative to GDP. That has been surging, and now, so you're looking at that 55% of U.S. spending is known growth because that's entitlements, that's interest payments. 20% of that is interest payments, just to give you some sense. So it's a quite significant number, and it's only going to grow from here unless we take rates to zero tomorrow, which won't be the case either. So, I do think that this is a problem, and it comes down to two potential solutions if you think about it. One, you can suppress rates so the interest payments can decline, and that's one solution, and I think that's going to be part of it. And number two is let's spend more so that known growth aspect, while it may grow over time, you still have that other part, the growth aspect that will still be coming in a more significant way over time as well. So let's just say instead of spending 8% of, or call it 6% of GDP on fiscal spending on deficit, you can maybe be spending 8%. So, but those things are highly inflationary, both policies, and I actually can see them actually working together, not separately. We can see a suppression of rates with more spending. But what's funny about this, David, is that if we see suppression of interest rates, that just means that the known growth aspect, that 55%, may actually shrink because you're suppressing interest payments relative to GDP. So you have to think that way. Monetary policy is becoming more and more a tool to allow the government to free up some of that burden from the debt front. And it's changing even the mandate of the Fed itself, which used to be let's try to create stability from the inflation front, labor markets, and the real, in my view, the real issue here is how do we pay our bills tomorrow from a government standpoint? And so it's changing the dynamic in a big way. And I think, again, it goes back to being very, very inflationary, because all these solutions or potential solutions to the problem, they're not really fixing the problem. They're just, creating other imbalances. And inflation is a big one. So I view this as a problem. And I do think we're going to see a lot more inflation. And this is not the end of it. And it's interesting that policymakers try to justify these changes in interest rates and other things by saying that, inflation is back to normal levels when, first, that's really coming from government data. But secondly, you can look at commodities, and commodities are not, I wanted to explain this earlier, but commodities are in kind of a rotation dynamic right now. You can see this clearly because every month there's one commodity that is a flavor of the day, right? It's like, oh, now it's gold. Gold price is surging. And then the next, 3 months ago was copper. And then it was orange juice. And then it was energy. You saw oil and natural gas back when Russia invaded Ukraine. And then you saw lumber prices coming out of 2021. Ammonia prices went up a lot. So you can kind of see they rotate. And that's usually a sign you're in a commodity cycle. So I would not play against that. I do think that's a much longer trend than most think it will last.
You've identified here something that I've noticed as well, which I find very interesting, the relationship between gold and base metals. You use copper here as an example. And you wrote that the recent rally in gold prices that's been happening all year long could serve as an early indicator of what could be on the horizon for base metals. Since when have they started moving together in tandem? Logically, that wouldn't happen, but here we are.
Well, it's interesting because I think all of us try to be, very specific when we look at copper and say, well, it's a very cyclical commodity and tends to move more as an industrial metal. Therefore, it moves more with the economy. And, when it falls more than gold. And when it rises more than gold. Those things are all true. I'm not here to say they're not true. But clearly, if you were in a gold cycle, you're probably in a copper cycle. Look at that chart. And I think it's a reflection as well of what happens a lot in markets where the easy capital or the easy decisions are made with things that are safer, right? First. And then as people feel confident, they start spreading the risk and going up on the risk curve. So in other words, it's much easier to take on a gold position at first than a copper position. But when gold starts moving, the immediate reaction of any investor is like, are there other metals that could move along with that? And then you start doing your research in other metals, and usually they're part of the same cycle. If you're an investor in the gold space, if you're a miner, a lot of the gold deposits also have copper. A lot of the copper deposits also have a lot of gold. A lot of the gold deposits have a lot of silver. So they're all kind of in the same phenomena. And then you think about what really creates a cycle for commodities. At the end of the day, if you could pick one thing, what is it? And it's usually CapEx. It's capital spending of the producers. When producers are spending a lot of money in aggregate, that's usually the end of a cycle. When producers are not spending enough, giving money back to shareholders, are not doing acquisitions, and so forth, that's usually the sign of being at a bottom. we're probably there, right? We're seeing some acquisitions, and usually they're happening between majors, one major buying another or merging with another major. But we're not seeing any CapEx increases. CapExes are still extremely low relative to history, particularly if you divide it or you adjust it by GDP, which you should be, right? $10 million spent in the ground today are not $10 million you spent back in 08. They're very different. Those dollars will not get you the same that you did back in 08. And so I think it's all kind of linked. And the same way goes to this, I don't know, ridiculous notion that is completely unsupported by history, that if we see gold prices this time rise, which has been happening, we're not going to see the miners actually perform well. I've never seen this throughout history. I don't think that's supported at all by data. And if we do see gold prices going a lot higher, which I think we will, it's just my opinion, I think that the miners will also follow. And also base metals, copper, silver, cobalt, zinc, manganese, you name it. Most metals should be moving in the same direction. And ultimately, if the underlying metal price is moving higher, then it means as well that we're likely to see better fundamentals for most mining companies.
So I've heard this theory from some people, and tell me what's wrong with this assumption, what the underlying assumptions behind this theory. Gold going up could signal more volatility ahead, more weakness in the economy, perhaps. Basically, gold going up is a barometer of weakness in risk assets, which could then signal slower growth, which means bad news for base metals like copper. Basically, gold going up should mean copper going down, a divergence from your chart. What, if anything, is wrong with that?
Well, David, I would, to those folks that have said that, can you please forward this chart to them? I think that would be important. I think you should ask them the question, what happened in 2000? Why did gold rise so much? And copper also was rising as much as it did during that period. Some people will say because of China. China was driving both markets, really. What about today? What are we seeing? Have you seen how much spending we're seeing in construction? Or have you actually taken the Inflation Act and how much is being spent, even from the government, forget about private, and compare that with times like coming out of World War II, when we did, nowhere close to what we're seeing today. Even the Marshall Plan, which was a global plan, not in the US, was smaller than what we're seeing now, adjusted for inflation or relative to GDP, which is insane. And so the amount of money going into construction is also likely to drive copper prices. And I think that the whole idea of copper being more industrial and also having this connection with economy is true. It's very, very true. And potentially, this is the beginning of an era. Now, maybe this whole chart is wrong, and that divergence we're seeing is the beginning of a new era where copper goes one way and gold goes another way. That's not what I believe. This chart, actually, if you go back to the 70s, was the same thing. And usually this is just the case because pension funds and other large capital allocators, gold has a potential to be signaling weakness ahead if it's rising. Not every time. Look at the early 2000s. When was that? That was the tech bust, right? And still copper did well. Look at that. Copper was still, going up. It actually had a little bit of a lag, which is the whole point of this chart, right?
Yeah.
It's the arrow that is a little bit ahead of it, but it went up, and it went up a lot.
I'm just scrolling back to, you're absolutely right. Good relationship between copper, which is right here, the purple line, and then gold, the bar chart. Obviously, there have been periods of divergence, but if you just scroll back into 1-year increments here, for the most part, except for 2019, they've held on pretty well. So
now, would it shock you if you put agricultural commodities in this? It will also show the same link.
Yeah,
and
interesting.
Is that shocking? I mean, you start thinking about it from just the rationale of putting capital into gold, and then gold starts going up. You start thinking about what are some other hard assets I should probably be considering. Should I put 1% of my fund into agricultural commodities now that they're so cheap and they haven't moved as much as gold?
Yeah, here's wheat moving quite well with gold.
Yeah, so there's...
So this is interesting.
Yeah, and so definitely there's a link in these commodities, and, they're usually all aligned. So, another point that is important. Remember that early 2000s all the way to 2011, where gold prices basically went one way up, despite the decline back in 08, which was brutal for investors. But if you're sticking with the trend, you did very well. But another thing that tends to happen when gold prices are rising, emerging markets, and there's a reason why we tend to see at times every couple decades a certain type of leadership in the market. Sometimes it's technology, and it's not forever. And then it changes to banks, and it could change it to emerging markets. And then it goes back to U.S. companies are leading the way to the upside. And look, I mean, back in the early 2000s, if you bought Ibovespa, which is a Brazilian index of equities, the most boring way to buy Brazilian equities, just buying an index, it went up 18-fold until 2011, right? So that's those are the types of returns you can get if you're being able to identify these trends early. And I think that's the type of opportunity we can have here in a big way. So yeah, I want to finish off. We have a few minutes left. I want to finish off on mining stocks here. You have here an excellent chart, cash flow of the gold sector and gold companies. Of all the sectors in the S&P 500, it looks like this one has the highest cash flow margin. Is it by the last quarter that you're looking at? Yeah, as of September.
17th. The GDX has just started to outperform the S&P 500 year to date, at 25% versus the 21%. But the outperformance is recent now, Tavi. So what's next?
Oh, well, I think we're not, we're nowhere close to what we're likely to see with the mining industry, in my view. Level of skepticism hasn't changed. A lot of people still think that, the overwhelming view out there is that gold, yes, I agree with gold. Of course you agree, gold is going up already. It's so funny how people tend to miss these things. But I think that the mining industry has a lot of leverage to metal prices. And leverage works both ways, in a good way and a negative way. If you catch the wrong wave of gold prices and metal prices in particular, you're done, right? It's going to be a very difficult period to be in the mining industry. If you catch the right wave where things are going up, then yes, costs will also caught up to, will also rise at some point as well. And there's certainly a degree of that linked to gold prices too. But they do have leverage, and you start seeing institutional capital come in, scalability of projects. Things can change quite drastically. The whole reason of this chart is to kind of prove the point that there has been fundamental improvement in this industry, and margins have been improving. It's needless to say that gold prices have been rising to a degree that we haven't seen in history, and other metals are yet to follow. So, in my view, the next wave here is going to be very much driven by the mining industry, and so I'm very focused on this because gold prices have already showed the direction, and I think that the next one to also benefit from this is the mining industry. And we're seeing general investors become more and more interested in the space, but the lack of knowledge and understanding of this whole industry, I think, reflects on the lack of efficiency that we have in how we price the securities. And inefficiency is also a cool word for opportunity, in my opinion. So this is why I'm always there's two things that I'm really interested for the next decade. One of them is, three things. One, try not to be too cute with markets, right? I mean, I don't know when gold prices are going to go down 5-10% or copper, and not just me, but anybody. Now, I have a strong view that gold prices will be substantially higher 5-10 years from now. If that's the case, there's two trends that I'm very focused on. Mining. I think mining will do very well. You could see energy, you can see other things do very well, but I think mining is going to be one of the main ones. And number two is emerging markets. And I think those are extremely mispriced today. And, talk to me in 5 to 10 years. If I'm wrong on that, then, I'm happy to admit and move forward. But that's really where my allocation of time, capital, attention is really towards at this point.
Well, it's been a great year for commodities and precious metals in particular. So you've been correct on that call. So we don't have to wait 5 years to congratulate you. You've already been right on that. Good stuff, Tavi. Thank you always for your updates. Where can we learn more about you, and what can we learn from your work?
You can learn more about me on Twitter at Tavi Costa, and you can see some of my posts, and also at Crescat.net, where you can see some of our research pieces that we put out there as well. But thanks again, David. Always a pleasure speaking with you. And look forward to speaking with you soon.
Yeah, thank you very much. Thank you for watching. Don't forget to like and subscribe. Follow Tavi down below.
Issue, because when the banks have a problem, we see a spike in funding. This is exactly what we saw in Asia. Again, we warned you this could hit American banks. 2 days later, we're already seeing signs of it as investors keep asking about last week's U.S. Treasury funding spike. We initially overlooked one key factor, large reserve drain into the third quarter end, and we're going to expand on the drivers and implications of large cash drain. Here's the hot take. The Federal Home Loan Bank issuance becomes relevant again, and this is a shocking move because what happened with Asian banks? They started running out of money, which is exactly what happens when financial conditions tighten. Then this always occurs when central bankers invert yield curves and money curves. Now, one of the challenges, it hasn't really impacted the U.S. financial system, and many people thought these curve inversions were irrelevant. We warned you. They were still relevant due to all the pandemic stimulus. It was only a matter of time. Well, it's here. And instead of going to the discount window at the Fed, which is what Asian banks did going to their central bank counterpart, they went to the Federal Home Loan Bank. This is something Congress doesn't want, something the Fed doesn't want, but the stigma of going to the Fed is such a negative that the banks don't want you to know they're facing a massive liquidity crisis. Quarter trillions of dollar reserves matter. Since the first half of September, at least $260 billion of reserves are drained out of the U.S. banking system. As cash left the system, repo spiked. We'll talk about what repo is in a little bit. The cash drain was a result of at least three factors: higher Treasury general account, lower bank term funding program, and Q3 window dressing. And this is a big issue because just like we saw with Asian banks, money is leaving and is not being refilled. And this is something we go back, of course, to when we saw the last banking crisis in March. What happened? The banks were running out of money. The Fed ran to the rescue and said, look, everything's okay. We'll inject money into the system. And we said it's only a band-aid to the bigger issue here. It will be back. It's here now as we see higher Treasury general account, which increased from mid to late September. And what this did is it pulls money out of the banking system because when the government borrows, well, the banks actually take a lot of these loans and then eventually resell that debt on the open market. Well, what this does is it pulls cash out of the financial system, puts it in the coffers of the Treasury. This again by nearly $200 billion. And recall, for every $1 in TGA increase, either reserves or overnight reverse repo typically declines by $1. So this is dangerous. This is a direct drain on reserves. How about lower bank term funding program? This was a bailout program back in March of last year. Usage of this surprisingly dropped $26 billion. We'll show you why this is, because one of the things we weren't expecting is a bank banks to run to the Federal Home Loan Bank, and we see debt issuing jump likely with higher advances to repay those loans. And this increased Federal Home Loan Bank debt is exactly due to upward pressure on the federal funds rate. But let's talk about window dressing here, because dealer repo activity likely declined into the third quarter due to balance sheet pressures consistent with overnight reverse repo jump. Commercial banks may not have as much flexibility to invest cash into repo because of reporting constraints. So we have multiple issues here as banks are seeking collateral. They're in desperate need of cheaper cash as they turn to the Federal Home Loan Bank. And on top of that, the government is borrowing big numbers, pulling liquidity out of the system. And this is all a dangerous cocktail, as B of A warns that this is heading us right into a massive liquidity crisis, one that looked like just what happened in 2019. If you look back what happened then, of course, the Fed reacted very quickly by aggressively cutting rates, something they can't get away with now, but they also did quantitative easing, something nobody thinks they're going to do. But if we hit a liquidity crisis, watch the Fed go ballistic. And here you can see the Treasury general account increasing from mid to late September, pulling nearly $200 billion out of the financial system of desperately needed cash, and now that's sitting in government coffers waiting to be spent. But how about we turn to the Bank Term Funding Program? Now you'll note this is a one-year loan, and what we expected was a payback to be exact mirror of course, all the borrowing, because it was a one-year loan and the banks have really no incentive to pay it off early, but suddenly they're doing that, and the reason has everything to do with a Bank Term Funding Program interest rate, which is stuck way up here as one-year overnight spreads continue to fall, meaning banks have every incentive to refi this debt. Now, the original plan was, when the Fed implemented this program, is that money would flow back into the banks, mostly this being the small and mid-sized regional banks that are starved for cash, and what would happen then is they would eventually attract this money back in and be able to pay this debt off. But what's happened is they're not attracting money. That's the issue, because the federal funds rate is too high, short-term rates such as CDs and other products are too high, and the banks just don't have the capacity to match those returns. We're seeing money again drain out of the financial system, out of the critical small and mid-sized regional banks. They're so desperate that they're turning to the Federal Home Loan Bank. Again, this is something Congress doesn't want, the Fed didn't want. In fact, the Fed doesn't want this so badly, they've come out with a marketing campaign to tell the banks it's okay to go to the discount window, but the stigma of going to the Fed for money is such a negative. The last place the banks want to go is to the Fed. And here we can see right around the time they started paying down those bank term funding programs, we see Federal Home Loan Bank issuance of debt rising because the interest rate is lower here. The banks are in danger in a big way. And we have long believed funding markets are determined by three fundamentals: cash, collateral, and dealer sheet capacity. We attributed last week's funding spike to the latter two factors. We overlooked the extent of cash drain and contributing to the pressure. So what we have is tight financial conditions draining money from the system because there isn't enough new money being created to pay on all the debts and to achieve the growth targets of the economy. But we're also seeing a collateral shortage. And this is important because in normal times, there's ample amounts of collateral. It's not an issue. But as financial conditions tighten, banks start to get worried. They start wanting more capital. And what they need is, of course, treasury bills. That is what's considered the most pristine collateral. We're talking more about that here in a little bit, because I want you to understand what's going on. Because what we're seeing is reserve balances are projected to get worse. And this is dangerous because the Fed really doesn't want to see bank reserves get a whole lot lower. They've kind of mentioned that in their press conferences, that they're happy with the level of reserves, because if they get lower, what that means is the Fed's going to have to lower interest rates and go back to quantitative easing, because what QE does is it forces the creation of bank reserves, and that means interest rates are likely broadly going to plummet. But the issue is in the short term, we've seen interest rates rise. But applicable 30-day free trial. You know, my buddies don't do that because they know you won't make money draining their system. We do. We want you to get in and start making money, and then you'll understand. Because let's talk about reserves and what happens here when financial conditions tighten, money gets drained from the system. So let's go back to the global financial crisis and see what happened. So on this chart, we're looking at the net percentage of domestic banks tightening standards for commercial and industrial loans. It's shown in blue. And what happens is any time that blue line is above that horizontal black line, well, it means financial conditions are tightening. Now here you see reserves of depository institutions skyrocketed. Now this was due to quantitative easing one. It really wasn't an evidence of money being drained out of the system. But look what happens as the Fed ends its QE program. You see what happens. Reserves start to get drained. And even though financial conditions eased a little bit, they were still fairly tight. Not enough money was being created. And you see money getting drained out of the system. And then what happens? The pandemic hits. Massive amounts of money are borrowed, injected into the financial system. But look what happens now. You see financial conditions tightening. It really isn't affecting the broad economy at this point, although it's just starting to. But look at the banks. You see reserves getting drained down. And then they come back a little bit. And now they're getting drained again. This is a dangerous sign for the banks, because what it's indicating is there's a liquidity crisis coming. And remember, we talked about this in the show the other day, that those very short-term rates spike, those interbank rates spike when you have liquidity problems. Well, guess what? Bank of America says that's about to happen, as repo is the heart of markets. Now, you might wonder, what is repo? Now, when my buddy Jay Bravo calls me and asks me questions, he says, Steve, can you explain things as a third grader? Well, JB, this explanation is for you. So let's pretend we're a third grader and we're in class, and the school says, hey, we've got to issue a textbook, meaning every third grader needs a textbook. We'll call that collateral, is what that textbook is. But let's say there's a problem, and under normal conditions, each student would have its own book, and that way, if there was something wrong, they'd have the collateral they need. But let's say there's a mirror class and there's only one book for the entire class. So how do they meet the requirements of having collateral? Well, the first student with the book says, you know what? I don't really need this this all the time, so I'll loan it to the student behind me at their desk, and I'll charge them interest. And then that student says, well, I don't need it every day either. So they're going to loan it to the next student. And next thing you know, there are lending agreements to every student in that class. And yet when a regulator looks at it, it doesn't matter if every student has the own book or every student's borrowed a book. When the feds come in and audit the banks, they say, oh, everybody's got collateral. But there's a problem. When things start to go wrong in the system, those who have borrowed it, well, or lent it out, that is, they want it back. And so they say, hey, we're going to do a margin call. We want our money here because we want to hold collateral in case something goes wrong. And next thing you know, there's a scramble by all these banks that don't actually have collateral. That's why you see funding rates spike. That's why you're seeing this issue in the repo market. It's telling you financial conditions are tightening, because what you don't know about the US banking system is they're not required to actually hold the collateral until they actually need it. And then the banks scramble in a big way. It's a big problem with our system. And here we can see that repo EKG flags a shift as cash drain has supported a spike in the repo rate. And Fed should take repo pulse and sense the shift. If the Fed is too late to diagnose, we get 2019 repeat. The bottom line, stay short on spreads with Fed behind on the diagnosis. And here you can see, looking back to the SOFR less the IBOR spread, going back in 2019, what happened? It spiked. And yes, for those who remember those events of September, a similar dynamic was seen back in September 2019. At that time, the correlation of changes in reserves turned similarly and culminated with the Fed's not QE with the last few months before COVID mysteriously emerged and sparked the biggest liquidity injection in history. Here, we're now seeing the setup. You see this again from Bank of America Global Research, but similar but not identical, because this time, in addition to the $3 trillion in reserves, there's also the $300 billion liquidity backstop that was reverse repo facility. However, between QT and the coming Treasury issuance onslaught, that's just a matter of time before reverse repo is drained and total reserves slip back to the $3 trillion, which at point will be time to start front running the next Fed panic, which we know is coming. But as we started the show out, there's issues not just with the liquidity, the underlying plumbing of the financial system. We're now seeing problems with the banks and consumers that are only going to make this liquidity problem worse. Let's turn to JP Morgan, who post their earnings today with a surprise gain in net interest income, which raises key revenue view, but it's really the underneath that matters here, because the firm's results included $3.11 billion provision for loan losses and $2.09 billion in net charge-offs, amounting to roughly $1 billion in reserve build. Now, what this means is when they have loan losses or they build the reserve for loan losses, they're projecting people that are going delinquent or are not going to be able to pay their loans. They're going to have to write that loss off. That's not a sign of a booming economy, because what you want to see here is loan loss reserves go down as more and more people lend, which would give you some indication that the liquidity crisis is going to go away because new money is being created. What we're seeing here is further signs at the consumer level and at the banking level that the liquidity crisis is getting worse because people are running out of money. And most of the reserve bill was tied to the consumer unit, primarily credit cards, as period end card services loan grew 12% a year ago. And what that means is we start to see the delinquency rate rising, which is something we've warned about, and is again evidence that there's not enough money in the system. As we go back to the net percentage that makes tightening standards for commercial industrial loans against the delinquency rate for credit cards, that's shown in red. And what do we see here? As banks tighten lending standards, eventually the money drains from the system. You see there's not enough money to pay on all the debts. Delinquency rate rises here going into the dot-com bubble. We see it happen again going into the global financial crisis, and we see it happen again. Now, mind you, it's still very low levels, and this data is only updated quarterly. But nevertheless, the direction here and what JP Morgan signaling is absolutely dangerous, because now we turn to the U.S. consumer as sentiment unexpectedly falls on high cost of living. And what we know is when cost of living goes up, consumers spend less, they borrow less money is created in the system. And what you can see is the brewing of an imminent liquidity crisis centered right at U.S. banks. Of course, the only bailout will be the Fed. The question is, as BofA notes, it'll be too little and likely too late. As a preliminary October sentiment index declined to 68.9, something we believed was likely going to happen from 70.1 in September. And when we look at sentiment against delinquency rates, well, it's notable. We see back here in the mid-90s, the economy was actually fairly decent, but not for everyone. You see delinquency rate rising, sentiment flatline. But now we move into, again, to 2000. What do we see? Sentiment comes down as the delinquency rate rises. Consumers realizes the party is over. Again, it happens once again going to the global financial crisis. But this time we see something different. We see sentiment rising as consumers remain very optimistic about the economy. At the same time, they're struggling to pay their bills. We believe the sentiment is going to come crumbling down as the delinquency rate skyrockets. Now, of course, we know this has everything to do with the labor market and our question of the accuracy of the data of the labor market. But we look at continued unemployment claims against consumer sentiment. What we're seeing in the delinquency rate is consumers losing their job, unable to pay their bills. And what this is telling us is consumers are starting to get worried about the economy. Now, they're not saying it, but we can see the relationship here between a plunge in sentiment and a rise in unemployment in terms of continued claims. And while the rate of inflation has cooled over the past year, households remain troubled by high prices as they also see outpacing their income gains for the year ahead. And that means, of course, less spending. That's a real issue here. A measure of consumers' perception of the current financial conditions dropped to the lowest level since the end of 2022. But get this, despite the fact that they're looking spending less and they're worried about their finances, the share of consumers who expect unemployment to rise in the coming year fell to 31%, which means they actually think the labor market's going to hold up. But remember, your spending is someone else's job. At some point, they're going to lose confidence in the labor market as well. And yet, respondents welcome the Federal Reserve's decision last month to start lowering borrowing costs. Their views of buying conditions for durable goods such as cars and major appliances edged up just to a 4-month high. So notably, they're worried about their finances, but for some reason, like, well, I might be able to go afford things. The reality is they're not, and that's the issue. They just don't realize they don't have the money. But looking about creating large amounts of money for the economy, but let's talk about home buying conditions as concerns about high interest rates fell to the lowest in 15 months. But a majority still sees borrowing costs as too high, suggesting further easing is necessary to bolster sales. When that means is builders are going to be stuck with inventory, banks aren't going to be lending and creating money, and all you see is everything kind of slowly moving into what's going to be a massive liquidity crisis that we're already starting to see in the repo market. My friends, this is not a good sign for the U.S. banks. It's not a good sign what we saw the last 2 days for Asian banks or the global economy. It says we're headed to an absolute financial crisis. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.
Bjorn Sheldrop joins the show. He is a chief commodities analyst at SEB Research. We talked about his outlook on oil. Welcome to the show. Bjorn, good to see you. Pleasure to host you today.
Thank you for being here.
In your recent research report that you published in the first week of October, you wrote, so if worse came to worst, and if the Strait of Hormuz was closed for a month or more, then Brent crude would likely spike to $350 a barrel. The world economy would crater, and the oil price would fall back to below $200 a barrel again over some time. But the risk for this currently seems very remote, and both the U.S. and China would likely move in to try to reopen the strait if it was closed. Walk us through that scenario and some of the assumptions behind a $350 oil target under that scenario.
Yeah, I mean, if you look back in history, and you don't need to look far back, you can see that when you have commodities, severe disruption in supply of specific commodities, they tend to move like 5x or 10x the normal price. I mean, look at nickel price when Russia invaded Ukraine. It went from $20,000 to $200,000 per ton, and of course it was due to some technical reasons as well. But then the nat gas price in Europe moved to like $550 per barrel of oil equivalents in Europe, and to $385 per barrel of oil equivalents in Asia on the LNG market, and then fell back, of course. And when you calculated these costs to the share of the economy, the pricing of electricity on the basis of that nat gas was like 20% of GDP for a whole year, priced on the 2023 contract, which is just unachievable, which the economy would crater. And obviously, the price fell back rapidly. And if you look at the oil flowing out of the Strait of Hormuz, we're talking 18 to 20 million barrels per day flowing out there. And that accounts for close to 20% of global demand. So for sure, if it was really closed and you lost 20% of supply, the price would just explode. And the fact that, we have only witnessed prices moving up to $149, $150 historically, which is a much higher price in today's money. It doesn't mean it can't move there if we get these resupply, and we really have to move back to the 70s to see this 5x move in oil prices. But it's so far long back for oil to have seen these massive spikes of 5x normal price or 5x the prior year price. So we kind of have forgotten, and markets tend to be surprised when things happen, which hasn't happened for a long time. I mean, look at inflation, suddenly spiked. We haven't seen it since the 70s and 80s, and then pandemics. We haven't had a pandemics in 100 years, and governments panic around the world and stimulate the global economy with 10x the stimulus of global financial crisis. So just the fact that it's long ago doesn't mean it can't happen again.
Well, we know that the Strait of Hormuz is very important and vital for transporting oil from the Middle East to the rest of the world, but do they not have other alternatives besides the Strait of Hormuz? Pipelines, perhaps, inland?
You do have one pipeline going from east to west from the Strait of Hormuz and into the Red Sea, and it holds something like 5 million barrels per day of capacity. Saudi Arabia is holding that pipeline, so as an alternative outlet, Saudi Arabia could ship oil into the Red Sea and out into the global market, either up into the Mediterranean or down through to the Persian Gulf area or around there and around Yemen and to Asia. But of course, then you have the Houthis who could threaten that oil. So for sure, there would be a lot of adaptation to such a supply shock, losing 18 million, and some would be adapted by oil coming out of strategic oil reserves in the US and the OECD countries. China would use from strategic reserves, and Saudi Arabia would channel oil through the Red Sea rather than to the Persian Gulf. So yes, we always have a market adapting quickly and as fast as they can. And then of course you would have Russia lifting production by 1 million barrels, stuff like that. But I mean, we are talking like 20 million barrels, and even with shifting oil to the Red Sea by 5 million barrels, we're still short like 15 million barrels on the supply side.
Now, if the Strait of Hormuz was closed by Iran, presumably through a naval blockade of some sort, right? What does this imply? That there has been a significant escalation in this war between Israel and Iran, and perhaps Israel has already retaliated by this point. What needs to happen for the Strait of Hormuz to be closed?
I think we recently had like 200 ballistic rockets hitting Israel from Iran. Many were intercepted though, like Tuesday 1.5 weeks ago. For sure, Israel is going to retaliate. That is for sure. We don't know when, we don't know how. We know that they have like a mile-long list of possible targets, which they could choose from. Is going to be just a soft reply like we saw in April, where like it's just two dogs barking at each other and then sort of moving back? Or is it going to be a hard hit to military installations? Or is it going to actually hit the oil installations of Iran, hurting and closing down Iran's possibility to export currently around 2 million barrels per day of oil, including condensates? And if Iran then is losing its ability to export oil, I mean, it could hit back by closing the Strait of Hormuz, just saying, okay, if we are not going to be able to enjoy oil exports, enjoy oil
crisis might seem kind of mild compared to what comes from where we are now, just because we have so much more debt out there. It's a growing number of people who are just basically debt slaves, completely controlled by a small handful of elites. And there's no fix. Unless the government just starts giving them money again, there's no way out for those people. So that's a recipe for a recession, or something a lot worse than a recession.
John, thanks so much for coming back on the show.
Hey, Todd, it's great to talk to you again.
I always love your thought-provoking commentary and your writing. You're a great author. I love your Substack. I love the work that you do. And as we started out when we sat down here today, you said there's a lot to talk about. So, really, I want to go over, I know you've got a lot, but I want to make sure that I get your opinion on the current housing market as well as the economy. But one of the things I really want to make sure that I don't let you get out of here without talking about this last United Nations meeting in New York City. And, they signed this to be maybe this 42-page, pack, pack of the future, they call it. I want to get your opinion on that too. So how's that sound? Is that all right?
Yeah, that's fine. Basically, the UN is an awful lot like the World Economic Forum, which is an awful lot like the EU. They basically all want control in one way, shape, or form of what goes on going forward. They want to effectively do away with free speech, and they want apparently kind of sort of global open borders. In other words, they want the world to look an awful lot like Europe right now, and that's catastrophic. So it's definitely a thing to oppose. But the people who are capable and willing to oppose that kind of trend are becoming fewer and farther between around the world. And there's 1,000 examples of that. Like Brazil basically shut down X until Elon Musk agreed to some of Brazil's terms. And France arrested the CEO of Telegram, which was a formerly private communications social media network, until that guy agreed to some of the EU's terms. So there's a lot of power plays going on in the world in which governments or multinational organizations try to take power away from what used to be thought of as the public square. In other words, we used to have free speech to an extent, at least. And if they get their way, we won't have anything remotely like free speech. We'll only be able to talk about what the government considers to be the truth. And since the world's governments have been the biggest purveyors of disinformation over the last, well, maybe forever, but over the last 30 or 40 years since we've been watching, that means basically that none of us will get exposed to what is true or any kind of a discussion over what's actually true. And that's basically totalitarianism. So, you can't really minimize what's happening, or you can't overstate how important the things that are going on right now are, because they're changing the world in fundamental ways without most people noticing that change is happening. But once it's in place, it's over. Freedom of discussion, freedom of ideas, that all goes away. And that's what the UN is talking about right now. So we should be paying attention, and we should be opposing it in any way we can.
I'm surprised that, we're really not hearing anything about it at all. All the world leaders coming together in New York and, signing this pact. Nobody's covering it. You have to dig for it. It's amazing. It seems like at least the mainstream media, or like you're referencing, a lot of the even social media platforms aren't really covering it. And being in the housing market, I see the UN's footprint in a lot of the counties, in states and counties across the country, with the agendas for green space and the green energy and things that are affecting the housing market. And I guess when you're referring to like Brazil, for instance, in banning X, or the issues with the social media, I guess they just don't want anything that is controversial or opposing to these agendas to even be discussed.
Well, no government wants dissent, because if you're in power, you're assuming that you are doing the right things. And so anybody who disagrees with you is, in your mind, in other words, if you're power hungry enough to be running a government, because you basically have to be a narcissist squared to make it all the way to the top of most governments, it's impossible for you to believe that the people opposing you are right or even good. So it's really tempting just to shut that down so you can get on with doing God's work, right? And governments have, throughout history, basically have gotten away with that, because democracies with free speech are incredibly rare in human history. So most of the time we had some kind of a dictatorship. And that tendency is always there. Governments always want to be dictatorships. And we're seeing today's would-be dictators get a lot of new tools, basically. We basically funneled debate into a handful of big social media companies. And if governments can control those social media companies, then they control the narrative, because they already got the legacy media, CNBC and MSNBC and ABC and Fox and CNN. They all basically do what the government tells them to do. And if X and Telegram and Rumble and just a handful of other social media platforms get in line, and start obeying governments, then that's it. We have no source of good information, because what you and I are talking about right now would be banned in a heartbeat if the government was able to completely dictate to YouTube what shows up there. And they can already partially dictate what shows up on YouTube. There are things that you and I can't talk about, that you and I might talk about. If we're sitting in a bar with beer in hand, we would be saying things that you can't say on YouTube, probably. And because that's the case, expanding the realm of censorship is pretty easy once you get started. So there's no reason why they can't add all kinds of other taboo topics and just ban us from saying what we think here. And that's coming. The guys in charge will do that if they can. So it's up to people to stand in the way of that. And you do that by frequenting places that still feature free speech, first of all, and by kind of pushing the boundaries on the places that don't. You and I are going to talk about things that offend the government today, because the government is doing so many offensive things. But we probably won't step over the line that would get you banned from YouTube. And when they move that line, then that's when things get tough, because they have the ability very easily to change their algorithm to punish things that they don't want to punish. And if the government's on board and there's nobody else protecting us, that's just how it is. That becomes our world, where we're censored and there's nothing we can do about it. So it's a very scary time, because we're not far from the dystopian version of this whole thing that could easily happen.
Almost sounds like Paul Revere's ride. You have to go back to word of mouth, blasting things out that way, versus having any kind of microphone that reaches out. It was interesting. Not that long ago, I heard that the White House had their first like YouTube summit almost. It was, they invited some of the, I don't know how they picked the creators. I wasn't invited to come to the White House. And this was just maybe a couple months ago. And, they made it seem like that they were concerned about, they wanted to know what was in the psyche of creators and, how they were handling, certain things, mentally. And they were also talking about making sure that YouTube pay them their fair share, like almost like making sure that you were getting the revenue that you deserved, and like they were going to put some kind of regulations in to protect YouTubers or something. And I thought to myself, very strange. But then it made complete sense to me. I'm thinking to myself, well, I mean, why wouldn't you want to be, pulling these top creators or whatever that have the influence and, tell them, hey, we're here for you guys to make sure everything is okay. Where do you want to start? Where do you want to start today?
Let me add one little thing to what you just said there, because the government definitely wants media creators to be dependent on the government. And in Canada, for instance, that's already the case. The Canadian government sat down, made a list of what it considers to be the legit media outlets in the country, and then started subsidizing them. So they pay the guys who toe the government line in order to keep doing it. And the U.S. government would love to be able to do that. There's a lot of First Amendment issues with them doing that, but if they can get away with it, they totally will. Okay, so you want to start with real estate? Housing industry is pretty interesting right now.
Yeah, let's start there.
Okay, what has happened in the last couple of years is that houses have soared in price in the U.S. to the point where they've become more unaffordable than ever. In other words, the average American cannot afford anything close to the average American house. That's the term unaffordability when you see it tossed around. That's what they mean. And so home sales have gone way down. There was a stretch there where Wall Street was basically almost the only buyers of houses out there. And now, it's not clear who is buying, because home sales have dropped down to like 1990 levels, even though the population was much lower in the 1990s. And that's because houses are unaffordable. Now, what's happening? What's happening now is that the supply of houses is starting to go back up. Finally, people are starting to try to sell at today's prices. They're not listing their houses at 40% below the market. They're listing their houses at the market. But since the market is at unaffordable levels, those new houses coming on the market are not selling very well, if at all. So home sales are still way down. So the way the housing cycle usually works is that you get a peak of home prices that are borderline unaffordable, and then home sales drop off while the supply of new houses goes up. And then people who are trying to sell start to panic. They start to cut their prices dramatically. And we're seeing that happen now too. So the supply is going up. Price cuts are starting to become much more common on Zillow. I think it's like 1/3 of houses that are listed now have had a price cut already. And so that's what normally happens before the housing market rolls over, because then the dam breaks and everybody starts trying to sell their houses for whatever they can get, and prices drop. So I would say, based on recent data, that we're kind of there right now. This is where historically a downturn in home prices and just the market generally starts to happen. And then commercial real estate, office buildings are going bust. Now that's a bubble that is bursting, not just rolling over. And that affects, both housing and commercial real estate affect local and regional banks, because they own a lot of that real estate paper. So let real estate roll over, and then the banks start to go bust, and that starts to spread, and the government has to step in and bail them out. So we're in the early stages, or maybe the medium early stages of a process like that. That's going to be front page news within the next 6 months to a year. And it's the kind of thing that can be a domino that knocks over a lot of other dominoes. So it's definitely worth paying attention to.
You wrote the book on the real estate crash too. I mean, you predicted 2008. You were a couple years ahead of time. But you know what, John? It's not easy to predict something like a housing market crash, considering, number one, we had never had one really since World War II. So when you were predicting this a couple years before the crisis, you saw the market shaking. Like you're explaining now, there were indicators and things that you were looking at that, and we didn't have anywhere near the unaffordability as we back in 2008 as we do right now. The question that I have for you, when we look at the 2008, we'll just call it GFC. I think everybody knows by now that's the global or great financial crisis. Millions of foreclosures. It was bad. When that actually started, we saw the peak in 2006. By 2008, we saw obviously the blood in the streets. In 2008, we had a 5-year reset to home prices. And I know it was somewhere, and I read this in even one of your Substacks, about 19% median price drop across the country, much more in certain markets. But we know that represented about a 5-year price cut. If we look at 2008, we saw housing go back to 2003 prices. Where we are today, if we had a 5-year price correction, that would take us not 19% off of the value of the average home. That would take you to 50 to 80% back in price if we had a 5-year correction now. What are your thoughts as far as that happening? Do you think that's a possibility?
Well, something has to happen to cut the cost of home ownership by like 40%. So it could be falling mortgage rates, because higher mortgage rates right now are a big part of the whole unaffordability thing. So if interest rates plunge, then that helps a lot with home affordability, because if you can go back to 3% mortgages, all of a sudden a lot more people can afford houses at today's prices. But going back to 3% mortgages kind of implies the economy has just ground to a halt, right? Because you don't get cuts in mortgage rates from 6 or 7% today down to 3% unless the economy is deeply in recession and the government is cutting interest rates in a panicky way, where they're really easing to avoid some kind of a much deeper recession that they're seeing at the moment. So that would probably involve falling house prices too. So we can see it, but let's say house prices drop by 20%, mortgages drop by 3 or 4 percentage points, and that gets us back to where it's not wildly overvalued anymore. But the environment in which that happens would be pretty brutal. So people wouldn't be thinking, oh yay, houses are affordable again. They'd be thinking, oh my God, I'm going to lose my job. My credit cards I'm going to default on my credit cards. They won't be thinking about buying houses at that point. So the home market will be pretty ugly for a while, just because housing isn't the only bubble. there are all these other bubbles. We're in the everything bubble now. And once one bubble starts bursting, the others will start bursting as well. And you get something a lot more serious, potentially. I mean, the numbers are so much bigger than they were in the 2000s that the great financial crisis, the GFC, might seem kind of mild compared to what comes from where we are now, just because we have so much more debt out there. We basically, in effect, doubled the amount of debt in the world from 2007 or so to today. And we were already wildly, catastrophically over indebted in 2007. So what will have to happen to bring debt back into line is going to seem really extreme, even compared to people who remember the GFC and who know what it was like during the pandemic and everything. It's going to seem much worse than that. Well, it'll be much worse than that, just because that's what an overabundance of debt does. And so there's no real way out of some kind of big crisis. But as far as home prices go, it matters a lot what kind of crisis we decide on, because we basically have two choices now. We can let everything fall apart, let all the bad debt go bust, and then we're kind of sort of back in the 1930s, which is devastating for the housing market. Or we can try to inflate our way out of it, which is what we're trying to do right now. We have to talk about the U.S. cutting interest rates and China easing so aggressively just lately. And what that means is that we're going to try to make the existing debt less onerous by making dollars and euros and yen and pound sterling and yuan less valuable, so that we can pay off our debts in depreciated currency. But of course, that means inflation. So we might have a burst of inflation as we try to work our way through this. As all the current easing gets even more extreme and the money supply spikes, and that causes the value of currencies to fall. So we could have that. In which case, house prices might be stable or continue to rise a bit, because we're changing the measuring stick that we use to price houses. If the dollar goes down by 30% versus real stuff, then for a house just to stay stable, unchanged in real terms, its price would have to go up by 30%. So that's where things get kind of iffy. And it's the same thing with the stock market. In countries that are inflating away their currencies, stock prices go up. So you have a bull market in equities, which is usually an optimistic thing, but it's happening because the currency is collapsing. Look at Venezuela's stock market. Just pull up that chart, and it goes straight up. It looks like the most successful country in the world in the middle of a tech stock boom or something like that. But it's actually in the middle of a hyperinflation. So when you're talking about real numbers versus non-inflation adjusted numbers, things get very hard to figure out. And I wouldn't presume to have any way of predicting like what the average price is going to be worth, house is going to be worth 3 years from now in dollar terms, because it's very hard to predict what the dollar is going to be 3 years from now. So the general advice that flows from this is to be cautious. Don't do anything really aggressive financially in a world where we haven't quite yet decided which kind of crisis we're going to have to deal with all our debt. And if you do choose sides, don't bet the farm on either side being right, because we just don't know right now. We're headed for a version of chaos, but we don't know for sure which version of chaos that is. And we're trying for one, but there's no guarantee that we achieve that. We might end up with the other very easily. Sorry, that's not very helpful advice, because it's not definite, but that's the world we live in now. It's just a really indefinite, potentially chaotic place.
Yeah. If we go back approximately 5 years in home sales, and by the way, this includes some pretty low years, down years. I think they're predicting that maybe this year we'll have 5 million home sales, somewhere around 4 million last year. But if we go back 5 years, that would mean that about 30 million home transactions have taken place, home sales, since 2019. Now, we both know that during the GFC, a lot of values were dropping much bigger, depending on where they were and how the markets were impacted by job loss and distress, areas that were heavily distressed. Those prices dropped way more than 19%. But we know that when we look at 30 million home sales over the last 5 years, potentially being underwater, what happened back in the GFC is people were walking away from their loans, not just people that were going through financial problems. If you looked across the street and someone could buy your neighbor's house that's exactly like yours for $100,000 less than what you owed on your mortgage, I personally know people that's what happened, and they just stopped paying. They just said, you know what? I want what they can get. I don't want this overpriced debt, to have a mortgage payment that is worth, so much more than my house is worth. What you're saying is the possibility that hyperinflating or devaluing the dollar would cause home prices to go up. What would happen in between? Like what kind of implication would that be on our jobs market?
Well, let's say we engineer a declining currency from here. In other words, we make the dollar a lot less valuable by creating a lot of new dollars and taking on a lot of new debt. And so the dollar falls, which is inflation. In other words, the price of the stuff you normally buy, your cost of living, goes up dramatically. So picture 2022 when people were hoarding toilet paper in Costco and buying as much as they could of everything because prices were suddenly spiking and nobody knew when they were going to come back down. So picture that, but as the new normal, where the dollar is decreasing in value by 10%, 15%, 20% a year or whatever. If you've got a lot of debt, that actually helps you. So the logical conclusion, the logical action that flows from predicting that the world is going to be kind of like that is to go out and borrow as much money as possible. Buy the biggest house possible, buy a leveraged stock portfolio, do whatever else you can with debt, because the debt that you're going to pay off is going to be way cheaper than the debt that you took on. That logically flows from the idea that we're going to have inflation, but it's a really dangerous thing to do, and I would not recommend it to people. But in the housing market, that would manifest as home prices not falling and maybe going up from here, which is kind of counterintuitive because they're already unaffordable right now. But they're doing that because the dollar is going down. So we're measuring houses with a different yardstick. And the price using that yardstick goes up and up, and house prices get higher and higher. But at the same time that's happening, your cost of living is going way up. So it could be that the affordability of your house, in other words, how easy it is to keep your house well maintained and pay the mortgage and pay the taxes and everything, that goes up more than the supposed market value of the house goes up. and then the rest of your living expenses are going up even more. So you don't make out in that kind of a situation. It's not, oh, my house is more valuable and therefore I made a good deal. It's my homeowner's insurance just went through the roof. Jesus, and my taxes, what happened to my taxes? And I need to get a new roof put on, speaking of roofs. And I thought it was going to cost $12,000 and they're quoting me $29,000 right now. That's going to be life for homeowners. So the fact that the sale price is a little higher does not make it a good situation to be a homeowner. Inflation makes everything hard for everybody except the super rich. Like if you're already rich and you own a bunch of trophy real estate and blue chip stocks and gold and silver and you've got your own island, and et cetera, then inflation makes those things become more valuable. So you make out. But if you're a regular person, you've got a house where insurance and taxes are a big part of the living equation, then you get burned. And so that's the kind of environment that I think is most likely if we try to inflate away the world's currencies. So yeah, you've got a house, but now keep it. Pay the money that you have to pay in order to keep that house, and suddenly things don't look so rosy. So I don't know what the investment implication of something like that is as far as real estate goes, because if you pick a really good rental house, then you probably do okay because you can raise your rents enough to keep up with taxes and insurance and everything. But if you're just living in a house and you're paying a mortgage, which is okay, but your taxes and insurance go through the roof, well, then that means your cost of living went way up, and that means your life got much harder. And it means you can lose everything if you can't pay all the fees that are associated with homeownership. So I would draw from this that we should be very careful with our own lives and our own real estate decisions, because it's very hard to know what a good deal is in a world that's getting more and more chaotic. And but if you're very smart, if you're a very smart landlord, there's a chance that kind of an environment is good for you. But you're still dealing with insurance, and you're still dealing with taxes. So it's not utopia. It's just something where you might be able to have the pricing power to stay above water in that kind of an environment. So I don't know. I'd like to be more optimistic, but very few things are going to be easy to manage in the world that seems to be coming.
I think of, just listening to you talk, I think about, we're talking about asset prices. So, having a depreciating asset is a house that does need continual repairs and upkeep. And I think about if I need to spend more of my money, I have inflation, the prices of homes are going up, the cost of repairs are going up, and I have to spend more of my money there. I have less money to spend anywhere else. And so that's going to affect the economy overall by this inflation. That's where I see it coming around and biting us. But I see that impacting the jobs market in a very negative way also. I mean, do you agree with that? Do you think, in order for just now, not even printing more dollars, not even creating more inflation, we already have an unaffordability crisis where, we would literally have to give people 40% raises in order for them to just get by in a lot of cases. That turns into what I see as like a vicious cycle, because if people are spending more on their houses, at least for an interim period of catch up, what does that look like? Do we see inflation and then massive layoffs because people can't afford to do anything but pay for their place to live, which is happening now?
Yeah, what inflation does is it divides society into haves and have-nots, which is basically what we've seen since 1971. That's why we have so much inequality right now, because the guys who own the assets make out during a period of inflation. The stuff they own goes up in value, while the people who are working and just living paycheck to paycheck find that their cost of living is going up faster than their wages. So yeah, what happens at a certain point in an inflationary period is that people just run out of money, or the vast majority of consumers just run out of money. And that's happening right now because the savings rate has plunged in the US to close to zero. In other words, we're not saving any new money, and credit card debt is going through the roof, which means we're putting day-to-day life on plastic. And that the debts that are related to credit cards usually charge 20-25% a year. So that is a very quick recipe for bankruptcy. If you put a lot of money on credit cards, don't pay it off, then the interest eats you alive. And a growing number of people in the US are in that kind of a situation. So the idea that we're going to grow organically, in a sustainable way going forward, driven by 70% of the economy being consumer spending, out of the question now, because consumers are tapped out. So pretty much whatever the government does from here on out, consumers are a big problem, because if the government, tightens, raises interest rates to protect the dollar, then that gets a lot of people thrown out of work. A lot of the leverage plays out there don't function anymore, and so a lot of people get thrown out of work, and so unemployment goes up. If we cut interest rates and try to generate a lower dollar in order to pay off our debts, then that increases the cost of living for all those same people who are just getting by, and maybe they still have their job, but they're falling 2 or 3 or 4 or 5% behind each year. In other words, their income gets less and less able to cover their costs until people just stop spending money. And you're seeing signs of that all around the U.S. right now, because companies like Walmart and McDonald's are actually doing not bad, because the people who used to shop at higher end places can't do that anymore. So they're falling a couple of rungs down in the consumer ladder, and now they're at they're basically down there in the dollar store territory in a lot of cases. And there's nowhere to fall from there. Well, I guess, thrift stores come next, but basically people are less and less able to buy the stuff they used to buy. So they have to choose cheaper things. And that's much less profitable for the companies of the world out there to sell the low margin, cheap stuff. And that's where we're headed. It doesn't seem like it's going to take much longer, based on how credit card interest is just going through the roof right now. It's a straight up parabolic line. And, there's nothing out there that offsets that, because student loans are seeing rising default rates. The car loan business is starting to roll over. Cars had a really nice little boomlet there. And now auto sales are starting to slow. Fewer auto loans are being taken out. And the ones that have been taken out in the last couple of years have been at really high interest rates. So, it's something like, I forget the stat exactly, but it's something like the number of $1,000 a month payment car loans used to be pretty minuscule. And now it's a big part of the market. There are all these people out there with massive car loans over long periods of time. They call them car mortgages.
7 years.
Yes. Yeah. That's a crazy amount of time to be paying a lot of money on a depreciating asset that might only last 10 years. So people are being boxed in by the financial world. They're putting a lot of money on credit cards. They need a car to get to work, so they're having to take out a loan for that car, but that's eating them alive too. It's just becoming a very hard time for most people. And there's nowhere that can lead unless we go back to stimmy checks on a vast scale. If the government says, okay, we're going to pay you $2,000 a month forever, which then stops being stimmy checks and starts being universal basic income, UBI, which is another borderline, well, it's understandable, but also incredibly destructive idea that's being tossed around out there. But barring stuff like that, the average person's trajectory right now is rapidly approaching bankruptcy in the US. And let there be a recession where a bunch of those guys get thrown out of work, and then that just accelerates the process. So that's what taking on too much debt does to you. It means that whatever sector you look at, there's a huge problem, and it's related to excessive leverage. So we did it. We spent basically 55 years since 1971 borrowing way too much money, creating way too much currency, and now we basically have what you would expect us to have if you put the bankers in charge of the government. We have a society where the banker's product, which is debt, is everywhere. Everybody has bought the banker's product, and we're all deeply in debt, and they're making tons of money on interest right now. But we've reached the end of that process where it can't go much further, and that's when things get really crazy, because there's no plan. The banks don't have a plan for getting through the next 10 years if the people who've been borrowing can't borrow anymore and cannot make their current payments. So look for higher default rates on credit cards and on auto loans and on student loans in the next couple of years, and look for that. If nothing else causes a recession before that, that will cause a recession. So one way or another, major slowdown coming, and it's all related to too much debt.
When you're talking about debt, obviously just recently, from 2020, March of 2020 through Tuesday, October 1st, student debt payments were either suspended, or in 23, they became optional to some degree, paying back your student loan. I think it's an estimated, I think the government has provided 92% or thereabouts of the student loans in the market. And that's a lot of money. I think it's like 43.5 million student loans out there or something like that. And now that they have to start paying this back, or it will have a negative impact on them, implication as far as it's going to ruin their credit. They're going to have debt collectors. I think when you hit default, it escalates, and the whole amount's due. When we look at J-Pal talking about, soft landings and economists saying, yay, it's been done. I mean, we achieved this. Over the last 4.5 years, this is a big number of people that have not been paying their student loan debt back. And even if it's only a couple $100s a month that's circulating in the economy, I mean, they're consumers. They're buying things, keeping things moving. Now yanking that back out of the economy, however much debt that is, right? And making them pay the loan, it's going to take it. We're going to see a massive slowdown, I believe, with that. But I mean, could it be that one single suspension of paying student loans for 4.5 years, could that be one of the reasons why the economy hasn't crashed?
Oh yeah, that was a big part of it, but it wasn't just student loans. During the pandemic, the government said, okay, you don't have to pay your rent anymore, and you don't have to pay your student loans, and we'll send you free money. We'll send you stimmy checks. So what happened was, starting in 2020, Americans built up a big balance of what economists call excess savings. In other words, that's more money in the bank than would be expected for you to have if prior trends just continued. So we came out of the pandemic with a lot of extra cash to spend, and we spent it. That excess savings have gone down from, I think it was $1.3 trillion, but I'm not sure about that, down to zero and now negative. So we spent all our extra money, and a lot of that was what we saved by not paying on our student loans. And now we're putting our day-to-day life on credit cards. So yeah, if you took somebody who already has to put food and gas on plastic and just leave it there, if you took that person and said, well, now you have to pay $400 a month on your student loans, they don't have that money. So they either default or they go into even more onerous forms of debt to cover it. So either way, they're not taking nice vacations. They're not buying SUVs. No flat screen TVs for those guys. They're just basically debt slaves. They are paupers now, or serfs on a plantation, or whatever metaphor you like to use for somebody who is now completely controlled by a small handful of elites, because they borrowed so much money from the institutions that are run by those elites. And that's our world now. It's a growing number of people who are in that situation, and there's no fix. Unless the government just starts giving them money again, there's no way out for those people. So that's a recipe for a recession, or something a lot worse than a recession.
A lot of these student loan debts, I mean, the people were expecting them to be forgiven, and there was so much talk about forgiving a lot of these loans. So people were really taken back, and had been, it's just a mess that's created. It's a manufactured disaster, right? It's a mess. So if you look at it, you go, okay, if you have to pay the debt back, and you have 4.5 years essentially, or 3.5 years, because last September, the interest started growing again. But if you give somebody, they have $39,000, $40,000 student loan debt, and you say for the next 3 years, 100% of the payments that you make will buy down the principal. Nothing will go to interest. If you were financially astute, you would pay that down as much as you can. You would be doubling down. You'd forget the $7.50 coffees, the eating out, the whatever. You would be jamming the money into those student loans to get them down. But most of these people were living on the, with the assumption that, hey, they're going to come out with this debt relief program and I might not have to pay it. I don't want to be penalized. I mean, God forbid that I actually pay back my obligation. I want this to be wiped away. And hey, who wouldn't? I mean, geez, let me rack up $40,000 in debt, and whether I finish college or not, but I rack it up, or credit card debt, and then all of a sudden they say, hey, Todd, don't worry about it. Or John, you don't have to pay that back. We're going to forgive you. Why would you pay it? You'd be an idiot. You'd be like, why do I want to pay that back and penalize myself and deprive myself of other things? Now, for many people, this isn't the case. I get it. They're struggling financially, and it's everything to them, and they're going to default probably, with it coming back online. They're going to be in the same position they were maybe 4.5 years ago. Kind of getting back to this, there hasn't been a bailout on this. What do you think is going to happen over the next, that we have this election that is knocking on the door? some of the people that I talk with, they go, you know what, Todd, it doesn't matter who the president is. It's going to nothing. This thing is destined to, implode. Just like when Obama was sworn in, right? Took office, he inherited this, ginormous debt and collapse of financial institutions. If you had to look back and say, okay, back then the bubbles are way bigger now. If you had to give a prediction, what do you think is going to happen in the next 12 to 18 months?
Well, I don't think they're going to cut student debt. It's too late for that, and there are too many legal issues around that because apparently the federal government, the executive branch, does not have the ability to just change a contract like that. So they're not going to cut student debt before the next election for sure. And I don't think, if the Democrats win, they'll keep trying to cut student debt because it's a good issue for them. If Republicans win, they absolutely will not cut student debt because when you eliminate student debt, basically you're asking the plumbers and the electricians and the guys who didn't go for expensive four-year college degrees to pay for the people who went out and got a psych degree or a sociology degree or whatever, and now they're a barista at a coffee shop. So it's a political advantage for each party to take one side of that debate, but it doesn't really matter financially any of this right now because whoever's in charge is going to run multi-trillion-dollar deficits going forward no matter what. Because for two reasons. One is they never got their act together in the past, so we're on that trail or on that track. And the other is that boomers are retiring now. The cost of caring for the biggest generation ever is going to go through the roof. It is already starting to go through the roof with Social Security and Medicare. So there's no way that government spending can be controlled in that kind of an environment. Which means there's no way that government borrowing can be controlled. So we're going to run big deficits until the thing breaks, and we don't know where it breaks. But the mechanism for the course that we're on right now to be derailed. In other words, we hit a wall of some sort, and then the system has to be rebuilt or recreated because the old system doesn't work anymore. That process has to do with the currencies because basically what we're doing right now is, and Trump has said he wants to do this too, he wants much lower interest rates than exist right now. So he would run big deficits and force the Fed to lower interest rates, just like the Democrats would. So that part of politics almost doesn't matter. There's lots of other parts that do matter, especially foreign policy. But financially, we have institutional momentum right now. The system is going to do what it's going to do until it breaks. And the breakage will be about currencies. In other words, we'll start generating higher and higher rates of inflation, which is to say the value of the currencies will start to plunge till it becomes disorderly. And then at that point, you do the currency reset, where you scrap the old system and say, okay, from now on, this is how money works. And you hope, or we hope, that the guys doing it do it wisely. And we hope we survive geopolitics in the meantime. If we have World War III, none of this finance stuff matters. But if we can stay at relative peace while this plays out, then we've got a financial crisis that we have to deal with.
What does a financial crisis mean to the average American? Let's say that we do get to the point where the system breaks, like you said. I mean, I interview a lot of people. I hear you talk about precious metals, basically not as an investment, but as a way to protect your money. But if we do have a societal breakdown, some kind of a financial collapse, and you talk about these things, we've talked about them together. I mean, some of the realities that are possibilities, they're quite scary. I mean, it's they're harsh. And we talk about homesteading, and we can't, John. We're a society that's completely forgotten. How to do anything, right? If we go back, if we just look at if the internet went down. I mean, I remember when that CrowdStrike, I was traveling, I was going to see Peter Schiff at his house in Connecticut, and me and my team, we get to the hotel on a Sunday, and it's like 10 o'clock at night. Now, CrowdStrike went down on Friday, and by Sunday, this hotel we were staying at, which was like a Holiday Inn. I mean, it was a big brand. They were completely shut down. They had no systems. They weren't back up. I mean, they couldn't give you keys. You had no security. It was almost like, it was kind of like on a small scale, very freaky. But if we go back 100 years, which is not that long ago, I mean, we're talking about my great-grandparents, right? Your great-grandparents. I mean, we're not going back, hundreds and hundreds of years. 100 short years ago, literally, like in 1925, only about half of the American houses actually had electricity. 100 years ago. And it wasn't until like 1920s that indoor bathrooms became code in new homes. And I think in 1940, nearly half the houses lacked piped hot water. Can you imagine if you had to take a cold shower, or you heat the water up in in a bowl and give yourself like a towel bath or a washcloth bath, in the wintertime, right? We didn't have the hot showers, the steam showers, and all the luxuries that we have now. But back then, we still managed to live. We raised families. We had chickens. We had all these different things, right?
Well, if the power grid went down, see, now we're getting into external shocks that could give us this crisis ahead of time before finance does. But yeah, if the power was to go down, which could happen, we saw that it could happen with cyber attacks. Also possible is an EMP attack where somebody sets off a nuclear warhead in the atmosphere and that fries all the electronics. And then just, an overloaded grid goes down or something like that. All of these things are possible. And if it was a serious thing, like if it was a total outage in the US that lasted a year, well, 1925 technology could support about 100 million people, maybe. So what are the other 300 million going to eat? Maybe each other at that point. Watch these dystopian movies. Not the Walking Dead so much as there's a series that I think the first one is 1 Second After or something like that, and it's about an EMP attack on the U.S. that basically just shuts down electricity and does so for decades because a lot of the equipment that we need to get our power grid back up is made by China. So and it goes on from there. But tens of millions of people starve. The rest are in various kinds of little warlord-run dictatorships, and it's a nightmare. But it's also realistic. That's what would happen in the extreme case of the power grid going down. But a less extreme case is a lot more possible or a lot more probable because there are all kinds of bad actors out there and technology that's overloaded, et cetera, that could knock the power out for weeks or months. That's completely possible. And see that you don't even need a financial crisis for something like that to throw your life into chaos. You just have the power grid going down. But then that would via all the bad debt out there that would go bankrupt if we had let's say we had a 6-month power outage for 1/3 of the country or something like that. That would bankrupt so many people. It would be the domino that knocks down the rest of the financial dominoes out there, and we would get a 1930s style deflationary depression. That's that, and we would get it fast too, because everything happens on internet time now. These bankruptcies that used to take a long time to work out now just happen in a heartbeat. So that's a possibility too. And as for what you do with it or do about it, you mentioned what we should be doing about it. We should kind of be looking at how our grandparents lived, and thinking about what we can adopt from that lifestyle. What's possible? Like if you're in an apartment, obviously you can't have the big garden that your grandparents had. But if you've got a house with an acre or something like that, you can be 50% food self-sufficient, and you really should do that. And if you don't know how to do basic wiring or drywall, you should probably learn how to do that, because those are the kind of things that will be extremely expensive relative to your income in some kind of a crisis. And if you can do it yourself, you are way ahead of the average person. Same thing with working on a car too. If you can fix your car's brakes, and you don't have to wait for an overloaded local mechanic to be able to get to you, it'd be good to know how to do that. So depending on how scared you are about what's coming, and therefore how motivated, there are tons of skills that we can all acquire that make us more resilient, and also just make us better people. Because really, if you're involved in your community and you're fixing things instead of just replacing them with something that you used a credit card to buy, you're a much more valid human being than a lot of the people are now. We've had it so good for so long that we actually got the idea that we don't need to be living near family, and we don't need to be embedded in a community, because we're always going to make enough money to pay for the stuff that we need. Therefore, let's live in a condo in San Francisco, never get to know our neighbors, and our rest of our family is 2,500 miles away, and that's okay. And people who've chosen that lifestyle are at the most risk. And the people who are living in like multi-generational houses or in a place where they know everybody in their neighborhood and there's some family nearby, that's a way safer lifestyle than what a lot of people do now.
Talking about being able to fix things on your own. I mean, you actually feel really good when you build something or make something or fix something. It's like a sense of accomplishment and pride that you can't get doing anything else. I mean, I feel like most of our society is so unsatisfied. I mean, all we do is want, right? And we have to have everything, the latest and greatest. And we kind of really have gotten, if you look at over the last 100 years, we've advanced in a lot of different ways. But we've also destroyed ourselves and have become a lot more miserable in a lot of ways, and really forgot what life is really all about, or living. And speaking of the power grid, solar flares. I mean, I interviewed David Tice that him and Dennis Quaid developed this documentary called Grid Down, Power Up. And, he talked about solar flares. So he says it's not a matter of, if we just look at that, the grid situation, a lot of things that we're talking about have a lot to do with power and greed and things they can be controlled. But if you think about something like not being prepared for a solar flare, knocking out a power grid, that in itself could be devastating. And he says that nothing's really being done at scale. And like you said, these transformers, they take like 18 months to even get. So it's not like, and by the way, he says that the ones that we have that are from China, there's like no regulation of knowing what's in the back end of it. Can they be shut down? Of course they probably can, in the event of any kind of a, conflict or whatever. What do you think we're going to look? I mean, what do you think the U.S. looks like? I know this is a crazy question, man, but talking to, somebody like you, we can have these conversations together. I mean, John, what do you think the U.S. will look like 10 years from now?
Well, actually, let me say one more thing about the solar flare thing, because that's a really good point. Because I don't know the exact details of this story, but apparently the sun put out a really dramatic solar flare not so long ago, but it missed us. And it could easily, just if we were over there on that side of the sun when it went off, would have fried all our electronics. And that's the kind of thing that is just Russian roulette, right? It's just a random number generator with the sun putting these things out. One of them's going to hit us eventually, and it could be brutal. You're right. It could be the same thing as an EMP going off in the atmosphere. So anyhow, what do we look like in 10 years? There's no way there is no specific way that we're definitely going to look, because there's so many possibilities out there. So many things can go wrong and so many things can go right. And the biggest thing that can go wrong is geopolitics. We are right now on the verge of a shooting war with Iran, because Israel just attacked Lebanon, which is a client state of Iran. And this morning, the headline was missile attack from Iran on Israel imminent. The second story was America moving troops to the Middle East. So we're that close to a war that would be totally destabilizing. And, you get us into a shooting war with Iran, or God forbid, Russia or China. And the effects of that are not going to be gone in 10 years, because so many bad things can flow from that. And I think the biggest would be that financial crisis, because if we start shooting at a nuclear power, Russia has more missiles than we do. They could literally wipe out all life in the continental United States. And if we start killing their soldiers and they start killing our soldiers, then we're one step away from something like that happening. And if you've got a big tech stock portfolio, right, or any kind of risky assets out there, the first thing you want to do is get out of the risky stuff and get into safe stuff. So you would see an absolute collapse of the NASDAQ, big part of the S&P 500. Junk bonds would just evaporate, and government bonds around the world. Any government that isn't rock solid financially, nobody's going to want their bonds in that kind of a circumstance. So you would see the financial market just tank. And we're one more headline away from something like that right now. So that's the worst case scenario, barring a full-on nuclear war for the next 10 years. That we have a geopolitical event that we bring about through our own stupidity that crashes the financial markets and takes us a really long time to dig out from that. So that's one. And then the other is it's just a financial crisis. The geopolitics is okay. Nobody takes out the power grid or anything. And then we have a couple of really tough years followed by a currency reset. And 10 years out, things might be basically okay, because basically everybody who trusted the government in a currency reset is impoverished, because the money in the bank account, the money under the mattress becomes a lot less valuable when you devalue the dollar and go back to the gold standard or whatever. But they're alive. Those people are alive, and they're living in a country where the money is sound, which means they've got a pretty decent chance of rebuilding. And that's where we would be. We'd be a much less rich country, but one where the trajectory is at least understandable and positive. So that's the monetary reset is the best case scenario. And then there's lots of stuff in between where, the financial crisis is much worse than it has to be because we make stupid decisions and screw things up even further and trying to, keep a recession from turning into a depression, stuff like that. So there's a spectrum. All of it can be planned for with the same set of actions, right? You want to own gold and silver because this is it's a period in which the currency system is breaking down. So own the old kinds of money that governments can't create out of thin air. So be buying those gold and silver coins, just stack away. Look at the gold and silver and other commodity-based stocks out there. Uranium stocks are looking great right now. So is copper. To an extent, so is oil. So the gold miners and the other commodities stocks, and then develop skills that you personally feel like you might need. Look at your own skill set and fill in the blanks. Get closer to the people in your community. These are all things we should be doing, but we should be doing it just because it leads to a better life. Like even in great times, we should be skill stacking. We should be getting to know our neighbors, making friends with them, and making sure they know that we got their back, so that they have our backs. And that's how again our grandparents lived mostly, and that's psychologically so much healthier. So even if everything turns out great, the whole world is borderline utopia in 10 years. If you own a bunch of gold and silver and you know how to rewire a house and how to do drywall and how to fix brakes on a car, and you know your neighbors and you've got family living nearby, and maybe you have some of the younger generation living in your house with you. You've got all those things. You lived a good life and took good steps over the last 10 years. You're happier than you would be otherwise. So I think there's really no downside to prepping for a gigantic crisis because it leads you to do the things you should be doing anyhow. And so that's basically the optimistic mindset for all of this, that you're acquiring skills and getting closer to people that you're going to need in the future. You own the kind of money that is going to maintain its value or go up dramatically in value, but not fall in value in the next 10 years. And you're basically okay financially and socially, and that's if that's the lesson we take from this, then our personal situations will be a lot better in the US 10 years from now than they are right now.
Well, both of my grandparents on both sides of the family, my mom, my dad's side, were products of the Great Depression. And I was, very close with my mom's parents. And my grandmother, she always said, plan for the worst and hope for the best. And she meant that in simplistic ways a lot of times, even with just, going out in the evening, or just being prepared. And, there's so much to learn from that. And then also, how they lived. I mean, you're exactly right. I mean, it was a community, people, they knew what each other could do, what their strengths were. They pitched in, they helped. And it was just a very interesting time. I grew up with my grandparents, and it was just a very interesting, life, background. And the other thing that comes to mind, you talk about Iran. I remember going through my broker classes, and my instructor was from Iran, and originally from Iran. And so English was his second language. And he always used to say in class, and it was only, I don't even remember, maybe 3 or 4 months of classes with this instructor. And I remember very vividly, we used to talk about different things in class, and geopolitics would come up, and he would talk about what it was like to be in Iran, and as being Persian, and he said one thing that the United States doesn't want is a war with Iran. I mean, that was that was of all the things that he said, that was one thing that just continually stands out now when I think of all this conflict going on in the Middle East is what he used to say.
Well, yeah, because among other things, a war with Iran means a shutdown of Middle Eastern oil. So that means $150 a barrel oil, $10 a gallon gas. That will throw a country into recession right now. So even if it doesn't spread and it doesn't kill a lot of our soldiers or anything, it still maybe breaks the economy. So yeah, we definitely don't want a war with Iran for sure. Your grandparents were very smart people, obviously, right? Because mine were the same way. They basically came over from Italy and replicated the Italian peasant lifestyle. They got some lands, they had chickens, they had a big outbuilding where there was a workshop. And, that's the life that a lot of people aspire to now. To me, growing up, I thought, that's how poor people lived. I was going to make money and live in a big house. And now I look at what they did and thought, well, yeah, we should probably be doing exactly what they're doing. So it's funny how life is so cyclical.
We had a vegetable garden every single year, a big one, a very small yard, a very large garden. We had a couple apple trees, a pear tree. We had grapevines. We had chickens. We had ducks. We actually ate duck eggs. I mean, it was, a lot of people have never had a duck egg, but it was just and I didn't live in, believe me, I didn't live in some rural backwoods spot. I mean, we were right in the middle of I grew up in Reisterstown, Maryland. And I mean, it was like the city. Main Street was right out our front door. So this was not, but this is how they lived as a product of the Depression. They knew what it was like. I mean, my grandmother would save, there wasn't one scrap of food that went in the garbage can. She kept we ate, we had a night of leftovers, right? And she would make something together and kind of throw it all in. But I think I hope we can learn something by this, John. And, and what comes to mind too, when I think about people living in apartments, I think the idea is to have a skill of survival, right? Know life's basics, be able to provide for yourself. Because if we had a grid go down or something like that, right? I mean, it wouldn't even matter if it was your yard or not. You would be gardening in public places, right? You would just go out and dig. You would do whatever it took. But if you had absolutely no idea how to even grow a plant. So, I mean, even if you're in an apartment, you could grow plants on your patio. You can grow tomato plants on your patio. I mean, there's so many things to do. You can have window boxes. You could grow things inside. But I think that's interesting. So you had mentioned gold and silver, and I get a lot of people that ask me this because of the nature of my show and the people that I speak with, and they're really confused over the gold and silver stuff. They think about Bitcoin. Everybody's saying that Bitcoin, that's going to be the way. And you know what? By the way, they had the Bitcoin conference in Nashville, Tennessee, and RFK spoke at it. Trump spoke at it. I mean, they're all like, hey, the first day in office, we're going to do this or do that and switch everything over to Bitcoin and rah, rah, rah. But, everyday people, or at least I'd say middle-aged people, are confused about Bitcoin. And then there's the other thing, John, and which is coming up is this convention, this BRICS convention that you had mentioned Russia or whatever, and us maybe pissing them off, or, and the world, a lot of countries are joining the BRICS nations trying to reduce the world's dependency on the dollar. Can you kind of give us, for those that are listening that may not understand? And by the way, guys, John has an amazing Substack. Actually the link to Substack is below. We always publish it. Top line of our comment section here. I get John's Substack. I highly recommend it that you sign up for that and get his books too. I've read his books. I don't make money on his books. I'm just telling you they're very. He's a great author and I really enjoy his work. But can you kind of give us some education for the people that are you've got the gold, silver, precious metals, you have the Bitcoin, and then you have this threat of currency collapse or whatever, the BRICS trying to reduce or the world's dependency on the dollar. Can you kind of just give us a little bit of each of those? And when you talk about gold and silver, do you talk about the physical gold and silver? Because a lot of people are confused, like, hey, should I trust somebody? Should I have my own gold in my possession? Just kind of give us some education on that.
Sure, because it's a fascinating time now in the money world. You got a lot of different theories being tried out. Now, Bitcoin and the other cryptocurrencies are basically digital assets. They don't exist in the physical world. They are basically computer code that is kept track of on something called a blockchain, which is a distributed ledger. Like when you complete a transaction with Bitcoin, that transaction goes out to thousands or hundreds of thousands of computers around the world that note that happened. And in that way, you keep track of it. Nobody can falsify that because it's everywhere on the blockchain. So they call that it's immutable. Once the deal is done, it's done. Everybody knows how much Bitcoin you own and what you did with it and everything. And conceptually, I love the idea of a private sector technology-based currency that isn't subject to any one government's regulation. It's an amazingly cool story. And that's why it's getting so big, because the concept is awesome, And Bitcoin is spreading. There are countries that are dabbling in calling it legal tender and lots of companies being willing to take Bitcoin, and lots of investment houses creating investment products using Bitcoin and other cryptos. So it's kind of emerging organically, and we'll see where it goes. Now, I don't understand it well enough to be able to predict what happens when governments perceive it to be a threat and attack it, as they inevitably will, or co-opt it, one or the other. What happens if, like you and I talked about, the power grid goes down and internet is out for a month or whatever? How do you access your Bitcoin, and how do you use it to transact in a world where you can't get to the internet? And so those questions have to be answered, and they're being answered. So we'll see. Bitcoin is going to do very.
Can it be wiped out?
Can it be? Yeah, we'll have to see, because it's a brand new thing. It's an emerging asset class, so it has to be tested, and it has to pass those tests before it thrives. And so we'll see. I think it's possible, and I just don't know enough about it to give you a definite answer or a definite prediction. Now, on to gold. Gold is sort of the exact opposite of Bitcoin, because gold has been around for thousands of years. It's an inert rock that is very rare and is incredibly useful as money. It's been society's money for 3,000 years because it holds its value. We dig about 1% more gold out of the ground each year, which is to say the money supply, when defined as gold, grows at about 1% each year, which is zero inflation. So it's inflation-free money. And it's worked for a really long time. We only just went off the gold standard. In other words, a society where our currencies were linked to gold in 1971. So a blink of an eye in human history. And that experiment with currencies that weren't linked to gold has failed miserably. It's collapsing around us right now. So what's happening in response to that is fascinating from an investment standpoint. This is really the big part of the story if you're trying to decide where to put your money. But the world's central banks have decided that they want to own gold as a reserve asset. In other words, the thing they back their currency with, which used to be mostly treasury bonds, in other words, U.S. government paper, is not holding its value well enough. So they're dumping their treasury bonds and they're buying gold very aggressively in terms of how much gold there is out there. And that's part of why gold is up. You've got these central banks in the world who can create their own currency, or who have a ton of dollars sitting around that they want to do something with, and they're not price sensitive. They're still buying gold with it at $2,600 an ounce. And their buying is a big part of what pushed gold up from $1,800 an ounce not so long ago to $26 today. And the BRICS thing that you mentioned is a big part of this story, because a lot of the central banks that are buying gold are also part of the BRICS coalition. Now that stands for Brazil, Russia, India, China, and South Africa. Those are countries that are basically sick of living under the thumb of the US dollar. The US uses the dollar as a weapon against other countries, and that's making them really mad. They don't want to risk being kicked out of the SWIFT international bank settlement system like the U.S. can do to them if they want, or they don't want their exports to be sanctioned, so that they can't sell computers or uranium or oil to anybody, and they lose incredible amounts of money because of that. So what they're thinking about doing, the BRICS coalition is meeting on October 22nd, and what they're looking to do is create a parallel monetary system that doesn't involve the dollar. And one of the things they're threatening to do lately is to create a gold-backed currency that they use for trade with each other. So they don't any longer need dollars if they want to buy oil, for instance, or they don't end up with a big pile of rupees in exchange for oil that they don't know what to do with. So they have this gold-backed currency that derives its value from gold, therefore it's very predictable, it holds its value, and they'll use that as their trading currency. And that's a big threat to the dollar. That's liable to send a lot of dollars that are out in the world back to the U.S. to buy U.S. assets, which would be super inflationary for us. So that's the story with gold as a monetary asset that is going up in value right now. Now, if you want to buy some, here's how I think you should start. You go with the safest in-hand option, where you get physical gold. You just buy gold and silver coins. Silver is basically the same story as gold. So anything I say about gold, think of it as applying to silver too. So you buy gold and silver coins, put them in a very safe place, and that's the bedrock of your finances there. You got money that is going to hold its value for the next 100 years or the next 1,000 years. And you can hand it off to your family 50 years from now, and it'll be a good thing to hand off to them. And then from there, you branch out a little bit to things like physical ETFs, which are they trade like stocks, but they're basically companies that go out and buy a bunch of a commodity, like let's say gold, put it in a vault, and then you can buy their stock and you own a share of that gold that's in a vault. And that's, you know, to the extent that anything in the stock market is safe, that's relatively safe. Certainly safe compared to tech stocks or mining stocks or something like that. And then from there, once you've got some remotely stored gold in a place that you consider safe, then you branch out and maybe you buy gold mining stocks or silver mining stocks. And same with the other commodities. We don't have time today to go through the stories of each of the big commodities, but some of them just have phenomenal stories. You hear about what's happening in the copper market, for instance, and you really want to buy copper because it's such a shortage. There's not enough copper to do what humanity wants to do. So its price has to go up. Same thing with uranium. So you buy physical ETFs that allow you to own physical uranium or physical copper, because you don't want to own those things directly yourself, certainly not uranium. But you buy physical ETFs in those commodities, and now you're branching out into a portfolio of real assets, things that governments can't make more of, therefore that will go up when the dollar goes down. And you can go on from there. There's all kinds of other things you can do further out on the risk spectrum, but also on the profit spectrum. There are things where it's a little bit more risky, but you might make 5 or 10 times your money, which is more than you probably make with just owning physical gold or uranium or copper, but with a little more risk. So you think through what kind of risk you can handle and which things you want to own, and you build your portfolio in that way. And that's on my Substack newsletter. We look for ways to do this in a coherent, relatively safe way, and there are a lot of them.
Yeah. Well, I thank you. I always enjoy our conversations, and I think we stayed out of trouble today. I don't know about you, but I think we managed to do that. And guys, like I said, check out John's links below. Subscribe to his Substack, and I promise you won't be disappointed. And my friend, I'll see you next time.
Great. Look forward to it, Todd.
Well, thanks for watching. If you enjoyed the podcast,
by at least 150%, and that in 40 years' time, the markets would have gone nowhere when adjusted for inflation. Here to give us his thoughts on the economy, gold, the fate of the dollar, the US elections, and how we're in an era where even a fact is no longer a fact is Dave Collum. Dave, welcome to Kitco and to On the Spot. Very good to have you with us.
Oh, I'm glad to be here. I'm a big fan of Kitco. Right? You've got many good analysts there.
All right. Well, we're thrilled to have you with us. And I'm curious to get your thoughts on a number of topics, including the latest inflation data and how that fits into your overview of the economy currently. But before we do that, why don't we start off with an overview? What is your point of highest conviction right now?
Well, the point of highest conviction you already hit, and that is that the markets are way overvalued. Someone once said, who's the Dow theory guy? Richard Russell once said, why can't they just keep going up? And he had a great metaphor. He said, go into your kid's room, start stacking blocks. And just keep stacking what happens. And eventually the stack gets so high, it becomes very shock sensitive. And then so some subtle vibration causes the whole thing to fall. You end up with a big pile of rubble. So the further, what any chemist or physical scientist will tell you is that the further from equilibrium you get, the more violent the return and the more destruction that occurs because of that return. So that's what a bomb is, a bad earthquake, a hurricane. There's a good one for you. So it unleashes this huge amount of energy that's pent up in the system. And so overvaluation is appreciation that has been pulled forward by the more overvalued, the larger number of years. And that appreciation is going to be eventually given back, or you're going to have to wait for it to catch up. And 150% is too much. So that's the first. Second is I think the economy is starting to roll over, despite what some people say. I think all the indicators say that we are rolling over.
What do you mean by rolling over?
If you look at official statistics, you don't get a good read because it's election year, and I think the official statisticians lie their tail ends off. So I don't trust those. But if you look at, for example, commercial real estate, it's in a disastrous state right now. If you look at numbers that are below the radar, so instead of looking at national job numbers, which turn out to be dominated by new government jobs, and those are worthless jobs, that's busy work. If you talk to anyone about what's really going on at the street level, you find out that businesses are having trouble, they're struggling. And so I think, and I'm not alone in this. I'm like Stephanie Pomboy, and there are some bears out there who say this exactly the same thing. So I think in 1991, there was actually a poll done of 51 economists, and they said, are we going to have a recession this year? And the economists all said no. And it turns out that the poll was done. At the point the poll was done, it was later found out that we were 6 months into the recession. So one could argue that if we wanted to save money, we should stop paying economists.
Well, again, it always depends on how you define a recession and by which data and by which metrics. The technical definition, 2 quarters of negative GDP growth.
Yeah, I don't like that one at all, but yeah.
And we've had many guests on the show that have made the same point, especially when that GDP growth is inflated and is not really connected to what is happening on Main Street and in the everyday lives of people. But before we get into your breakdown of this 150% overvalued, I want to talk about some of the data that we do get and the kind of picture that it is painting, as murky as it may be. And we just got our last major inflation report before Election Day on November 5th. The consumer price index rising 2.4% from a year earlier after rising 2.5% in August, according to the Labor Department. And that was above the 2.3% year-over-year rise that was expected. So hotter than expected. Core prices, which exclude food and energy prices, up 3.3% year-over-year, and more than the 3.2% rise seen in August, also above expectations. Now, of course, Dave, many are questioning the metrics used to measure inflation in the first place and how accurate it is. But big picture, what is your read on this?
Well, I think the numbers are dishonest. They're not just inaccurate. I don't think they're. I think we've long since passed the point where they're trying to get it right. And so let's look at how they calculate inflation. Let's start with that. So the first thing they do is they calculate the rising costs of housing through OER, which is basically owner's equivalent rent. And the way that's 27% of CPI, and it is determined by surveying homeowners and saying how much could you rent your house for. And the answer to that question is, who could possibly answer that question? Who could possibly know what their house could be rented for? And so 27% of CPI looks like it was invented by an insane economist to me. Now, there's other things they do. They do hedonic adjustments where they say, look, you've now got intermittent windshield wipers, and therefore your car is better than it used to be, and therefore we have to correct for that. And then they overcorrect for it. So they say that basically the price of cars haven't gone up. There's so much, as soon as you start putting in these fudge factors, the nefarious behavior kicks in. The one I like the best actually is called substitution. So substitution, they say if you go to the store, and let's say you went there to buy sirloin, and it's twice as much as the price of chicken, and now it's just gotten too high. So what you do is you say, well, I'm gonna buy chicken instead of sirloin, and they say, therefore, your cost of living is actually not as high as it appears to be. Now, let's think about that. If the price of beef is twice that of chicken, the free market is saying beef is twice as valuable as chicken. If you substitutionally correct for that by saying now you're going to eat chicken, don't you have to hedonically adjust for precisely that same amount because you're buying a product that is 1/2 the quality precisely? So substitution shouldn't exist at all. If you look at shadowstats.com, which I think has been demonized enough that people probably ignore John Williams, but if you look at the Chapwood Index by a guy named Bukowski, they both over the last 30 years have shown that a more traditional metric for measuring inflation, let's go to Chapwood, they take something like the 50 largest cities, they look at 500 prices in those 50 largest cities, they don't correct for anything, there's no seasonal adjustment, which I still haven't figured out what it is. And they just say, what's happened to the prices? And the Chapwood Index and the shadow stats have been running, I would say over the last 30 years, on average, maybe 5% higher than the regular inflation, the CPI measured inflation. What does that mean? There's a profound conclusion here. According to a number of smart people, over the 20th century, GDP grew 2.2%. It's not as big as people think. Now, that seems like a low number. I'll give it 3 if you want. If they say inflation is running at 3, but instead it's running at 8, if the GDP is corrected for inflation, that means instead of being positive 3, it's negative 2 because it's being underestimated by 5%. The conclusion could be that for the last 30 years, our economy has been shrinking.
When adjusted for real
inflation. Yeah. And then you look at this growth in the economy. You go, well, where is this growth? You go, well, it's in Facebook. Now, if Facebook went away today, would anyone lose anything? The answer is no, not a chance, right? Facebook is a waste of our time.
Facebook friends, maybe some social media influencers would lose their Instagram money.
But the point is that the companies today are not the companies of yore. They're not U.S. Steel. They're not Ford Motor. They're not railroad companies. They're not wealth creating companies. They're financialized companies.
Right.
I'll give Google some credit. Apple makes phones and they sell phones, so they're basically an industrial company. But if you let's look at Microsoft. They make software, right? Has your Word software improved in the last 20 years? No, it's actually gotten worse in my opinion. But here's the important point. Microsoft has gone up, I don't know, about 10-fold in the last dozen years. Now, it turns out that 4-fold of that is increasing valuation. It's just a higher price for the same revenue stream, which means, therefore, that if Microsoft were simply to return to 2013 valuations, it would be a 75% correction. And then take a company like Invideo, which is somewhere between profoundly overvalued because their customers are buying their chips and they haven't yet figured out how to make a single penny out of the product, to the fact that they appear to be vendor financing through shell companies and therefore could do a 95% swan dive for a whole host of reasons. And so there's a $3 trillion market cap that could go down within an error bar of 0. It did it in 2000. It could do it again. And that's $3 trillion out of people's pockets. So there's just a lot of problems here. I don't think, they say, The Economist, I'm going to pick on them. Some of you guys I really like, so don't take offense, but they say that their economy is 70% consumption. That's not an economy. You get to consume after you produce wealth. So if I'm on a desert island and I don't catch fish, I don't get to eat. If I don't build a house, I don't have a dwelling to live in. And so you produce wealth and then you consume because you produce wealth. You can't say that 70% of what we do is consumption. 100% of the economy is production of some kind. And the consumption is what we get to do with that wealth that we created. And so it's a silly idea. Well, then you say, well, then why would you say that? Well, because the federal government's growing their debt at 7% a year, which means that we're basically pulling consumption from the future forward. And people say, well, why can't they keep doing it? Because the dollar at some point is going to collapse, and then we're going to give it all back. We are going to give it all back in a catastrophic correction.
So I mean, you're taking issue, you sound very bearish, and we'll get to that longer term outlook of yours, but you're taking issue with not only how inflation is measured, but how GDP is measured. As you said, if you say, we always say 70% of the US GDP is consumer spending. So you're saying that the metrics or the lens through which we look at our economy is completely wrong, completely murky, completely skewed.
So here's another great example. One of the things we don't correct for is the cost per use. So I just put a 70-year-old refrigerator out to pasture. It still worked. The compressor was fine, but we got a new fridge. I'm not quite sure why, actually, in a cabin up in the Adirondacks. 70 years from now, there will be 0 70-year-old refrigerators that still run. Probably 10 years from now, there'll be 0 10-year-old refrigerators that run because the average refrigerator has a life expectancy of a fruit fly. Now, where in the inflation numbers do they correct for the fact that I just bought a reclining bed in June and the motor broke yesterday from June? Right. So where in the inflation numbers does it correct for the unbelievably high depreciation rates of the goods that we're buying now? Because when you go to the store and you buy something, it's crap.
They just don't make them like they used to.
That's right. I broke a blender from the 40s. The kind that would break your foot if it landed on your foot, a big one, these big heavy ones, right? And then I bought a new blender, which they said, well, it's cheaper, it's got more buttons, so let's hedonically adjust it some more. I guaranteed myself that blender wouldn't last 1/10 the time, which means there's a 10-fold inflation correction there. Mm-hmm. Because the per use cost is huge for the new blender. It didn't last 7 years. It lasted like 3 years. And so again, where is that corrected? Where is it corrected for the fact that when something on your car breaks, I have to replace the entire unit, not just some little piece of plastic? And so I think we're living in a really fictionalized economy, which explains why if you go to street level, people feel like they're suffering.
Right.
And you can tell them there's no inflation and talk to someone just start a conversation with someone at the checkout and say, they say inflation is 3%. What do you think? They projectile vomit.
Yeah, as you say, we've got replacement costs, and just basically the metrics through everything that we look at are distorted. But even this data, even the government data as it stands, inflation is up over 20% since February of 2020. I mean, sure, it's up 3.4%, but collectively it's up over 21% since February of 2020, and that's by the government data. That's if you add.
That's right, which means it's at least a factor of 2 off. In the book, I was thinking about this as you were starting the show. In the book, this time it's different. Reinhardt and Rogoff talk about how inflating away debt, which it's actually hard to make the case you can inflate away debt. It's actually a very difficult case to make. But they said you only have a prayer of inflating away debt if people don't know there's inflation. So hidden inflation, you can inflate away debt. Once the system catches on to the inflation, then it outruns it, and you can't inflate away the debt. And you'd have a hard time convincing anyone we're inflating away debt if our national debt is growing at 7%, if our credit card debt is growing at monstrous rates. All forms of debt are growing spectacularly. What part of this inflation is inflating away debt? We're just getting worse and worse off. And that's what happens. Inflation gets in the DNA, and you cease to be able to lie to the person and say, oh, over the last 4 years, things are up 20%. You go, excuse me, they're not up 20%. Someone like Jimmy Iorio happens to not only trade and go on CNBC a lot, but he owns a restaurant. He says he'll give you numbers like 40 or 50% minimum for his restaurant, for the inputs.
Yeah, and as you say, this perception management is starting to have cracks in it, right? People aren't buying it anymore. Perception management of government data, it's losing its efficacy there.
This is my shock face you're seeing here. This is my shock face that the government would lie to us.
Well, we know that they're lying, but they're apparently the success of how their lies are being accepted is starting, to change and to wane. I want to bring it very quickly to the near term in terms of, before we get again into your bigger picture outlook, what are we expecting from the Fed by the next meeting, end of the year? I mean, where we learned that we had meetings come out, and we learned that there was some pushback for Jerome Powell when it came to that half-point interest rate cut, some officials wanting 25 basis points during that September meeting. What do you expect next from the Fed?
Well, what I would be happy from the Fed is if they parked rates at 5% and never touched them again. The free market can work around Fed funds rates, but if they keep changing, the entire purpose of changing the rate is to throw the free market onto its heels. The entire purpose is to say, now we're going to change the rate. So you are now officially wrong. You have to correct for that error, right? So I think it was Hayek said, look, we can handle all sorts of bizarre rules as long as they're consistent. But the Fed, their entire purpose for being is to throw us out of equilibrium, right? If we knew the rates were going to be Fed funds rates was going to be 5% till the end of time, the free market would say, okay, I know what to do with that. So I think. I was shocked by the 50%, 50 basis points. Not shocked but not surprised. How's that? I like those two different words. To the extent that you'd have a tough time making the case for it, unless they can see something we can't see. And that is, it's conceivable that they can see now that the regional banks are all collapsing, and we just can't see it yet. I would think that I'd be able to see that. I remember when the banking system was collapsing in 2007, and I said to my class in March of 2007, I think the banking system's about to collapse. It took another year and a half, but I was correct. And so it's conceivable Powell will see something that's so ominous that he had to go 50 basis points. I'm not convinced it's actually going to do any good. I'm not convinced that game still works. But as it stands, based on what was headline data, we've got inflation that, in my opinion, is still too high, even using the official numbers. We've got all-time highs in the risk asset markets, which should scare the crap out of Powell. Powell should be so troubled by the fact that Nvidia is just nuts. That a famous quote from Graham, I think it was Graham back in 1949 or 1959 or something, where he said at some point, he was referring to the 20s, the whole idea of buying a revenue stream just completely got thrown out, and it just became nothing but price. And then that's where the markets are. It's nothing but price. So it's like gold. Gold is nothing but price, but we know that. But equities are not supposed to be nothing but. There's your sirens for you, by the way. Equities are supposed to. You're supposed to be buying a revenue stream, and you're not.
So then let's take it to that point that you made earlier of markets currently, as they are, being overvalued by 150%. Break that down for us. What metrics are you using to get to that number?
Well, I use about 25, but let me give you just one. And I actually posted on Twitter yesterday after you and I had what we'll call a brief chat. And that is, you take the Case-Shiller index and you go back to 1880 to about 1994 and you plot it. And then I actually just eyeballed it, but I think I know the answer anyway. So I think it usually sits around 12. And during that window, if you eyeball what the Case-Shiller price earnings ratio is, it looks like it's averaging about 12 for that. What's that? 20 plus, so say 115 years. And then when you plot the whole thing with that same line on it, you can see that the market's left orbit in 1994. You can see that when I say fair value, that's not really quite right. Historical average value is better. If you want to call that unfair, you're welcome to, but historical average value. The markets left orbit in about 1994, and there's an interesting debate about why that date would be a magical date for the markets to leave orbit. Debt picked up massively from that point. There's all sorts of indicators that followed the markets up. The 2008 correction, for example, got back to fair value, but not cheaper. And some metrics, it went actually slightly below fair value, but I did it with Mark Spitznagel one night. And I said they just barely got to fair value. And he concurred. He said, and they only spent about a month at fair value. So what we consider to be a horrific correction went back to historical average value.
How are we defining fair value?
By 1880 to 1994, the average.
Of what, price to earnings ratios?
Price to earnings, price to revenue, price to book, you name it. I do like 25 of them. They all give you the same answer. Dividends, if you wish. You can actually use dividends, right? The dividends over that period averaged around 4.5%. They got as high as 6%. They're now 1.5%. So averaging 4.5, 1.5, what's the market overvalued? Factor 3 by that model. So there's everything points to the markets being absolutely out of the Earth's orbit. Now, here's what I'll also tell you. There's never been an overvalued market in history that didn't become undervalued. There's not a single example of one that left orbit just stayed out there. It just will not happen. I don't know when, But that's why I say, look, if they're 150% over fair value, and if you do the experiment I just said, you'll see it, because the PE is now 36 instead of 12. So that's 200% above fair value. Okay, so you can either correct it back down. Now, what's a correction? I have a definition of a correction most people don't agree with. Some people say 20%. I go, no. Correction does two things. It corrects the price back to a rational level. I would argue a 60% correction would be needed. The other thing is it corrects investor attitudes. For the last 4 decades, investor attitudes, they've developed a sense of invincibility. So every time the markets drop, they say, now is the time to buy. V-bounce after V-bounce after V-bounce. And the markets never, ever really drop the price to cheap. And they never rip the will out of the markets to make them really suffer, where they say, never again. I'm not touching that crap.
And to that point, Dave, to what degree does it matter if you've got this overvaluation if markets are driven by sentiment? And so divorced from fundamentals, you own the stock, the markets think it'll go higher, so it goes higher. You know, you can sell it higher regardless of how that company's actually performing, because so much is just driven by sentiment. And as you just said, there's a dip, great opportunity to buy the dip. So, you know, what forces this correction?
Well, if you're a trader, that makes total sense. But if I were to tell you there's a train coming and I can't tell you when, would you camp out on the tracks? And the answer is a prudent person would not. And so the point is, if you accept my premise that at some point the markets will get cheap, and if you accept my argument that the markets are at least 150% over fair value, you also have to accept my premise that at some point you will be so angry with yourself for not getting out of the way of that disaster. Now, that disaster can take several forms. One, it can take a 29 to 33 form where it dropped 90%, and that formed a bottom. You can correct it like 1967 to 81, where the markets treaded water without inflation correction, but with inflation correction, it dropped 70%. Worse than dropping 70%, it took 14 years. Now, show me a boomer who could withstand 14 years of a 70% drop, and I will show you a very rare boomer. Now, show me anyone who can tolerate that. So at some point, it has regression to the mean is a force of nature. At some point, it has to regress to the mean. And
what is your current exposure to the equity markets?
Well, there's things I'd like to buy, but I'm holding back because I think when the whoosh comes, it'll all go. I have pots of money. I have one pot that comes from my dad that I don't have control over. There is like a 40% exposure there, and that'll get beat up. I have, as you know, a lot of gold. My equity exposure to the market's probably 10%.
Okay. We're going to get into your gold. How much of that is your portfolio percentage-wise is in gold?
All the different forms of gold commitment, including equities, which I don't trust. So what I do is I take cues from guys like Fred Hickey and Bill Fleckenstein, and they say these are the 3 gold miners who actually are run by people who are not idiots or liars. And I own some of those. If they went to zero, my exposure is small enough that besides being mad at gold equity CEOs, it wouldn't cause a lot of damage to me. I have probably to physical gold, I have probably exposure to the extent of maybe 20% of my total net worth, which my total net worth includes my house and stuff like that. So that's a lot of physical gold. And then probably another 10% in things like Central Fund of Canada, which I'm pretty comfortable owning. A little tiny smattering of silly things like a little, Pan American silver and things like that. And it's almost hobby. It's almost a hobby. It's enough where I go, okay, if that went to zero, I'd feel it, but it would not be life-changing in any way, shape, or form.
We're going to get more on your thoughts on gold a little bit later. I want to now get to this 40-year timeline view that you had, because you've said that the markets, once adjusted for inflation in 40 years' time, are effectively at zero.
Yeah, it's fourth grade math.
But break that down for us. Give me that thesis.
Well, so what do you accept is there's so many paths. There's an infinite number of paths to get to 40 years regress to the mean. So 40 years from now, regress to the mean, inflation corrected, right? So it means you got to burn off 150%. You got to account for inflation. If you accept that the GDP grows at let's be generous, 2.5% on average during the 20th century, will the 21st century be as good? It might be okay. I'd be surprised if it was as good because that was a pretty good century, but let's accept that it's the same. And so we say 2.5%. So if you were to simply grow your way out of a 150% overvaluation, it takes about 40 years, 2.5% compounded, 1.025 to the 40th power. And if you want to drop straight down, you got to correct 60%. Now it's fair value tomorrow, but that won't correct anything because the dip buyers will show up. The way you correct not only price, but sentiment is you have to keep knocking investors on their butts over and over and over again. You have to rip the will out of them. How do you do that? You do what the Nikkei did. So the Nikkei, I did a George Noble Twitter Spaces. George was Peter Lynch's right-hand man, so this was a cool Twitter space. And he said you could short it. And I said, no, you couldn't, George. You know you couldn't. Trying to short the Nikkei, it took 15 years to find the bottom. Your frictional costs would destroy you trying to short the Nikkei. And so the Nikkei is 35 years later without inflation correction, identical to what it was in '89. It finally made a new high without inflation correction. And it does include dividends. I don't know what their dividends were, but it also does include taxes and fees. And so you could really argue the Nikkei's down 50% for all I know. Still,
I mean, it also doesn't include what's happening with the yen as a currency.
Well, I think the Nikkei that I'm reading is a dollar-denominated Nikkei. I think.
So let's look at the U.S. scenario. Okay, I get your reference to the lost time in the Nikkei. If you're saying that if I put $100,000 in the S&P 500 now, that $100,000 in 40 years' time is nothing.
It'll be $100. It'll be the same if it corrects, if it regresses to the mean, and the GDP grows at a reasonable price. Because don't forget, you can only earn what you produce. If you don't produce anything, You don't earn anything.
So if I put $100,000 now, you're saying 40 years time, adjusted for inflation, it'll still just be $100,000. So hence going
inflation adjusted. Here's one for you. A guy named Ron Bryce, who runs the chart store, sent me a chart, and he showed the market from 1925 to the present, corrected for inflation using the M2 money supply, which strikes me as a pretty good metric because it's a pretty mathematical thing. I think it's pretty well known. Maybe there's fudge factors in there, but it's pretty clean. And from 1925 to 2025, the markets dropped, adjusted for M2 money supply. They dropped. What did you get during that period? You got dividends, which average about a little over 4%. Buffett says the most you can hope to get out of an equity exposure is about 4%, which is exactly what you got. And then you say, but those don't include fees, they don't include taxes. So you probably got 2%.
But you're making money along the way, right? I mean, you're saying what are the opportunities that you see along that 4-year timeline, assuming you come in and out at opportune times?
Well, let's kind of the dividends. The dividends are where you're harvesting the crop as you go. The capital gains is growth of the business. I kind of mentally break it that way. It's not clean, but it's a way of thinking about it. Here's an interesting way. Here's a great case study to see where Pfizer and their vaccine. Pfizer, by the way, has been a lousy investment since 1990s when I think during the Clinton era, something caused all the pharmas to take up, probably nationalized healthcare coming or something. But it's been a lousy investment. If you look at Pfizer before COVID and you look at Pfizer now, it's lower now than it was before COVID. This is how you track profits. And so you go, did that big, huge vaccine payout provide nothing? And the answer is no. In the middle, they had a couple of one-off dividend payments that were exceptional dividend payments. And I haven't actually done the math, but you can actually see the dividend payment spike, hold there for maybe 2 years, and then drop right back down. You can take those percentages for those 2 years, calculate it as a percentage of the market cap. I can tell you exactly how much money they made because that's what they paid out that was in excess of a normal working business. So I think the dividends in some ways reflect what the company earns. Like if you owned a gas station, it's not growing. It's a cash cow. And if you're paying a 4% dividend to yourself owning that gas station, essentially you're getting a 4% return. And so a friend of mine, David Einhorn, talks about companies that are priced at a PE of 5. And he kind of, the way he presents it, he talks about how like no one's interested in these companies. But he also knows full well that if you own a company that's kicking out 20% cash, you don't need capital gains. That company will put out 20% cash and somehow it will find its way into your pocket. Right? Now, here's the problem. If you look at the Mag 7, which I can't remember what the PE ratio is, but it's a monstrous number. According to their PE ratio, they're kicking out 1% a year. You say, well, what if they grow? Okay, let's say their earnings double. They can now kick out 2% a year. Let's say they quadruple, 4% a year. You see the problem? It's mathematically very hard to get out of a 1% cash flow.
So if you're positioning a portfolio for 40 years' time, and granted that's a very long time horizon, what are you doing then?
Well, I don't think you can position a portfolio for 40 years. I think it's turned us all into traders. So for me, I have a very large cash position, which I call cash. I have a lot of 2-year treasuries, for example. I won't go out long duration. There's no chance I'm lending the U.S. government money at 4% for 10 years. Because if you said over the next 10 years, what's inflation going to do to me? Boy, it could be a disaster. So I'll only go out 2 years. And again, according to my math, I'm probably losing money, but I'm losing money to maintain what a lot of people call optionality. I do believe we are going to have a serious correction. I see opportunities that I think are good, but they'd only be good if I didn't see a serious correction. So when the selling starts, everything's going to sell. People are going to start selling the shirts off their backs at some point, probably. And so you don't really want to own anything when the selling starts. You don't want to own gold even when the selling starts because people will sell whatever they can. But there are things that you say, look, if I have to own something, I'd rather own a 2-year treasury. I'd rather own gold. I'm comfortable with gold. But I'm pretty cashed up. I made a mistake in 0809. I was very cashed up in 0809. But because we only hit fair value and we had done what I thought was a huge amount of damage, I was convinced there was another factor of 2. So for me, greed kept me from buying. I bought some tobacco stocks and stuff like that, but not that much. Greed kept me from buying because I said, well, again, back Einhorn, I think it's credit for this. He says, you know what a 90% correction is? He says a 90% correction is an 80% correction and then cuts in half. So you buy a dip, an 80% dip, and then you lose half your money. You feel pretty stupid. So calling the bottom's hard. The mistake that I made in 0809, I won't make again, and that is when it reached fair value, historical fair value, I should have said, how much do I want to own at fair value? And then say 40 years from now, I'll be okay.
So David, let's take that. Well, we'll see you around in 40 years' time. But let's take that 40-year time horizon, right? Let's take that. Mm-hmm. Maybe a version of you will be uploaded into the cloud, your consciousness, who knows? You're short on Nvidia, but who knows? Maybe they'll use those chips for some AI application where your consciousness is uploaded by 40 years' time. But let's bring it back to the macroeconomic conversation. And using that 40-year time horizon, where do you see the state of the global monetary system by then, particularly with the view of the US dollar as a reserve currency? Because de-dollarization is one of the topics that we've discussed quite a bit on this show, and potentially how the dollar is losing its status as the king of global reserve currencies. I mean, we've already seen that trend happen with countries opting to trade in their own currencies. New report from JP Morgan showing that the share of US dollar in global currency reserves continuing to drop. Now it accounts for just 57% of reserves are dollar-based as of the third quarter, citing the IMF. That's compared to 73% in 2001. So we're seeing this trend. So let's use that 40-year time horizon of yours. Where do you see the dollar? Where do you see the global monetary system?
I think the problems will be way back in the rearview mirror. I think that's going to happen faster. So when I say regression of the mean over the next 40 years, the path to get there is absolutely unknowable. If I had to guess, I would say that the de-dollarization story will happen much, much sooner. To date, inflation has been well hedged by equities. And I'm willing to accept the idea that an equity is an inflation hedge when the inflation is tame. So for example, the metaphor I like is shovels are used to move dirt and bulldozers are used to move dirt, but don't confuse the two. So I think when you have relatively tame inflation, equities are the place to be. I think when inflation runs a little wild on you, which I believe it is, and I believe at some point we'll start to pay for this, like in, say, the 70s, I think equities will fail to be an inflation hedge. And that's when gold becomes the bulldozer relative to equities or the shovel. And so that's why I think you want hard assets. You want stuff that hurts when you drop it on your foot, as they say. So I believe that the de-dollarization story is real. I think our absolutely most fundamental mistake that we made was using the dollar as a military weapon against Russia. To the second that we told Russia, by the way, we're going to use the dollar and we're going to knock you out of the SWIFT system and things like that, every leader of every country in the world said, holy moly, I'm now in a position where if I piss off the United States, they're going to hurt me with the banking system. So I think that began a massive geopolitical movement to shift alliances. Now, a lot of currency guys will say, well, the BRICS currency will suck. I don't think it's about the BRICS currency. I think it's about alliances. I talked to Steve Hanke about this for about 2 hours, and he agreed. He's a currency expert. He says, you're dead right. It's not about a currency. It's not about some BRICS currency. It took the euro 20 years to show up. So BRICS currency is not going to show up. It is, BRICS was 4 countries, and they weren't even allied. It was just some guy at Morgan Stanley or something who named him. I can't remember. Famous guy. Goldman Sachs.
Goldman Sachs. Yeah.
Exactly. And he just grouped them together. It's like 4 emerging markets. But now it's an alliance. And now it's also an alliance that includes maybe 25 countries. Now, for the first time in my memory, we've got 25 pretty important global countries that are saying, we are going to hang out with Russia, China, India, Brazil, and 20 more. We're not going to hang out with the United States anymore. They are changing teams. And that is because we acted irresponsibly with the dollar. And so China's not buying our debt. Russia's not buying our debt. You and I should not be buying our debt. And so who's going to buy our debt? Well, apparently the Federal Reserve at some point, they say.
And yet you just said that you're in treasuries.
2-year.
2-year treasuries. You're comfortable with that level of debt.
So
let's bring it back
to time.
So the BRICS, they're having a summit later on this month, 22nd to the 24th of October in Russia. What are your expectations there? I mean, we know that it's the BRICS Plus, that they've already expanded at last year's summit to include Iran, Egypt, Ethiopia, the United Arab Emirates. Saudi Arabia is still sort of straddling the fence on that one, playing both sides for the most part. We know that Turkey, Thailand, Cuba, lots of other countries are applying to join the BRICS. What do you think is going to come out of this meeting? I mean, there's some conversation about progress being made about this new currency referred to as the unit. There are various reports that this unit, as it's called, could be pegged 40% to the value of gold, 60% to a basket of BRICS national currencies. This is what we're getting mostly from Russian news agencies. So they obviously have an incentive in putting out that kind of information. So we've got to keep that in mind. But what do you think comes out of this next BRICS meeting?
I think the most important thing has already been done. And that is, I don't know what's going to come out of this meeting. The fact that they are holding the meeting in Russia is the story. We have done everything within our power to demonize Russia. And we've got 25 important countries going to Russia to hold a meeting.
Yeah, and their heads of state. The leaders are arriving as well. They're not sending the prime ministers, the presidents. They're all showing up.
That's right. So the cool kids are not us anymore. That's the problem. Now, as I said, I think I mentioned to you at one point, Putin held a 3-hour press conference with 12 prominent journalists from all over the world about 6 months ago. And I've yet to run into a person who knows about the existence of this press conference. I don't know how I stumbled upon it. I got the transcript. I don't know where. I even asked Jeff Sachs if he knew about it. And he sat there like much the way Trump would do, throw the questions at me. And at one point, some guy said, oh, I have another question, but I'll wait. And Putin said to him, he said, you might as well ask it now. I'm not sure you'll get another chance. And what Putin does brilliantly is he never waffles. He might be lying, but he goes right through the front door. And so for 3 hours, he fielded questions from these international journalists who asked these pretty sweeping questions about why are you attacking here? What are you going to do there? And it got no headlines. It got no coverage in the West. Meanwhile, 25 major economic forces are meeting in Russia to talk about the future. They're not meeting in Washington. They're not meeting in The Hague. They're not meeting in Iceland. They're meeting in Russia. No matter what we said about Russia, which, by the way, I don't blame Russia for the war in Ukraine. Let's go there. They're meeting in Russia. I cannot fathom a more important message.
I know you've discussed how you think, as other guests on the show have as well, that Putin was provoked into the war in Ukraine after NATO's expansion in violation of previous agreements post the dissolution of the Soviet Union. But we won't unpack that in this conversation for I
just like to throw that out there just to piss off half your listeners. Yeah.
I think most of our listeners are potentially on board with that when we've had a few guests that do feel that it was potentially an unnecessary prodding. But let's bring it back to this idea of the BRICS. So you said you're not concerned about the BRICS currency. You said, the euro took a long time to happen, and even then it didn't really challenge the dollar. If you're not concerned about the BRICS currency, what then does happen to challenge the status of the dollar if it's not an alternative in the form of a different currency? How does that then threaten U.S. hegemony and supremacy on the global monetary stage?
So to answer this, I turn to a guy who I think has great data and lousy opinions, a guy named Peter Zeihan. He's been looking at demographics around the world and looking at various things. And one of the things that he emphasized, which I think he's dead right about, is the fact that the U.S. had the only blue water navy in the world. We could project power anywhere in the world. And what that achieved was that it kept trade open. And so someone who said, oh, I think we're going to cause some trouble and stop trade, the U.S. military would be down their throats fast. Now, here's the problem. We've now got 25 countries who previously would not have even thought about pissing off the United States because it's been a fatal thing to do, right? If all of a sudden you say, oh, we're going to do some gold dinar or something, next thing you know, your country's bombed into a sheet of glass. So making us mad has never been a very healthy move for a world leader. And now all of a sudden you got 25 world leaders saying, we're not as afraid of the United States. We're going to hang out with these commies over in Russia, which I don't think they're commies. China's kind of commie, but I think Putin is the most based world leader right now. I think Putin has his feet on the ground better than any other world leader.
So again, what does it mean for the dollar? You're saying that
it means we're weakening. We as a country are weakening.
You're saying that it's because the U.S. isn't viewed in the same way as it was on the world stage. And many would argue that it was the Biden administration that projected tremendous weakness on the world stage. A lot of people point to the withdrawal from Afghanistan, the debacle that was as a pivotal moment. Keeping in mind, we do have elections coming up. Would a change of U.S. leadership, say it goes to Trump, and I want to get your thoughts on the elections in greater detail, but sticking with the BRICS conversation, would a change of U.S. leadership potentially change this perception of the U.S. and restore the full faith and credit? Well, maybe not so much credit with $35 trillion in debt, but would it restore faith in the U.S. on the global stage if you had a more assertive leader?
Well, if you were a world leader, would you make any big grand bet based on a 4-year window? No. So let's say Trump gets elected. Let's say for some reason they like that. The best bet would be they'll solve that 4 years from now, right? The U.S. will go back to only offering us people that they like, that our power structure likes, right? Trump broke that mold is the problem, and that's what caused trouble. Again, we're back to the fact, what's it do to the dollar? Well, if Russia's not buying our debt, and if China's not buying our debt, and if Saudi Arabia stops buying our debt, and I don't know what they're saying, they might have already stopped buying. There's no one left to buy our debt, which means the Federal Reserve has to buy our debt, which means we're monetizing debt, which means the dollar's going to get smacked.
Even if they don't come up with their own currency. Let's bring back...
You can't print money and monetize your own debt without getting crushed.
What do you make of the fact that all of these central banks have been buying gold at record levels?
Because they're not stupid. That's what you have to buy, right? The fact that the central banks are buying gold, my God, does that make me salivate over my gold holding? My cost basis on my gold, by the way, for the record, starts at $270 an ounce. I bought from $270 up to about $457, stopped. And then when it sat at $1,200 for what felt like eternity, I bought another wad. And I haven't bought any since. But yeah, central banks are buying gold. Someone's going to make a move and say we're backing something with gold, I think.
And yet you don't think it's this currency that they're talking about.
We don't need a currency. If you say here's a currency that's backed by gold, if they come up with a currency that's backed by gold, it's just a receipt again. We're back to the old idea that a receipt for an ounce of gold is really just gold. So it doesn't require cleverness. Like the euro required cleverness because it was a fiat currency and there were all these connections and all these different, how do you have a currency and how do you have debt in Greece and debt in Germany and how do you juggle those two? But if you have a piece of paper that says this buys you an ounce of gold, that's not a complicated currency at all. That's just gold. That's right. Just, you can print those. If they said we're going to back this, we have enough gold. Let's say China has 87,000 tons of gold, like some people speculate, which I think is a big number. China could all of a sudden say, we're going to have gold certificates. We're going back to gold certificates. Here's a certificate that offers you 1/10 of an ounce of gold. And they could do it by Friday.
And what would be the consequences of such a move?
It's quite possible that would destroy the dollar immediately.
Paint that picture for us. How would that play out?
Well, why would you hold dollars which are being inflated away, whether slowly or rapidly, when you can hold a certificate that's not being inflated away? That's why the Bitcoin guys kind of have it right. I mean, the Bitcoin guys don't have it wrong. I don't trust the system to leave them alone.
All right. Well, we'll go down the Bitcoin lane, seeing as you brought that up. But before we do, I want to go back. It's your timeline, your 40-year timeline. So just for the sake of wrapping that idea up, it's 40 years time. Where's the dollar? How do you see the world stage? I know you said U.S. equity markets are basically nowhere, adjusted for inflation. Give me your synopsis in a few sentences of 40 years from now.
Well, projecting by assuming regression to the mean and normal growth in GDP, the math of 40 years from now is easy, in my opinion. There's no analog to that with respect to the dollar, with respect to these other things. So gold. Well, so here's everyone likes to say gold has been able to buy an expensive suit since an ounce of gold could buy an expensive suit since the dawn of time, right? But I don't know what a Roman suit looked like. What I've also read is that an ounce of gold could buy you a month's worth of labor, and a month's worth of labor hasn't changed. Just hard, unskilled labor hasn't changed. And so you say, well, an ounce of gold, $2,500 a month, that's about what you pay an unskilled labor. And I'm told that back in ancient Rome, it bought a month of unskilled labor. So I'm not one of these gold is money guys, because if I have all my assets in gold, I go to the grocery store tomorrow and gold has dropped 5%. My spending power has dropped 5%. So the price in the grocery store is going to be more stable denominated in dollars than gold, short term. And they always say, oh, it's not the price of gold that's going up or down, it's the value of the dollar. No, it moves too erratically for that to be an accurate statement. Long term, yes. Short term, no. So if you're not going to need, if you said, Dave, we're going to put you in suspended animation for 40 years, and we're going to wake you up in 40 years, put your assets somewhere, gold would be a big part of that story. I wouldn't know what else to get. A friend of mine does multi-generational wealth preservation, and I think he said 25% real estate, 25% fine art, 25% gold, and 25%, bonds or something. And the real estate's an interesting one, where he said, but real estate, you can have takeovers. He says, what you do is you hang on to the deed. And then when those evil forces get pushed back, you bring your deed back, you reclaim your land. So I think an example in the future could be displaced Cubans. who bring their deed back to Cuba and say, that's my land, give it back to me. And but I wouldn't want the fine art. I wouldn't want so I'd have a lot of precious metals if you were going to put me in a coma for 40 years and wake me up, and I would not put it in Invideo.
I prefer the idea of uploading your consciousness rather than you being in a coma, Dave. It has a nicer feel to it. You mentioned Bitcoin.
Yeah.
You mentioned Bitcoin. So let's go there. You said that the Bitcoin guys do have it right, but you're not convinced?
They have it right in principle. And the fact that I don't jump all over them like some of my gold bug buddies do, I don't think it's a gold or Bitcoin story. What keeps me out of Bitcoin is a multi-layered onion. I think the idea of the limitation, the blockchain is all logical. What I don't trust Bitcoin, I wouldn't trust myself to wake up 20 years from now and say, how did my Bitcoin hold its value? What I don't trust is, first and foremost, I don't trust the state to not step on it. And the maximalists will say, oh, the state can't do that. That's the beauty of the blockchain. I go, if the federal government says you will go to prison for 10 years if you use Bitcoin, I can guarantee you Bitcoin's not going to do well, because authoritarianism can take out anything it wants like that. So there's that. Secondly, Bitcoin, and I love the mobility of Bitcoin. So that part of the story, Lynn Alden tells that story the best. Secondly, Bitcoin has not yet been through a credit crunch. So in 08, 09, it was a twinkle in Satoshi's eye, basically. And I don't know when it actually formally started. It was somewhere back near there. But it was just it was just an oddity. It was just a quirky thing. And so I will be watching Bitcoin with great enthusiasm, not necessarily to buy, but just out of pure interest. If we have another credit crunch, what happens to the Bitcoin market? It could go into a swan dive. Gold holds up. Gold gets hurt, but holds up pretty well. I don't know if you remember 08, 09. You're probably in junior high, So, but gold held up okay through 08, 09. It got hurt, but not badly. What happens to Bitcoin? That's a fascinating question to me. But it could do a 95% swan dive. It could do a 20%, correction, and that could get me to ponder buying some. But people say, "I'll just buy 1%." I go, "What's 1%? That's like a $10,000 life insurance policy. It's not going to make a difference." So if Bitcoin's going to make a difference for me, it's got to be a position. I've got to size it.
Right. That's a fair point. We don't know how Bitcoin performs in that particular scenario. For the
record, could be buying opportunity.
For the record, I wish I was in junior high in 09. I was actually anchoring for Bloomberg Television here in New York back in 2009. But I'll take the junior high compliment any day of the week. But on the Bitcoin idea of regulation, some of the Bitcoin maximalists would say that is somewhat elevated as a risk now, relieved as a risk because you've got these big institutions. You've got the BlackRocks backing Bitcoin. It's become a regulated, legitimized asset. So they're less concerned about it being, regulated out of existence because you've got so many of the traditional financial players in the party. Now, for me personally, I've actually always argued that is contrary to the ethos of Bitcoin, that it is against the whole idea of moving away from the traditional financial system. But it does, to many, allay the concern of it being regulated out of existence. You still see that as a big existential risk.
It's possible that the entire purpose of Bitcoin is being missed by some, and that is that I'm told, it gets to the question, what is the fact? I'm told that the original paper, the white paper on Bitcoin, was written by 3 guys from the NSA. The first paper that had the word coin, currency in it was written by 3 NSA guys. That would lead you to believe that it's possible that the story about Bitcoin is not quite what we're being told. It's not some grassroots thing. Now, what would it be? Well, one of the possibilities is it could be they're crowdsourcing the technological development required to bring in CBDC. So what does Bitcoin do? First, it gets you used to owning a digital currency. Second, they've debugged the whole blockchain problem and all sorts of details. And they say, okay, now we're going to squash Bitcoin, but here's CBDCs. And that's authoritarianism. That's a serious problem. So there's that potential problem. Second of all, BlackRock is up to its ass in DEI. Watch, they'll run from that so fast. So these big money guys will stay in an asset long enough to make a ton of money, and then they will bury you up to your neck as soon as it suits their purposes.
So that is definitely not any sort of way to alleviate concerns that the regulation crisis. No, I don't necessarily.
But I like your ethos argument too. I mean, the last thing I want to do is own an asset that has become one of these financialized assets.
Well, for me, that's contrary to the whole idea. If you subscribe to the vision of what Satoshi Nakamoto after the 2000
a hat tip to people like Max Kaiser and Stacy Herbert, who got in early and hung in there. They got those two have to be worth $1 billion. I mean, they've got to be stinking rich. I did a couple podcasts where I said, I'm guessing you guys don't have trouble paying the heating bills.
Well, they're hanging out in El Salvador, so I don't know that that's probably the air conditioning bills that they need to worry about most of the time, if anything.
They'll pay it off.
I'm sure they will. But the idea of Bitcoin being a Trojan horse for CBDC.
I worry about it.
It has come up on the show before, and it would be interesting, as I say, to have you on and perhaps have one of our big Bitcoin maxis to debate that conversation with you. But that has come up, and regulate the system, get people used to the idea through this whole private enterprise, and lay the groundwork for then a central bank digital currency. Let's hope that's not the case. If for no other reason than the fact that, as our viewers know, nothing keeps me up at night more than the idea of a central bank digital currency as the ultimate tool of oppression.
Yeah, that's a nightmare. That's
control.
a nightmare.
And speaking of oppression and control, I think that this is a good time to segue perhaps into the elections, right? And what your expectations are there.
Well, I believe if the election was straight, I think Trump would own it with a huge margin. I don't think you can take Kamala, who was the least favorite vice president in history, and all of a sudden turn her into a winner like that. I think that's a media narrative that is just a complete fabrication. There's famous people who've noted that people who lived in authoritarian states, they say, look, we knew that it was propaganda. What they're shocked by is that the Americans don't understand that they're getting propaganda. And so there's nothing about Kamala's campaign that looks like a winner to me. Nothing about it that makes any sense whatsoever. And the Democrats who would vote for her should be so disgusted by what the Democratic Party has done to the party that used to be credible. Now, you say, well, what about the Republicans and Trump? Well, first of all, what I'll tell you is it's pretty clear to me the Republicans didn't want Trump. They just couldn't stop him. So they want MAGA out of there. They want Trump out of there. They can't say it because MAGA and Trump are too powerful. But the Republicans want to go back to normal. They want to go back to being a bunch of, sort of authoritarian light leaders and go back to the olden days. And so if it was legit, I think Trump wins big. That doesn't mean I think, in March 2025, Trump will be in the White House. I think that to the extent that Biden has shown that the presidency is a laughably irrelevant office, or can be. So I think when the right person is there, I'm reading Annie Jacobson's book, Nuclear War, and it's terrifying. They describe the sequence of events that happens if there's a nuclear strike heading our way, and how they open up the nuclear football and the various checkpoints and stuff like that. And you go, you don't want Biden or Harris for that, and I'm not sure you want Trump with that. I might feel better with Obama with that. You want a very clear-headed person at the helm. And so I think the Biden presidency showed that you can live without a president, but it didn't in any way dissuade me from believing that it's an extremely risky state of being. So I think it hurts the dollar. Let's go back to that. I think showing the insanity. I think if I were a foreigner looking into the United States, I would be scared. I would be saying, oh boy, the guys who used to be dependable don't look very dependable to me. I think Kamala, I can't figure out if she's stupid or if we're getting some professional wrestling skit going on and that she's just playing that role. But I'll tell you, the other day there was a video of her and her teleprompter broke and she could not handle it. Now I could handle it. You could handle it. Trump could handle it. Biden could handle it. But Kamala was just stuck. And so she just repeated the same sentence over and over and over. So she really does appear to lack any sort of intellectual and moral compass. And that scares me. Now, to the extent that she's probably not going to be calling the shots no matter what, or Biden wasn't calling the shots, maybe nothing will change. But Glenn Greenwald wrote an article about the danger of the country being led by committee rather than having a person at the top. Think of the Cuban Missile Crisis without Kennedy. Imagine you removed JFK from that room. What would have happened? And the outcome, I think, would have been very different. I think it came to the fact that there was one guy there who said, history will show that it was my fault if I blow this. And so he tried to get it right. And I think, by the way, back in defense of Powell, I never quite finished that thought. I think Powell's worried about his legacy. I think the economists and the market makers and stuff are underestimating that Powell might be more worried about whether he's going to be Arthur Burns or Paul Volcker than they're giving him credit. So in the New Orleans meeting for several years now, I've said, you guys are underestimating Powell's resolve to be one of the great central bankers if he can.
Meaning he's going to hold steady, meaning you don't see more rate cuts.
That's why I was shocked by the 50 basis points. I don't think they were called for, and so he somehow caved on something. But if he goes 50 and then says, okay, now shut up, that's all you're getting, that's fine. That's fine. He threw a bone. But if he keeps dropping it down, he takes it back to zero, then he's blown it, in my opinion. He will go down in history as a weak central banker. Yellen is a post-it note in the history of central banking, and Bernanke was a disaster, in my opinion.
Let's bring it back to the elections then, what the potential outcomes could mean for the markets. So I hear your point. A lot of people sadly have lost faith in the integrity of the system and in the institutions. So I hear your point that if the elections are indeed fair, then you think that Trump wins. Look, I mean, we've had guests on the show that say they're not going to let him win, that have called correctly an assassination attempt following the weaponization of the justice system, as many have seen it. But, we still, let's see how that one plays out. What are you doing from a market perspective to prepare for either outcome? I'm
already hunkered down in my bunker of doom, so I've got nothing else to prepare for. So I have been prepared for worst case scenarios for quite some time. So after having, as I said to you before, my greatest decade was the noughts. When everyone else was getting crushed by two bear markets, I compounded 13%. My worst decade, 13% per year. My worst decade were the teens. While everyone was partying like it was a drunken orgy, I was hunkered down still because I didn't think it was over. And I got something like 4% a year out of the teens. And everyone else was getting like 12% or something. So I got crushed that decade. Overall, I've done well, but I'd like to do over on the teens. And I wish I had, but
how do you see gold responding? How do you see gold responding one way or another?
I think gold could do what the bulls say it's going to do. I think the guys who euphoric over gold might be closer to right than normal. Euphoric people are not right. They might be right. I'm very comfortable owning gold.
Do you have a price forecast for
no,
early
and if I gave you early 2025, I have no idea. Short term, I have no idea. Gold could be anyway. Yeah, long term, could gold get to 5,000 in the next 2 years? Yeah, I think so. But by early 2025, I don't have any idea.
So 5,000 gold in the next 2 years. And again, it's not necessarily.
But I'm just guessing. I literally, anyone who actually takes what I just said to the bank should get a CAT scan. It's an opinion of an organic chemist.
True, it is an opinion, and I want to now bring it back to the idea of opinion versus fact. But before we do that, you did say your opinion that you think that the age of the American experiment could be over. Expand on that.
Weaponization of the justice system was Biden's legacy. I think it's actually, in my opinion, the Democratic Party's legacy. So I see, gender transitions. I see a lot of real rot in the system. But by using the justice system to take out political opponents, we have really, really stepped off the precipice, in my opinion. When Biden bragged about putting J6ers in jail for a sum total of 870 years, that to me, that was Hitlerian. That was just truly awful. So you could argue January 6th was a sad day in U.S. history, but the Saturday was when the president bragged about putting people in jail for 870 years because of it. The fact that they've used the justice system to go after Trump in a horrifically brutal way. My brother's an accountant. The accounting convictions that they got out of him, which were corrupted at so many levels, my brother can't even figure out what law he broke. So here are 34 felony charges that seem to be unfounded in the justice system, in my opinion. The fact that the voting interference and all that stuff, the Stormy Daniels crap, the E. Jean Carroll crap, these are all weaponizations of the justice system. I think Merrick Garland is treasonous. Now, I don't know the formal definition of treason, but I'd love to put him in front of a grand jury and let him figure it out. I think Merrick Garland is a horrific human being at this point. Because he should have not let the justice system gone that far off the deep end. Another example, it's not even politicized. Daniel Penny saves a bunch of people in a subway. Guy's crazy. He walks in the subway, says, I'm going to kill people. I don't care, blah, blah, blah. Daniel Penny puts a choke on him for 90 seconds. It wasn't 50, 90 seconds, and he's up on a homicide charge. Daniel Penny, if he pulled out a gun and blown the guy's head off, I would give him a medal for taking control of a bad situation. The guy was threatening to kill people, yet he's on a homicide charge. It's just astonishing to me. And so the justice system has been destroyed by somebody, and I believe that it's been destroyed by somebody who is using a Sun Tzu sort of tactic. I think these are people who wish to destroy the United States. I think this is all part of a plan. You're not going to destroy the United States with battleships and with bombers and things like that. You're going to destroy us by getting us to destroy ourselves, and they are doing a superior job of doing that.
We're running out of time, David, but I think this is a good place to then hear your idea as part of this phenomenon of self-destruction, of how we're in an era where we're questioning what is a fact and how much of that is in fact designed to create a lack of faith in the system. So expand on this idea that you say you want to touch on, the framework of we don't even know what a fact is anymore these days.
Well, CPI, let's start with that. We've already talked about it. One of the mistakes they made, by the way, is they handled COVID wrong. So COVID clearly was a geopolitical event. It was not a health event. If they had played it with a slightly softer touch, they might have gotten away with a lot of stuff, but they overplayed it. And so, if you don't at this point know that the vaccine killed a lot of people, you have not been paying attention, because it did. If you don't know that ivermectin is an unbelievably good drug with no side effects, you have not been paying attention. They overplayed their hand on this. And so you've got a huge percentage of the population going, okay, so the COVID story was a farce. They locked down kids who were not getting sick at all. It was a farce. They destroyed 3 million small businesses. It was a farce. Once you start questioning things like that, you don't stop. You say, what about 9/11? What about Pearl Harbor? What about World War II? And it turns out that you find that they're always lying to us. And that the lies have felt like white lies when in fact they're not really white lies. There's some really egregiously horrific lies. And so now you've got a populace which is, I would say, on a bit of a DEFCON scale emotionally. And here's the problem. We're at a market top. They say the economy's still okay. If 10 years from now you were to look back, I bet you would say that the chance that this represents some sort of top and that we're going to go through a tough period. We have never been at a top with people in such a grumpy mood. Remember 2000? It was euphoria. The world was phenomenal. Everything was great. We're all going to get rich off pets.com. The internet was going to change the world. It felt so good. This top, you got people who are talking about civil war. You got people who are talking about authoritarianism. By the way, people includes me. This emotionally looks like a bottom. And so then the question is, what happens when, let's say I'm right, the boomers lose more than half of their retirement money? What happens when, because of these downturns, Gen X or Gen Z or millennials or whatever still can't buy a house? And society's going to be in a bad mood. So this gets you into fourth turning thinking. It's a little too pre-canned, right? Categorical. But what happens if the next 10 years is the bad 10 years? It could get pretty gruesome, I think. Now, I don't like projecting such things, but I wouldn't be shocked. Springfield, Ohio has 20,000 Haitians in a town of 60,000. I'm doing a second podcast with one of the world's expert on the southern border. He's a border guard who's written the book on it, who's made documentaries on it. And we've let thousands of people into this country who are bad actors. Possibly tens of thousands, possibly hundreds of thousands. And I'm not talking bad actors because they're poor and they're people of color, whatever. I'm talking people who maybe came here to be bad actors. If I were an enemy of the United States, and over the last 4 years, those borders were thrown wide open, I either moved unbelievable numbers of my people across those borders into the United States, unmonitored, or I am not a very scary enemy of the United States. It was an opportunity that our foes, our adversaries, couldn't possibly have overlooked. Once we close those borders, we might say, okay, everyone, we're going to get in, we've gotten in, so now what do we do with that? And all of a sudden, things start blowing up. And all of a sudden, we start getting shootings. And you've got this looting phenomenon. We've got society figured out that 20 kids with their cell phones can organize a loot, and they can go in and destroy a store in 10 minutes.
David, unfortunately, we're out of time. You're painting a bleak picture. Any quick positive note that you have for us?
Well, Jonathan Turley's book is a must-read. The Indispensable Right. It's about the right to free speech. And that's what COVID taught us we didn't have. You could not speak up against it. You now could not speak up against Ukraine. You could not speak up against, heaven forbid, someone touch Israel, Gaza. Oh my God. Turley tells a history of the battle for free speech. And the good news is it cycles. And say, okay, when times get tough, free speech gets stepped on. And it's been going on for 250 years, this cycling. It's a very scholarly and riveting book. Those two don't go together well. I urge everyone to read it. Here's the problem. The good news is it cycles and therefore will cycle out, presumably. The bad news is Turley, when he does interviews, says, and he's a brilliant legal scholar, he says, I am not sure we're going to get out of this one. So I'm back to doom. But read Turley's book. That's my good news.
You're back to doom, but you've got some good reading for us in the bunker, at least. Keep Gold and a few good books in the bunker. We don't know what a fact is, but I'll tell you what is a fact, and that is that I've enjoyed speaking with you and appreciate your very candid insights and information. So thank you very much, Dave Collin. Really appreciate it.
My pleasure.
And thanks as always to our viewers for watching. A big thanks to our sponsor, Goldback. For our viewers not yet familiar with Goldbacks, it's an easily portable form of a physical, interchangeable gold currency made of real 24-karat gold. Now, these are gold notes with real gold woven inside. The gold is vacuum deposited using state-of-the-art proprietary technology. And with Goldbacks, you can help protect your wealth against fiat currency debasement and devaluation through the stability of gold, because they are in fact made with real 24-karat gold, and they appreciate with the price of gold. And Goldbacks allow you to own and spend gold in small interchangeable increments. You can buy Goldbacks starting at just about $5 US. Goldbacks can be used as real money from small to large transactions. There are over 5 states where Goldbacks can be used to pay for goods and services, from a growing list of over 2,000 businesses where Goldbacks are accepted as payment for goods from coffee to sneakers to RVs to services like chartering flights, getting your car repaired, or even your accounting services. And there's also a way to earn interest on Goldbacks that you get paid back in Goldbacks that you own. So get all those details on goldback.com. If you want to diversify the way you hold your gold and get some Goldbacks, there is a link in the description of this video with where and how you can buy your Goldbacks. So make sure to check that out. As usual, thank you so much for checking us out. Please feel free to leave us your comments, praise, whine, or just opine. From me, Michelle McCory, and the rest of the team, we'll see you soon.
On the Spot with Michelle McCory is brought to you by Goldback. Inflation-resistant, 24-karat gold currency. Protect your purchasing power, grow your wealth annually, and spend